Welcome, ladies and gentlemen. Thank you for joining the MMXM Traders Mentorship. Before we dive into all the content, let's watch this mandatory risk disclaimer. So, first of all, I know this goes without saying, but all credit regarding the concepts themselves go to the inner circle trader, Michael J. Huddleston. The 2022 ICT mentorship is a core understanding and is not taught in this mentorship. However, it is a prerequisite. So if you haven't studied the 2022 ICT mentorship, do so first. So over here we got a overview of all the topics we're going to cover. First of all, we have the core concepts. These are foundational to understanding the trading models, and we're going to cover all these topics in the next lessons. After we've covered those core concepts, we're going to go to market maker models, how to use time frame alignment, how to use mitigation blocks, and how to actually trade those market maker models. And we're going to talk about the silver bullet, of course. After that, we're going to go to top-down analysis. We're going to be talking about long-term perspective, intermediate term perspective, and short-term perspective, which includes a New York session bread and butter model. And then at the end, we're putting it all together. At the end of the course, we're going to be talking about models and risk management. So we're going to be talking about a universal model, which is applicable on all time frames. Then a highly requested Asian session model, which is a hidden gem. And then at the end, we're going to be talking about passing funded accounts and how to retain them. So let's start off our first lesson about the power of three, which is the open high low close and the open low high close of a candle. Now what is open high low close and open low high close? We also call this the power of three, right? So accumulation, manipulation, distribution of a certain type of candle. Understanding the open high low close or the open low high close of a candle is crucial in everything from daily bias to entries. It's a foundational understanding to my trading, and the concept is fairly simple yet highly effective. We all know the daily candle opens up at 5 p.m. EST and closes at 5 p.m. EST. However, we are going to use this understanding from 12 a.m. EST to 12 a.m. EST, which is the true day open. And we call it true day open because this is where the algorithm starts its true day, right? So we're going to be talking about 5 candle formations. We're going to be talking about a bullish candle, a bullish reversal candle, a bearish candle, a bearish reversal candle, and then at the end about a consolidation candle, which is indecisional. Right, so over here we've got a bullish candle and a bullish reversal candle. So a bullish candle is a open low high close, right? Let's outline that over here because we open up the day over here, make a low, continue to expand during the day, creating the high of the day, and then closing out eventually. Now, most of the time when we have these types of candles, London session or London kill zone creates low of the day, and then we expand higher during London and have a New York retracement into a continuation. And then with a bullish reversal, we have a longer wick on the bottom, right? So we have a open, and this longer wick on the bottom can be comprised of a sell side liquidity run on the higher time frame, thus having a reversal and then continuing expanding up higher and closing at the end of the day. So over here we've got two bearish candles, right? We've got that bearish candle and a bearish reversal candle. A bearish candle is a open high, low close, right? So over here we open up, we create high of the day, expand lower during the day, and eventually close out the day down here, thus having a bearish candle. Now again, just like with the bullish candles, the high of the day can be formed during London session most of the time, expanding and having a New York continuation to close out the day bearish. With a bearish reversal candle, we can see again we have a longer wick on the top this time. This longer wick can be a buy stop rate, or we can hit a higher time frame bearish premium array, right? Like a higher time frame fair value gap or order block, causing a reversal for the day, continuing down lower and expanding lower until we close out the day bearish. And finally, that indecisional candle. The name already says it, right? The candle has no idea where it wants to go, leaving a relative equal top wick and a relative equal lower wick, and looks kind of like a doji, right? Right, so over here we've got a British pound US dollar daily chart. We've got outlined our premium and discount levels, right? From this discount low into this discount high. We can see these candles forming what up on top of this? Buy stops, right? And then what do we have over here? We've got a bullish order block, right? So when we're looking at a bullish candle, we're seeing a low created over here, expansion higher, taking out those buy stops, and eventually closing out the day bullish. But how does that look like on a intraday chart? We've got a intraday chart for the British pound and the US dollar, 15-minute chart, right? We've got that higher time frame POI over here, that bullish order block. Now, where do we create low of the day? Below that New York midnight open price, right? So let's outline that over here. Draw out that New York midnight opening price, 12 a.m. EST, right? Low of the day is being formed down here during London session. A lot of times we form low of the day during London session, and that makes trading New York a little bit easier, and I will explain later in this mentorship why. Over here we got that daily candle, right? We open up, create a lower wick, and then expand for the rest of the day with a bullish daily candle. Low of the day London session, New York retracement into continuation until we reach that buy side liquidity target and closing out the day over here, leaving this as a bullish candle. Over here we've got a Euro USD daily chart, right? Where is our discount and premium levels? We go from this low until this high, right? 50% level is in discount. Now over here we know if we're dropping lower and lower and lower, we're going into discount levels. And are we hitting a higher time frame PDRA? Yes, we've got that daily fair value gap, right? So we're going to be talking about a bullish reversal candle right now, and we can already see it's forming down here. And why are we reversing? Because we took out sell side liquidity, right? And then we're hitting a higher time frame discount array. How does that look like on a intraday chart? Again, we have a 15-minute chart for Euro USD. We're hitting that higher time frame POI, right? We took out all those sell side liquidity, and outline this with more annotations. Again, always outline your New York midnight opening price, right? That is the true day open of the algorithm. We want to be buyers below this line, and we want to be sellers ideally above this line. So over here we've got an indecisional London session, right? Probably some high impact news later in the day, could be possible. With New York session we drop lower, creating low of the day in New York. We run all that sell side liquidity and hitting a higher time frame PD array, right? That discount fair value gap, and then having a New York reversal profile for today. And you can see this longer wick because we opened over here, right? And actually if we take a daily candle we open at 5 p.m. but that longer wick is because we dive deep down below that New York midnight open line and then closing out the day higher up, so leaving this longer wick, thus having a bullish reversal day. Right, over here we've got a Euro USD daily chart. We've got an old high up here, external range liquidity buy stops over here have been purged, and then after we run buy side over here, it's likely that we have a bearish day afterwards to fill up an imbalance, for instance this imbalance down here. So how does that look like on a intraday chart? So we got this Euro USD 15-minute chart, right? We ran buy stops above this red line, right? So we are having a bearish day afterwards. So how does that look like with more annotations? High of the day during London session, right? Most of the time, London session creates high or low of the day before a higher time frame PY has been hit, right? So draw out your daily opening price over here. We see we trade and accumulate sell stops above here, taking out these buy stops. And you can see on a daily candle that looks something like this. An upper wick has been formed and the rest of the day will expand lower and lower and lower. During New York we have a retracement into premium levels, and then we continue down lower until we reach our closing price, forming this daily bearish candle. Now let's talk about a bearish reversal candle, right? So why does it reverse? Most of the time we hit a higher time frame PDRA or we run buy stops or sell stops, right? So in this occasion, we've got these buy stops up here being ran, and then we see this longer wick down and closing the day out bearish. So how does that look like on a 15-minute chart, a intraday chart, right? As always, draw out your New York midnight opening line, right, over here. Draw it out in time all the way to the right for the close of the day. And then with this longer wick on top, we need to have a expansion higher first, right? So we're expanding higher first, having a New York session reversal profile. We run buy stops on our higher time frame and then start to decline after, and then closing out the day over here, forming this bearish candle. So think about it, right? Accumulation, manipulation up higher into those buy stops, and then distribution lower. So that's the power of 3 of a daily candle. Now let's talk about a consolidation candle or an indecisional candle, right? So the market obviously has to be in a consolidation and the market has no clue where it wants to go next, thus creating a indecisional candle. So how does that look like on a intraday chart? You can already see it when we draw out that New York midnight opening price. It's just straight up, down, down, right? So we're creating a high of the day, going back to that New York midnight opening price, creating a low of the day, and then just keep hanging around that New York midnight opening price. And this is an indication too of a consolidation day. And you can also say it's kind of a seek and destroy profile, because we just run buy stops and sell stops and returning back into the range. And then on the daily candle, it looks something like this as an indecisional candle. Now that we went over our first lesson about power of 3, let's move on to the second lesson, which is about failure swings, low resistance liquidity. Now, first of all, what is a failure swing? A failure swing is a swing high that fails to take out another swing high, or a swing low that fails to take out another swing low. So this is low resistance liquidity, and we want to see this form on the opposing side of our structure. So for instance, when we are bullish, we want to see a bearish failure swing. A bearish failure swing is a high that fails to take out a previous high. And when we are bearish, we want to see a bullish failure swing, and a bullish failure swing is a low that fails to take out a previous low. And the market will usually go through opposing failure swings with ease, like a hot knife cutting through butter. Now we covered low resistance liquidity. Let's talk about high resistance liquidity, and we want to see this form on the side of our structure. So a low that ran a previous low and rejected is a high resistance low, and a high that ran a previous high and then rejects is a high resistance high. And we'll use this logic on all time frames. So over here we got a crude depiction of a market maker buy model. We've got our drawn liquidity up here, our structure and our discount array. Now think about where we want to see those failure swings form, right? When we are bullish, we want to see those bearish failure swings, which is a high that fails to take out another high, right? So how does that look like? Over here we've got multiple failure swings, right? We have a high over here, which this high fails to take out. Then over here we've got this little trend line going on, which is a set of failure swings, right? So this high fails to take out this high, and this high over here fails to take out this high. And down here we've got even more, right? So high, lower high, and even a lower high. So all failure swings around here. Now once we hit that discount array and we've got a low formed over here, we want to be targeting those failure swings as our draw on liquidity. And why is that our draw on liquidity? This is low resistance liquidity, right? So we always want to go for that low resistance liquidity. Now, what do we want to see form on our side of the structure is that high resistance liquidity, right? So we know it's rejecting that low and we want to go bullish, so we don't want to see those lows ran again. But how does that look like? So over here we got that high resistance low, right? Because we run that previous low and then reject immediately. So this is a good confirmation that we are heading into bullish order flow. I always say high resistance liquidity runs happen on the opposing side of our order flow. So once we are bullish, every low that gets ran and rejected is probably a high resistance liquidity run, and the market will struggle to go below those lows when we are bullish. Now once we are bullish again from the discount array, we want to target those failure swings, right? That low resistance liquidity. And once we're in discount, we want to draw into premium, right? So once these failure swings are in discount still, that's even better because we want to draw into premium. And if we have that low resistance liquidity in our discount range already, then it's even better to draw into premium and take out that low resistance liquidity. So over here we got the inverse, right? This is a market maker sell model. So we've got our premium array up here and our draw on liquidity again down here. Now, what do we want to focus on, right? We want to focus on that low resistance liquidity. And where is that forming? Again, those failure swings, right? Those low that fails to take out another low. And we've got those over here. We've got again a little trend line down here, right? Multiple lows which fail to take out the previous low, even down here at our draw on liquidity and over here. Now once we hit that higher time frame premium array, right, we want to see that smart money reversal happen, so that change in order flow, but we want to see a high resistance liquidity run first, so we know that's on our side of the structure and confirms our order flow. So how does that look like, right? We have this high which gets ran and then rejects immediately, and if that happens, we have again a good confirmation we're going to go in bearish order flow. Now we can see all these lows, these failure swings, right, and they are all still in premium, which makes it even better if we want to draw at least into discount and eventually the target down lower. Now over here we've got another high resistance liquidity run and then rejects immediately, right? So again, on our side of the structure, we want to see those high resistance liquidity runs happen. So we know these highs are probably going to stay intact and we're going to continue down in our draw on liquidity, right? Those failure swings which we have down here, which are still in premium over here. And then we draw back down into discount levels, taking all those low resistance liquidity lows down here and also down here eventually until we reach that draw on liquidity. So over here we've got a E-mini S&P 500 futures chart. Now let's look where is the discount and where is the premium levels. We've got this low down here for our discount. We've got this high up here for our premium levels, right? And now think about that low resistance again, right? Where are the failure swings forming? We've got those failure swings down here, right? So this is low resistance liquidity, and this is a nice target where we can draw into. So notice how these failure swings are in premium, right? And once we go from premium into discount and those failure swings are still in premium, we've got that engineered liquidity down here, right? Those failure swings, and it will cut through butter like a hot knife, right? Back into discount over here, which we can see that daily discount fair value gap, which was the draw on liquidity after we draw into bearish order flow. So low resistance liquidity up here has been liquidated and we hit that discount fair value gap in discount, right? So how does that look like on an intraday chart for the E-mini S&P 500? We got that 1 hour chart over here, right? So think back about that market maker buy model, that crude depiction we covered earlier. This is the same kind of schematic, only with candlesticks. We've got our draw on liquidity on the highs, right? And then our higher time frame discount array, which in this case is that daily discount fair value gap. Now over here we got that high resistance liquidity run, right, against order flow, right? So it rejects that low immediately and starts to go into bullish order flow. Now notice where are the failure swings, right? We've got all these failure swings up here, which is low resistance liquidity. Now also notice how this is still in discount levels, right? Because the premium is about around here and we want to move up into that draw on liquidity, which is up here, and then target all that low resistance liquidity, all those failure swings up here, and then eventually up here on a draw on liquidity. So over here we've got our Euro USD monthly chart, right? Let's see where our premium and discount levels are. So from this swing high up here into this swing low down here, we've got our whole dealing range. So everything up here is in premium, everything down here is in discount. So what did we hit recently? Did we hit a higher time frame PDRA? we've got this monthly premium fair value gap, right? So that's a perfect area where we can reject from, and on the lower time frame we can scout for an opportunity to get into a sell. So let's go to the daily chart. So over here we got that Euro USD daily chart, and remember we hit that higher time frame bearish array, right? That monthly premium fair value gap. So over here we've got some nice structure, right? What do we want to see when we want to sell? We want to see a high resistance liquidity run, which confirms we are going into bearish order flow, right? So how does that look like? So over here we've got that high resistance liquidity run, right? So it's a swing high that takes out another swing high and then immediately rejects price action. And we can see over here it fails to take out this high once again. So it starts to trade lower and lower and lower. Now we want to target that low resistance liquidity, right? So where is that forming? Over here we've got all these lows, right, which are forming, which is a failure swing. Again over here, failing to take out these lows and these lows, and over here we've got some relative equal lows. So that's a very good to draw on liquidity, and we call that low resistance liquidity. Right now, where does a opportunity lie to go into these lows, right? We're scouting for a premium array once again. So what is available on the chart right now? We've got that volume imbalance up here, right? So that's also a good area to take a sell from, and you can actually see how willing price action is to go through those low resistance liquidity lows, those failure swings, right? So you can see here price action goes down with ease, right? And that's the whole point of that low resistance liquidity. Now that we went over our first lesson about power of three, let's move on to the second lesson, which is about failure swings, low resistance liquidity. Now, first of all, what is a failure swing? A failure swing is a swing high that fails to take out another swing high, or a swing low that fails to take out another swing low. So this is low resistance liquidity, and we want to see this form on the opposing side of our structure. So for instance, when we are bullish, we want to see a bearish failure swing. A bearish failure swing is a high that fails to take out a previous high. And when we are bearish, we want to see a bullish failure swing, and a bullish failure swing is a low that fails to take out a previous low. And the market will usually go through opposing failure swings with ease, like a hot knife cutting through butter. Now we covered low resistance liquidity. Let's talk about high resistance liquidity, and we want to see this form on the side of our structure. So a low that ran a previous low and rejected is a high resistance low, and a high that ran a previous high and then rejects is a high resistance high. And we'll use this logic on all time frames. So over here we got a crude depiction of a market maker buy model. We've got our drawn liquidity up here, our structure and our discount array. Now think about where we want to see those failure swings form, right? When we are bullish, we want to see those bearish failure swings, which is a high that fails to take out another high, right? So how does that look like? Over here we've got multiple failure swings, right? We have a high over here, which this high fails to take out. Then over here we've got this little trend line going on, which is a set of failure swings, right? So this high fails to take out this high, and this high over here fails to take out this high. And down here we've got even more, right? So high, lower high, and even a lower high. So all failure swings around here. Now, once we hit that discount array and we've got a low formed over here, we want to be targeting those failure swings as our draw on liquidity. And why is that our draw on liquidity? This is low resistance liquidity, right? So we always want to go for that low resistance liquidity. Now, what do we want to see form on our side of the structure is that high resistance liquidity, right? So we know it's rejecting that low and we want to go bullish, so we don't want to see those lows ran again. But how does that look like? So over here we got that high resistance low, right? Because we run that previous low and then reject immediately. So this is a good confirmation that we are heading into bullish order flow. I always say high resistance liquidity runs happen on the opposing side of our order flow. So once we are bullish, every low that gets ran and rejected is probably a high resistance liquidity run. And the market will struggle to go below those lows when we are bullish. Now once we are bullish again from the discount array. We want to target those failure swings, right? That low resistance liquidity. And once we're in discount, we want to draw into premium, right? So once these failure swings are in discount still, that's even better because we want to draw into premium. And if we have that low resistance liquidity in our discount range already, then it's even better to draw into premium and take out that low resistance liquidity. So over here we got the inverse, right? This is a market maker sell model. So we've got our premium array up here and our draw on liquidity again down here. Now, what do we want to focus on, right? We want to focus on that low resistance liquidity. And where is that forming? Again, those failure swings, right? Those low that fails to take out another low. And we've got those over here. We've got again a little trend line down here, right? Multiple lows which fail to take out the previous low, even down here at our draw on liquidity and over here. Now, once we hit that higher time frame premium array, right, we want to see that smart money reversal happen, so that change in order flow, but we want to see a high resistance liquidity run first, so we know that's on our side of the structure and confirms our order flow. So how does that look like, right? We have this high which gets ran and then rejects immediately, and if that happens, we have again a good confirmation we're going to go in bearish order flow. Now we can see all these lows, these failure swings, right, and they are all still in premium, which makes it even better if we want to draw at least into discount and eventually the target down lower. Now over here we've got another high resistance liquidity run and then rejects immediately, right? So again, on our side of the structure, we want to see those high resistance liquidity runs happen. So we know these highs are probably going to stay intact and we're going to continue down in our draw on liquidity, right? Those failure swings which we have down here, which are still in premium over here. And then we draw back down into discount levels, taking all those low resistance liquidity lows down here and also down here eventually until we reach that draw on liquidity. So over here we've got a E-mini S&P 500 futures chart. Now let's look where is the discount and where is the premium levels. We've got this low down here for our discount. We've got this high up here for our premium levels, right? And now think about that low resistance again, right? Where are the failure swings forming? We've got those failure swings down here, right? So this is low resistance liquidity, and this is a nice target where we can draw into. So notice how these failure swings are in premium, right? And once we go from premium into discount and those failure swings are still in premium, we've got that engineered liquidity down here, right? Those failure swings, and it will cut through butter like a hot knife, right? Back into discount over here, which we can see that daily discount fair value gap, which was the draw on liquidity after we draw into bearish order flow. So low resistance liquidity up here has been liquidated and we hit that discount fair value gap in discount, right? So how does that look like on an intraday chart for the E-mini S&P 500? We got that 1 hour chart over here, right? So think back about that market maker buy model, that crude depiction we covered earlier. This is the same kind of schematic, only with candlesticks. We've got our draw on liquidity on the highs, right? And then our higher time frame discount array, which in this case is that daily discount fair value gap. Now, over here we got that high resistance liquidity run, right, against order flow, right? So it rejects that low immediately and starts to go into bullish order flow. Now notice, where are the failure swings? Right, we've got all these failure swings up here, which is low resistance liquidity. Now also notice how this is still in discount levels, right? Because the premium is about around here and we want to move up into that draw on liquidity, which is up here, and then target all that low resistance liquidity, all those failure swings up here, and then eventually up here on a draw on liquidity. So over here we've got our Euro USD monthly chart, right? Let's see where our premium and discount levels are. So from this swing high up here into this swing low down here, we've got our whole dealing range. So everything up here is in premium, everything down here is in discount. So what did we hit recently? Did we hit a higher time frame PDRA? We've got this monthly premium fair value gap, right? So that's a perfect area where we can reject from, and on the lower time frame we can scout for an opportunity to get into a sell. So let's go to the daily chart. So over here we got that Euro USD daily chart, and remember we hit that higher time frame bearish array, right? That monthly premium fair value gap. So over here we've got some nice structure, right? What do we want to see when we want to sell? We want to see a high resistance liquidity run, which confirms we are going into bearish order flow, right? So how does that look like? So over here we've got that high resistance liquidity run, right? So it's a swing high that takes out another swing high and then immediately rejects price action. And we can see over here it fails to take out this high once again. So it starts to trade lower and lower and lower. Now we want to target that low resistance liquidity, right? So where is that forming? Over here we've got all these lows, right, which are forming, which is a failure swing. Again over here, failing to take out these lows and these lows. And over here we've got some relative equal lows. So that's a very good to draw on liquidity, and we call that low resistance liquidity. Right now, where does a opportunity lie to go into these lows, right? We're scouting for a premium array once again. So what is available on the chart right now? We've got that volume imbalance up here, right? So that's also a good area to take a sell from, and you can actually see how willing price action is to go through those low resistance liquidity lows, those failure swings, right? So you can see here price action goes down with ease, right? And that's the whole point of that low resistance liquidity. Let's go on to our third lesson for this mentorship. It's going to be about previous days highs and lows. Previous days highs and lows. That will be the easiest draw on liquidity for you. Think about it. Every single day you can see the daily candle reaching for previous daily high or the previous daily low. This is the easiest liquidity pool in the market side. There is rarely a inside bar, as we call it, and we'll show you on the next chart how that looks like. But in bullish order flow, the market will always seek buy side liquidity above previous daily highs, and in bearish order flow, obviously the market will seek sell side liquidity below previous day's lows. Previous days highs and lows is one of the foundations to daily bias and the draw on liquidity. It's the easiest liquidity pool the market will attack almost every single day. So now let's look at this next chart. We've got a daily chart for GBP USD. Now we can see a old daily low over here, or sell stops have been liquidated. So our higher time frame target has been hit over here. Now expanding higher and higher and higher. Let's look at all the candles in this chart. Do you see a candle which is an inside bar? I can show you one if I have to look for it. I think this one did not take out the high of the previous day, so this is what we call a inside bar. But look at all the other candles. Almost every candle takes out a previous daily high or a previous daily low. Over here it takes out the high and the low, which is indication for a reversal, but we'll cover that later. Over here we take out the low, over here we take out the low. Again over here both sides has been taken. This one takes the high, this one takes the high, this one takes the low, and so on. So 90% of all these candles takes out the previous daily high or low and will liquidate a daily liquidity pool. Now looking at after we rated those sell stops on the daily time frame, these daily low down here, what is the next target, right? We have an imbalance over here which could be repriced. Then we also have some relative equal highs up here, which is a good draw on liquidity. So now what do we wait for, right? How do we get there? And when do we engage on this? That's a topic for another section, but looking at all those previous daily highs and lows, that will be the easiest draw on liquidity. Outlining these highs over here. These are all buy stops. And remember, we already took out this long-term low down here, right? So over here we've got this smart money reversal, and then look at every previous daily high, right? This previous daily high gets rated, easy. This one gets rated, creating a small wick on the bottom, going up, taking out this high, and then eventually we're breaking structure over here. So buy side liquidity pools are seemingly getting taken out, and we can assume bullish order flow is coming in. Now let's annotate a break of structure, right? Over here This was the last swing high in this down move, and it got taken out by this big bullish candle. Now, this is significant because we already took out this old daily low, right? So remember that if this low was still intact, and let's say this candle and these candles just were slightly above here, you would still be you would still have to think about this low can be rated again, and then if we take out this high, we might just have a high resistance liquidity run, right? So this is important, this low getting rated before we break this structure, so we know there are no orders left on the sell side to return back into. Now with this displacement over here, what do we form? We have a daily fair value gap inside here after a break of structure, and again importantly this sell side rate down here. So this sets up a nice narrative to take buys, and order flow has changed to bullish instead of bearish. Again, outlining previous daily highs, right? Now we hit that discount array, which is a daily fair value gap after that break of structure. So we dip into that, and then we can look to target previous daily highs, right? So this low didn't get rated. We have an inside bar over here. So continuing up, taking out buy stops over here, taking out buy stops, previous daily high over here again, and again we've got this one over here. Now on a intraday chart, which is a 1 hour chart on the British pound against the US dollar, we have that break of structure right here, right, on the daily time frame, and then we have this blue box, which is that daily fair value gap. Again, think about these lows down here. Sell side liquidity has been rated. So after that break of structure, we can assume order flow is going into bullish order flow. So always outline your New York midnight lines, right? 12 a.m. EST, Monday, Tuesday, Wednesday, Thursday, Friday. Now we know where are we in the week, right? Also, Monday trades up, Tuesday trades up, but look at these highs, right? There are kind of relatively equal high, so it could be a buy side liquidity pool. So now we dip back into that daily fair value gap, which is a higher time frame discount array, right? So it makes sense if we break up structure from here. If we do so over here, we're breaking structure up here, rating this short-term low down here, back once again into that daily fair value gap. We also have a tiny little fair value gap down here, and then continue up, and then order flow is good to go into previous daily highs. So buy side liquidity pool over here, buy side liquidity pool over here, over here, over here, and eventually up here. So zooming in a little bit more, outlining that New York midnight price, right? Dipping below New York and reversing, going for previous daily highs. Again, this is key every time. If you trade below the daily or the New York midnight opening price, create a low of the day either in London session or with a New York reversal profile, we can expect previous daily highs to get rated every time. So if you are confident in your analysis that we are in the daily time frame bullish order flow, only look for those previous daily highs and always mark those out too on your chart. So I would say the most essential things to have on your chart is that vertical line to separate the days from 12 a.m. New York time. Draw out that New York midnight price line, and also previous daily highs and previous daily lows, as those are the easiest liquidity pools in the market. Now, how do these candles look like? Let's go to the next slide. Now we can see actually the daily candles look like this, and this is a very good indication we're still in bullish order flow, right? We've got slightly a bullish reversal candle over here, which we covered in the previous lesson with the power of 3, right? A little bit of a longer wick on the bottom, but closing out bullish after, importantly, hitting a daily fair value gap. Next day, also a buy day. Then we are in the next week, which is on Monday, also a buy day, and then you have to think about what time of the week you are in, obviously. But we still got a bearish candle, but order flow is still bullish, right? So You cannot have like 20 bullish candles in a row. There has to be some sort of a retracement or a slow move lower. And then you can have a bearish candle too. But remember, order flow is still bullish. We've got these nice highs over here, right? So even though this candle closed bullish, think about that liquidity pool, which is above market price, which is the previous daily high. Now we've got a daily chart on the DXY, or the US dollar currency index. This will be the scenario for a bearish order flow, which will target previous daily lows. Now there is a higher time frame array up here, a premium level which got hit. I assume this is a daily fair value gap going down lower and breaking structure down here. So we've got confirmed sell side of the curve incoming, right? So over here, every time we take out more buy side, so we take out previous daily highs again and again and again until we reach that higher time frame array, right? Now breaking structure lower and returning back into that daily fair value gap. So this is the same what happened on the bullish order flow, which we just covered, but this is on the sell side of the curve. So now we hit that bearish daily fair value gap, and we can see market is targeting every time this previous daily lows. Marking out your previous daily lows again, this one gets taken out, this one gets taken out. This last swing low after that break of structure gets taken out. Again, previous daily low, previous daily low, previous daily low. So very easy liquidity pool to get targeted when you are in bearish order flow. Let's look at this intraday chart, 1 hour chart again. Daily fair value gap, hit, higher time frame, right? Continuing in bearish order flow. Outline your previous daily lows every time. That's the liquidity pool. Trading lower during the week. This is a Friday. Let me outline this New York midnight open price, right? Every time we trade above it and then start to decline. Trade above it, start to decline. Over here, same situation. Trade above New York midnight price, decline. And it goes on and on until every time we take out these previous daily lows. I would say when Asia range is very large, right, then you don't necessarily have to trade above a New York midnight price. But over here, Asia range is every time is quite small and ideal to trade above New York midnight price. So how do the daily candles look like if we utilize this? Again, all bearish candles, right? So most importantly, do we hit a higher time frame array? Yes, we did, right? That daily fair value gap, that bearish daily fair value gap. And then we start to break structure lower, outlining the previous daily lows. Easy draw on liquidity, and all the daily candles will close bearish. Moving on to our next topic, daily swing highs and lows. Daily swing highs and lows. Now, every turning point in the market forms a swing high or low. On a lower time frame, this might seem meaningless. However, if we use a daily chart end, we see this form at a key level, and importantly, we also still have a draw on liquidity present. This becomes crucial, and we can frame an entire model behind this idea. So over here we got a US dollar index daily chart. Now, first of all, what is a swing low and what is a swing high, right? Over here we see a swing low. With a swing low, you want to have 3 candles next to each other, right? One is higher closed than the middle one, and to the right of it, it should be higher closed than the middle one. So we've got one higher, one lower, one higher, and then we have a swing low. So over here, we've got a swing high, right? So one candle to the left is lower, one in the middle is higher, and to the right of it, it is lower. So anticipating high probability price moves with swing highs and lows, we need to see them form at a key level. So if we are bullish, we want to see a swing low form at a discount array and or after running another swing low. And if we are bearish, we want to see a swing high form at a premium array and or after running another swing high. So the two opportunities using the daily swing highs and lows, and the easiest model you will ever have is the day after that 3-day swing bar pattern has formed. So we're going to focus on day number 4 after that swing high or low has been formed. We can also focus on 2 days after that 3-day swing bar pattern has formed. So 2 days after that swing high or swing low has formed, or day 5. So once the 3-day swing pattern has formed at a key level, we can look for day 4 to run previous daily high or previous daily low, right? So after that 3-day pattern. Furthermore, if day 4's body, right, the 4th day after that 3-day swing pattern has formed, if that 4th day body's candle closed above bullish or below bearish, right, we can also aim for previous daily high or previous daily low if the draw liquidity is still intact. So then all we have to do is work with the understanding of the open high low close or the open low high close, right? Taught in that first lesson of the mentorship. So this is hands down the easiest model you will ever have. You may not find a high probability trade on one pair every week, but within a basket of a few pairs you will find one high probability trade every single week using this model. All you need is one trade a week to make a living of trading and pass all funded accounts you want. Right, so over here we've got a crude oil futures chart, a daily chart, and again we're gonna focus on that 4th day, right, after that swing pattern has formed. So we can see a swing high form up here, right? We've got another swing high formed up here, and notice how this is formed in a volume imbalance, right? So we've got a premium array over here, and we've got another swing high formed over here, and we're focusing on that 4th day, right? And notice how that 4th day every time almost is a big candle, and it goes into our draw on liquidity. So now after we focus on that 4th day, we're going to use our understanding of that open high low close, or that power of 3, right, from lesson number 1. So this is day number 1 on the daily chart, right? Day number 2 over here, and then day number 3 down here, which forms that swing high on the daily chart. Now, is it in a key level? Yes, it is in a key level, right? We got that daily fair value gap fill, and then we're going to focus on the day after. So day number 4, open high low close, right? So draw out your New York midnight opening price. We want to see a manipulation or accumulation of sell orders above this New York midnight price line, right? How does that look like? Open high low close, right? So this is the daily candle we are anticipating to form. Over here we've got that accumulation of shorts above that midnight opening price, right? Over here, this is what we want to see. And then we got that break of structure lower, right? So day number 4 is the highest probability day to continue down into our draw on liquidity, and we want to see that accumulation above New York midnight, which happens. So we've got that power of 3, right? That open high, and then we're aiming for that low to expand and then close out the day bearish. We're forming a fair value gap, so this is the next premium array where you can frame your trade setup from, and we're anticipating that open high low close to form, right? Day number 4, very important, and eventually we draw down into our draw on liquidity. Right, so over here we've got a Euro British Pound daily chart, right? And now think about that daily swing high or daily swing low again. We want to see that form at a key level, right? So over here we've got that swing low formed, right? Is it happening at a key level? Yes, it is, right? Because we got that daily discount fair value gap. We've got this discount level and that fair value gap formed down here. Now we're going to focus on day number 4, right? That's most high probability to run that previous daily high after that swing low formation has formed. So over here we've got day number 1, we've got day number 2 hitting that daily fair value gap in discount, and then day number 3 forms that swing pattern, right? And now we're gonna focus on day number 4 because that's highly likely to run previous daily high. So we got an easy draw on liquidity, and we're gonna use again our understanding of the power of 3, right? That open, low, high, close of the candle. So how does that look like on an intraday chart? We've got that Euro British Pound 15-minute chart right now, and again we're outlining those numbers, right? We've got that daily swing low form down here. We've got day 1, day 2, and day 3. So that's that daily swing low being formed down here at a key level. Now we're going to focus on day number 4 running day 3's high, because that's an easy draw on liquidity, right? And we know we have a swing low formed at the key level, so bullish order flow is very, very likely to occur. Higher time frame, we have the draw on liquidity up here, but first of all, we're going to aim for that day 3 high. So looking for that low resistance liquidity, we want to see those failure swings, right? That's what we want to aim for. We want to see a high resistance liquidity run with our structure. So if we run a low and we reject, then we can look for a setup afterwards, right? So we've got those failure swings up here, low resistance liquidity. We're going to aim for this daily high. Again, using our understanding of the power of 3, that open, low, high, close of the daily candle, we're going to outline our New York midnight. We're going to use our New York midnight opening price, right? We want to see a low form and then continuation up into our drawn liquidity. So the daily candle should look something like this, right? We want to see an open, we want to see a low form, then expansion up higher, and eventually closing the day bullish. So where does the opportunity lie, right? We've got that liquidity rate down here, then price moves up, and in the process of moving up, we have our drawn liquidity up here. In those failure swings, we form a bullish order block and a fair value gap. So this is an opportunity to go long and aim for that high on day number 3 and eventually expanding up higher, going to our drawn liquidity. So over here we've got a US dollar index daily chart. Again, we're looking for a swing low to form at the key level, right? So we've got this bullish order block over here. We outlined that mean threshold also, important level, and now we can see that swing low pattern formed down here, right? One higher, one lower, and then one higher. And again, we're focusing on day number 4 and day number 5 is if the drawn liquidity is still intact, right? So on day number 4 over here, we're gonna aim for that previous daily high first. Now how does that look like on an intraday chart? We've got this 1 hour chart over here from the dollar index. Again, day number 1, day number 2, and day number 3, right? We want to see that swing low form at a key level on the daily chart, and then we're going to focus on day number 4. So where does the opportunity lie? We want to look for low resistance liquidity, right? So over here, we've got pretty much a lot of low resistance liquidity, all these failure swings up here. We're going into buy side of the curve over here. We've got this bullish order block supporting price up here. And eventually on day number 4, we can focus our attention on our entry model and then target day number 3's high and eventually more buy side liquidity in this LR or low resistance liquidity up here. So simply put, we can look for a fair value gap or an order block, and that could be our entry, and then continuing up into the draw on liquidity. The next topic we're going to cover is internal and external range liquidity. This lesson is what's gonna be the turning point for most of you. This is what makes bias easy. You really want to get your notepad out for this one, guys, and understanding the relationship between these types of liquidity will unlock your ability to read price action. Also, very important, backtest as always. I'm going to be talking about time frame alignment. We're talking about monthly levels into a daily structure. We're going to be using weekly levels into a 4-hour structure. We can use a daily level into a 1-hour structure. So price is fractal, right? So understanding external to internal, we can use these different types of levels on the monthly, weekly, and daily levels and using their corresponding structure on the daily, 4-hour, and 1-hour. The relationship between internal and external range liquidity and how they interact is the key turning point in really understanding where the market is likely to draw to. I consider this lesson one of the most important, if not the most important one in the mentorship. So grab your notepad, guys, make notes and backtest. The understanding you will learn between these two is the foundation to building the anticipatory skills for price movements and understanding where the market is likely to draw to. Now, what is internal and what is external range liquidity? Internal range liquidity, or IRL, is defined by fair value gaps, so imbalances on your chart. External range liquidity is defined by old highs and old lows. When external range liquidity is taken, a fair value gap becomes the next drawn liquidity, and when a fair value gap is tagged, an old low or a old low. Again. And when a fair value gap is tagged, an old low or an old high external range liquidity becomes the next draw. Now we have a crude schematic over here on how to see where internal and where external range liquidity is. We've got this move up starting from here. So we have external range over here, which is an old low, right? We move up, going down, 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 taking out that low. So that is external range liquidity, right? Because there's an old low down here. Now, price only does two things, right? It goes to old highs and old lows, or seeks to reprice into imbalances. So in this range where we draw lower from, there was a fair value gap or an imbalance up higher. Price took out external range liquidity. So what is the next thing price will do? Price will draw to internal next, which is that fair value gap. So think about it, when you see a old high or a old low get rated, you want to either look for an imbalance inside that range to get repriced into, right? And then once that gets hit, we can move for the next one, which is external again. Same over here, only reversed, right? We have external range liquidity over here, as in an old high. Price moves lower, forms a swing low, expands up higher, taking out that external range liquidity. In the process of taking out that external range or old high over here, we form an imbalance down here, which could be a fair value gap. Then price moves back into that fair value gap after taking out external range liquidity, right? And then when we hit that internal range, we want to go for external again. As explained earlier, price only does two things. It draws to old highs and old lows, and it rebalances an imbalance. So there's literally nothing else price does. And with that in mind, it becomes very clear after you see old highs or old lows getting rated. What are we going to look for next, right? We're going to look for an imbalance where we can trade into. And let's say we are in bearish order flow and we take out an old low. There's probably a fair value gap in a premium level on that same structure. We can look to trade and buy into that old, after that old low has been rated, we can buy into that fair value gap. And once that fair value gap hits and it respects it, we can look for external range again, right? The flow of the marketplace is that internal range liquidity being tagged will be the catalyst for price to draw to external range liquidity, and vice versa. And external range liquidity being taken is the catalyst for price to draw to internal range. So it's only this, and it repeats as simple as that after time, it repeats like this: external to internal, internal to external. Using this understanding on the monthly, weekly, daily and 4-hour is the key you've all been looking for when it comes to daily bias. All right, we've got a Australian dollar, US dollar monthly chart over here. Now let's look where is the monthly external range liquidity over here, right? So we rate this external range. Now, without going further, where does your eye draw into? You should be looking at a internal range liquidity in the form of a fair value gap, right? So after external gets rated, where do we want to reach into? We can see this imbalance down here, which is a fair value gap, right? So if you looked at this area after we got this external range liquidity rated, you're on the right path. We can see this monthly internal range liquidity in the form of a fair value gap gets tagged. Now, what happens afterwards? Right? Let's look at this from a daily perspective, right? We take out a monthly external range liquidity. Now, using daily structure to frame our setups, what are we going to be waiting for? After this monthly external range liquidity has been taken, we're going to look for a monthly internal range to be the drawn liquidity. We have this outlined down here. Now we need to wait for a little bit of confirmation, as always, right? So we wait for a break of structure. That happens after we rate the monthly external. Break of structure down here, return back into premium, and it continues down into that fair value gap. Example of AUD USD monthly chart. As you can see, external range liquidity defined by the old high gets taken and price starts to trade away from the high. So your eye should immediately go to that bullish fair value gap below market price as the next drawn liquidity, Because external range liquidity being taken is the catalyst for price to draw to internal range liquidity, which is that fair value gap. When we look at the marketplace with this understanding of the relationship between the two, and we blend that with the higher time frame charts, your understanding of price and where it's likely to draw next should really start to materialize. We can see just from this understanding on the relationship between the two being used on a higher time frame monthly chart, we have managed to frame a bearish bias for the whole 2 months. So think about it, right? You can have a clear draw on liquidity for 2 entire months. All right, we've got a GBP AUD weekly chart over here. Again, let's look at it from here. Weekly external range liquidity has been taken. Where is your eye drawing to? Do we see any imbalances down here? Nope. Where do we see an imbalance? Right down here. So with that imbalance being present down here, this fair value gap, your eyes should immediately go there for the next draw on liquidity. External range has been taken, so what are we going to look for next? Internal range, right? Weekly internal range liquidity over here. And it draws in there perfectly. Now we've hit that weekly internal range liquidity. Think about it, right? External to internal. Now we're in internal. Where are we going to draw into next? Where is your eye going? Right? External range liquidity over here. It's as simple as that. External has been rated over here. We draw back into internal. Internal has been tagged. Where are we going to go? We're going to go to external. It's simple as that. So that weekly external range liquidity, that old high has been liquidated after going into internal. And looking at the daily chart, now we can see how we can frame our bias on the daily, right? So this was the draw on liquidity. We're drawing lower, 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 right? And then hitting that weekly internal range liquidity. So we went from external, remember, back to internal. Now we've hit that internal range liquidity going into a market maker buy model, right? This is the sell side of the curve over here. Then we're going into buy side of the curve over here because we hit a higher time frame discount array, right? It's a fair value gap. So now we're going to reach for external range liquidity. And the first external range liquidity, which is very obvious, is this long wick here, right? So we're going to eye up this liquidity, which is also a break of structure after we hit that higher time frame array. Now, when the market displaces over here, we have internal range liquidity formed, right? So again, we go from external over here. Where do we want to go? We have internal, right? Back into internal. And after we hit that internal, where do we want to go? External again, right? So we have this old high up here, which is external range liquidity. And you might think, well, wait a minute. I thought this was external range liquidity, right? But in this whole bigger range, every swing high or swing low is external range liquidity. And that, remember, internal range liquidity will be that fair value gap we're looking for to mitigate with and continue up. So same case over here, we take out this external range liquidity. Again, where are we going to go? Do we see any fair value gaps? Yes, we have this one. And we have a fair value gap down here. But why are we not taking this fair value gap? Right? This has something to do with premium and discount. Obviously, if you take this range high to this range low to this range high, this fair value gap is in premium. So it's more likely it will draw into this discount fair value gap, right? So keep that one in mind. Market draws to that internal fair value gap in discount, right? Of this range, swing low to swing high. Continues up again. Where are we going to go after we take this internal range? Again, it's on repeat, right? External to internal to external to internal, and it keeps going and going. Again, external range liquidity over here after we take that internal range. So we went from this internal on a higher time frame, right? That weekly internal range liquidity as the fair value gap, and now we're on a daily chart and we can see day after day we're looking for external to internal to external to internal. Again, back into external. Right? Now we've hit that external, that extreme high up here. What do we want to do? We want to go back into an imbalance again, right? There's another imbalance down here in the fair value gap. and it keeps on going into internal and then draws back into external. So literally it's external to external on repeat. Again, external, and then all the annotations together, you can see how this is forming, right? Think about that extreme high. We're going to, and this high, we rated an external range liquidity over here. Remember, so we're drawing into a weekly internal level. Weekly internal level is down here, right? That fair value gap. Now we're looking for a buy program, buy side of the curve. We're going to an external range here, back to internal, to external, to internal, to external, to internal, and so on and so on. Knowing the relationship between the two is what leads us to a high probability daily bias. You can see how many intraday opportunities we just had with the understanding of the relationship between internal and external range liquidity. All right, we've got a USD dollar index daily chart. Again, example after example, and this is what you need to see. You need to train your eyes for external to internal to external, and it will make your reading of bias a lot better. And sometimes you don't know what is the draw on liquidity, but with using external to internal and internal to external, it will make it a little bit easier and, might I say, more accurate. So over here, external range liquidity again, right? What do we do after we take external range liquidity? So what do we do after we hit external range liquidity? Again, we want to go to internal range, right? So where is internal range liquidity? We've got this big fair value gap up here. Price reprices back into that imbalance over here. So we hit that internal range liquidity. What do we want to do after we take internal range liquidity? Go back to external, right? We fill this up. We look for this external range liquidity down here. And we keep declining. We take out this external range. Where are we gonna draw into next? You might have guessed it already. We're going to internal again, right? You can see it draw lower, going back into internal down here. Keep declining, taking out a low. There's no imbalance anymore over here, so price has issues going up way higher than here, and it just keeps declining, taking out this external range liquidity. Now we took external range liquidity. Do we see an imbalance anywhere, right, where we can reprice into? Yes, we have over here. We have this daily fair value gap, internal range liquidity. We've got a British pound Swiss franc daily chart over here. Again, example after example. Keep repeating this. Down here, external range liquidity, old swing low, right? Over here. And might I add, we have a rejection block here, right? This long wicked area over here, which is pretty deep in discount, right? Don't forget about your discount and premium levels, which is this whole range. Right, so we're pretty deep in discount. We rate a swing low, which is external range liquidity. Now where does your eye draw into? Right, we have this candle's low to this candle's high, forming a fair value gap up here. Price draws in there after we take external range liquidity. So now what are we gonna do after we take this internal range liquidity? You've guessed it, we're probably gonna go into external range once again. So looking at a 1 hour chart makes the structure look a little bit easier to read, right? We have a clear sell side of the curve over here, leaving that fair value gap on the daily time frame. After we take out this external range liquidity, we can actually see with 1 hour chart starts to break up and starts to break structure up here, right? Break of structure, return back into discount levels, repricing this internal range liquidity, right? External over here, back to internal, continuing up, taking out external. Where are we going next? Back to internal, right? Fair value gap down here. And then we're gonna go for external again, which is this daily fair value gap. So we went to external on a 1 hour chart, and on the daily it's a internal range. So for some of you, it's gonna be easier to spot than for somebody else, but in my experience, I found it most easy to see external range to internal range first. So we wait for an old high or a old low to get rated right, and then we want to trade into an imbalance as a clear draw on liquidity. If you find it easier to spot external range to internal range, you can just stick it with it like that. You can also go from internal range to external range, which could be a OTE entry, right, into a range on a fair value gap, and then aiming for an old low or an old high. You don't ever have to trade internal range to external range, and the same goes for those of you who can see internal range to external range. Important is what is most comfortable for you to see. So let's summarize internal to external range liquidity. The relationship between the two being used on the monthly, weekly, daily and a 4-hour chart is the key that unlocks your understanding to bias and builds the anticipatory skills required to forecast market direction and where price most likely will move. One of the biggest misconceptions regarding low resistance liquidity runs is there are only fragile patterns on a chart like trend lines or equal highs or equal lows, that kind of patterns, but that is valid. However, true low resistance liquidity runs are framed off the higher time frame PDRAs, right? So think about that: monthly levels, weekly fair value gaps, and so on. The higher time frame monthly, weekly and daily charts are the catalyst to one-sided low resistant liquidity runs occurring in the marketplace. In this next lesson, we're going to be talking about order pairing. Now, with order pairing, the previous lesson we had internal and external range liquidity. This is going to be key in understanding order pairing. So what is order pairing? Understanding the liquidity requirements smart money needs for their orders, where they get in and where they get out of those positions, is a crucial fundamental understanding that is required to trust the market to deliver to those specific levels and understanding where and why it's reaching for that specific level. Have you ever had those moments where you believe price is going to reach for a level, however you abandon it just for price to eventually get to your desired location? This urge to get out of the market is on a retracement, thinking is reversing and not trusting the delivery is a lack of understanding the liquidity requirements and how the market makers will engineer liquidity for their order pairing. Again, using time frame alignments, we use a monthly PDRA with a daily structure. We use a weekly PDRA with a 4-hour structure. We can use a daily PDRA with a 1-hour structure, and eventually a 4-hour PDRA with a 15-minute structure. So price is fractal, right? So if you, for instance, are a swing trader, you're better off using a monthly or a weekly PDRA and then utilizing the daily structure or a 4-hour structure. If you are more of a intraday trader, you're better off trading the daily PDRAs with a 1-hour structure. And if you're a scalper or a short-term trader, a 4-hour PDRA and an M15 structure, that's good enough. So depends on your personality. If you are a swing trader, higher time frame might be better. If you are more of a scalper or intraday trader, go with those daily PDRAs or 4-hour PDRAs and their structure, 1-hour structure and 15-minute structure. So where is smart money involved, right? Smart money is involved in moves on the monthly, weekly and daily time frames. No time frame lower than these time frames they are involved, because their orders are simply too large for these time frames. So when they are bullish, they accumulate their orders below old lows, and when they are bearish, they will accumulate their sells above old highs. If you are not trading off a higher time frame level, you are gambling. Right, so over here we've got a British pound Canadian dollar monthly chart, and just look at this chart and what do you see? What is the order flow right now? And where are we coming from, right? So we had bearish order flow over here. We have this massive rejection wick, and then spot internal range and external range liquidity, right? So we hit that internal range liquidity on a monthly time frame. So what is price gonna be wanting to aim for next? External range, right? So we hit an internal range liquidity down here. Then we can see external range up here, external range up here. And eventually we want to reach into that external range because we go from internal range to external range. So let's zoom in a little bit more. So here we have a daily structure and we have those monthly levels annotated also, right? So we have this monthly fair value gap down here and then the buy stops also on that monthly time frame. Now looking at that daily structure, where do we want to see the order pairing happening? If your eye went to down into this low, you are correct because this is external range, right? An old low. Where are the orders being paired up? With sell stops, right? So if they're long, they want to pair up their buys with sell stops, which is down here, right? So we have sell stops down here. Smart money is accumulating down here. Why are we accumulating down here? Because there are willing sellers trying to sell this position down here. So when they accumulated all these sell stops, they're good to go into bullish order flow, and also we're coming from an internal range on the monthly time frame, right? So from internal to external again, up into this high. Smart money sells to these buy stops over here, right? So order pairing happened down here. Willing sellers entering the market. They push price up and up and up until they can offload their long positions to willing sellers or willing buyers up here in above old highs and also above old highs over here. Now for them to offload their positions, their long positions or short positions, they need to engineer liquidity prior. So how does smart money engineer liquidity? They do this by retracements and failure swings. The retracements that form these engineered liquidity pools are opportunity for us to get into the marketplace. So think about those retracements and think about those failure swings. We have had a lesson about failure swings already. That's engineered liquidity, right? Low resistance liquidity. We're going to be looking for that as a target. So same chart again, British pound, Canadian dollar, daily chart. Smart money accumulates orders down here, long orders, pairing it up with willing sell stops. Where is the liquidity forming in this range? You can spot this failure swing up here, right? So this is engineered liquidity again. So they will engineer this liquidity to run it up later. They're retracing back down lower, right? So this retracement is an opportunity to get into the marketplace and aim for this external range liquidity. How do we get in? We wait for that sell stops to be accumulated for long orders for smart money. Then we have that external range liquidity over here with that failure swing, remember. Now where do we get in? We run up into that external range, but before we do that, we need to find internal range, which is over here. We've got this fair value gap on the daily time frame. So after that accumulation of sell stops, we can push price up higher. We'll wait for a displacement or a fair value gap, which is down here, right? And then this is the opportunity to get in long, taking out this external range liquidity. Now price action is accumulating over here. With this accumulation, we are highly unlikely to reverse, right? Because we already accumulated the sell stops for long orders. We already repriced into this imbalance, right? Taking out external range liquidity. Now what is price doing again? Over here. Creating a failure swing once again. So with this failure swing being formed, we've got a retracement lower, right? And there's another opportunity to get in. This big fair value gap up here, still being respected by the bodies. The bodies are important, right? The wicks do the damage, the bodies tell the story. So as long as these bodies are respecting this daily fair value gap, we are still good to go into external range liquidity. So we're going from external into internal, into external, back into internal, right? And once we reach internal range liquidity, we start to accumulate here again, going again for that external range liquidity. So this is engineered external range liquidity. Think about those failure swings again, right? This high fails to take out this low, drops once again into that internal range liquidity fair value gap and pushes up price to take out that engineered external range liquidity. Above here, more buy stops are present, so offloading their long position with buy stops over here is a perfect scenario for smart money. Over here we've got a British pound Canadian dollar weekly chart. Same chart as before with the monthly fair value gap. Now we've got that weekly PDA, right? Going to a daily structure over here. We can see this daily fair value gap. This is internal range liquidity. Now where do we pair up our orders and where is engineered liquidity? Can you spot engineered liquidity up here? Yes, we can, right? Because we have failure swings up here. So there's a lot of buy stops resting above here. Now order pairing, where do we want to pair our orders? Below old lows, right? Right, so we see this old low down here inside this PDA still, right? So order pairing, we can do that perfectly on this old low. Smart money buys from these sell stops. Again, we want to be buyers up below old lows. So over here we've got these accumulated sell stops for long positions for smart money. We can see all these failure swings up here. So this is also a perfect scenario to get into bullish order flow. After smart money accumulates these sell stops over here, we're good to go into bullish order flow, spotting out these failure swings up here. So all this engineered liquidity up here is a perfect target for smart money to reach into and pair up their long orders with these buy stops above here. Looking at the 1 hour chart, we can see it a little bit more clear. So trading that daily key level, right, below an old low, which is again over here, we can see a order block being formed below this old low, pushing our price higher and then engineering this liquidity, right? So what do we wait for? We wait for a retracement into discount levels, which is down here. So everything in the red is discount here, right? And above here we have this premium level. So we can see that this old low down here, right? Where does smart money pair their orders, right? With willing sellers. Their sell stops down here. They're accumulating their long position in this area over here because it's below this old low, right? We can see the 1 hour structure is pushing up, breaking structure over here. And then this retracement is what makes traders close their position early, right? Because they don't believe price will keep continuing up. So they will close their orders. But this is a perfect retracement into the mean threshold of this bullish order block, right? So after we move up from here, we can go into that engineered liquidity retracement. So this is perfect to engineer liquidity to keep continuing up longer, because we know where are the buy stops resting, right? We have all these failure swings up here. So there is a lot of buy stops up here. So once we hit this old low, smart money reversal happens over here. We displace up higher, taking out this first engineered liquidity retracement, and we can keep continuing up into these buy stops up here. Zooming in a little bit more on this little piece of price action over here. Again, what are we forming up here, right? Also all kinds of failure swings. Now, when we expand and then start to accumulate or consolidate over here, it's highly unlikely to reverse because there is no reversal from a consolidation. Now with these engineered buy stops over here, this failure swings up here, we can assume we want to push up higher, and keep in mind this is our target, right? These engineered highs up here. We can see a little stop hunt down here or a turtle soup on the 1 hour time frame. Perfect to go into this external range liquidity. Now how do we get in, right? We can see this low which took out the sell stops over here, creating a new dealing range, right? So if you take your discount and premium levels, we take this low, which rates liquidity, into this high, which took out these buy stops over here. And then look at these highs are relatively equal, right? So our eye should eventually or immediately go into these buy stops over here. Then price retraces back into discount, into this fair value gap over here, right? And this is another opportunity to get in long and be in line with smart money where they want to offload their orders above here, above market price. So over here we have Australian dollar, US dollar daily chart. Now we can see this old high over here has been rated. So buy stops have been liquidated. And this is where smart money accumulates their sell orders, right? So what do we do after we go from external? We go into internal, right? So where is our internal range liquidity? We've got this fair value gap here. But can you see something else? What are we seeing in this piece of price action over here? Because we want to look for an opportunity to get short, right? Because we know we should not go above this. So where do we get in? We want to be in a premium level, right? So we hit that internal range liquidity and we see this low and this low. What is this low and this low? We've got this failure swing once again. So this is engineered liquidity. The algorithm will continuously engineer liquidity to pair more orders up to continue lower. Now, where do we get in if we want to participate in this move down? We want to be in a premium level, right? So we need to dive in to a lower time frame so we can see more structure, because this is the daily chart, right? So we have a more clear picture if we go into a 1 hour chart. And in the 1 hour chart, we will see this retracement into premium as our opportunity. Right, it's a 4 hour chart on Australian dollar, US dollar. Again, these buy stops, right, on the daily time frame was rated over here. We're breaking down lower, 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 breaking structure down here, and then engineering liquidity on the sell side over here. Now, how do we get in? We want to be in a premium level, right? So if we take this high to this low, that's our dealing range, and then into this retracement lies our opportunity. We've got this 4 hour fair value gap, right? Draw out your premium and discount levels. That's very important. We take out this low into this high, then equilibrium or the middle of the range is over here. Again, pairing up our sell orders with buy stops, just like we did over here. We can do the same thing over here in this range, right? We have this buy stops, and then with this engineered liquidity still being present, so there's still a target present down here. We can wait for these buy stops to get run into, and then this is the perfect opportunity to go into a short. And if you, this is a 4 hour chart, and in this piece of price action on a 1 hour chart, we can very highly likely find a structure shift and a nice fair value gap into premium to continue down lower, taking out this engineered liquidity or a failure swing, and then eventually into these sell stops down here. So this is a 15-minute time frame. Remember the retracement into premium, right? And the buy stops earlier. This is all in a premium range. So above here, this retracement is breaking down lower, and eventually we are leaving fair value gaps behind. This is where the opportunities lie, right? We can see this breaker block over here is also in line with this fair value gap, making it even a higher probability fair value gap. So after the buy stops got rated, we wait for a break of structure, we wait for displacement, and then draw out your New York midnight open line, right? Where are we? Are we above New York open? Yes, we are. New York midnight open price, and then breaking down lower during New York session over here, and eventually continuing down lower and lower to pair up our sell with these engineered liquidity down here, and the sell stops resting below here. Higher time frame internal range to external range, or external range to internal range is lower time frame order pairing. So an example of this is in the next slide, is the high of a bullish fair value gap annotated by a previous monthly low is usually a structural low on the daily chart. So on a higher time frame monthly chart, price is moving from internal range, that fair value gap, remember, to external range, that was that swing high. However, on a daily chart, it's going to be below an old low, which is where smart money are accumulating long positions in what would be a turtle soup on a daily chart to distribute above those buy stops. So we've got this Australian dollar, US dollar weekly chart. Again, internal range liquidity. Where do we want to go? Once we hit that internal range liquidity, we want to go to external range liquidity, right? Where are the buy stops resting? We've got this engineered high over here. So after hitting that internal range liquidity down here, inside this fair value gap, we go again into external range, which are these buy stops above here. So this is a swing high too, right? So we have one lower, one higher, one lower, and then that gets their buy stops over here. Dropping into a daily chart over here, still having that fair value gap present from the higher time frame. We can see that swing low is being formed in a key level, also important to note. So where are the buy stops, and what can we see? We see this buy stops over here, right? This swing high. What do we have over here? Again, engineered liquidity, right? We have this failure swing over here, and again, displacement over here, an imbalance, internal range liquidity, and that's the opportunity to get in on more long orders. Smart money buys below this old low, right? So swing low down here. Smart money buys from these sell stops. And then we continue up into these buy stops over here. So over here we have a US dollar Swiss franc monthly chart, and this is going to be an example about the monthly external range to internal range liquidity. So we've got this low down here, right? This is external range liquidity on a monthly because this is a swing low. Where does smart money accumulate their long orders? Below old lows, right? So this external range, we can see this external range liquidity rate inside over here. So we have order pairing down here. So where should your eye go when you hit that external range? Again, internal range, right? We have this fair value gap over here. So after external range liquidity has been taken, we want to go to internal range over here. And eventually we fill up this whole fair value gap over here. Now how does that order pairing look like on a daily chart? Right, so we start off with that sell stops over here, that old low on the monthly chart. On the daily, we have a clean swing low formed down here below this low, and then we're breaking up structure again over here, breaking here, and then continuing down into discount over here, and then continuing up. So where do they sell their buy stops? They sell it above market price, right? So we have that monthly fair value gap fill over here. Buy stops are resting above this high. They push price up and then they offload their buy orders from these sell stops into this buy stops over here. Next topic we're going to cover is order blocks. Order blocks, what makes them high probability and what are the characteristics of them? First of all, order blocks need to form at a key level. So bullish order blocks with a short-term low liquidity pool above it, or a bearish order block with a short-term high liquidity pool below it. They push price into a liquidity pool, causing a purge on stops. So an up close candle that pushes price into buy stops when bearish, or a down close candle that pushes price into sell stops when bullish. We'll outline those in the charts coming up. So bullish order blocks in a buy program, they support price action to go higher into the drawn liquidity above market price, and vice versa with bearish order blocks in a sell program to support price lower or resistance to draw lower into the draw on liquidity below market price. When we are bullish, down close candles will act as roadblocks. When price moves down into them and support price higher, this is when it's validated. And for bearish, an up close candle will act as a roadblock too. So when price moves up into them and then resistance to turn down lower. Again, time frame alignments for order blocks. Same as all the other lessons, we have a monthly level into daily order blocks. We've got a weekly level into 4-hour order blocks, a daily level into 1-hour order blocks, a 4-hour level into 15-minute order blocks, and then eventually a 1-hour level into 5-minute order blocks. And all these different time frame alignments will be shown in the charts coming up next. So over here we have a USD CAD weekly chart, and again, keep in mind the previous lessons, right, with engineered liquidity and order pairing and external and internal range liquidity. We can see buy stops have been rated on this weekly chart on the USD Canadian dollar chart, right? Over here, buy stops have been rated. We want to turn down lower into an imbalance and going for that engineered liquidity. So what can we see over here? Buy stops rated, failure swing, right? Then we have this imbalance up here. So outlining those buy stops rate over here, this red box above here, right? Order pairing. Then think about the characteristics of a high probability order block, right? It rates liquidity and then breaks structure lower afterwards. So we have this order block over here, right? We take out buy stops and then price continues to break down lower, confirming this order block. So drawing out this weekly premium order block out in time over here. When we go to a 4-hour chart, and then we have some more structure to work with. Now take a look at this chart and see if you can spot another high probability order block only on a lower time frame. Right, think about the previous lessons again, right? Order pairing above these old high. So smart money accumulates sell orders to willing buyers, right? Then where is the liquidity? Where's the draw on liquidity? We have a failure swing down here, failure swing down here. So we have a draw on liquidity. We have a previous buy stop rate. Now what is a high probability order block in this piece of price action? If your eye went to this up close candle, that is correct, right? Because we take buy stops previously and breaking down structure afterwards. And remember, those order blocks need to form at a key level. And what is our higher time frame key level? We've got that weekly premium order block. Now spotting out this 4-hour premium high probability order block, right, as outlined earlier, this is where price action finds a roadblock, right? So price cannot continue up higher into this buy stops up here because we previously already rated it, then broke structure after, and think about the failure swing, engineered liquidity down here, right? So we retrace back into premium and then continue down lower. This is a classic high probability order block. Another example on Australian dollar, US dollar monthly chart. Again, external range liquidity, right? Monthly external range liquidity. So we rate these buy stops up here. So what do we do after external range? We go to internal range, right? We see this monthly fair value gap down here being the draw on liquidity. Dropping down into a daily chart right here. And remember that old high got rated, right? And we have our draw on liquidity. After external, we go to internal, which is below here. But before we reach this external range, look where price is being supported at, right? We have this down close candle taking out liquidity and supporting price action all the way up into that external range liquidity. Another one over here, right? Forming a swing low in a key level, which is this order block down here. Price moves up once again, taking out buy stops over here. Price hits an imbalance, so what does it do? It hits a key level, right? So forming an order block over here. It has to hit a key level to be a high probability order block. Price is being supported by this order block over here, continuing up and up and up. Rates external range liquidity once again over here, but it's just slightly, right? So it's not like a significant buy side rate. So it's more likely that it will run this high again, as it is not as a significant rate on liquidity as you want to see before price action breaks down. Now we see a retracement back into discount, and what are we using again? We're using this high probability order block over here. Price is dropping into this order block. Now it's coupled up with a fair value gap also. So this is a layered PD array, right? So we have an order block and a fair value gap coupled up with each other, making this even more high probability that this is a very good level to buy from. After that, price action pushes up into that external range liquidity, and eventually we drop lower and lower and lower. And remember, we've these lows down here, right? So this is for later liquidity, engineered liquidity. After we take external, we want to go to internal range, which is on the monthly time frame, right? So we use daily structure to go back down into that monthly internal range liquidity. What happens up here? Order pairing, right? Willing buyers, willing buy stops are being paired up with smart money sells, and again, pushing price lower and lower and lower. So here we have buy side of the curve, right? Price being supported, every order block is acting as a support, and we are still in bullish order flow until we reach that external level, right? This is a key level. Order pairing happens over here, right? Buy stops have been liquidated and smart money can accumulate their sell orders over here. So price pushes down, 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 breaking structure, right? And what does the form over here? We have a high probability bearish order block. Now, why is this high probability, right? We take out buy stops previously into a premium level, which is a fair value gap over here. But important, this high gets rated and then price breaks down after. So we have this high probability order block formed where price action can act as a resistance to continue down lower, because we already, remember, took out external range liquidity on the monthly time frame. So now we want to go into internal range liquidity down here as in this monthly fair value gap. Again, breaking down lower, another order block, price being tapped into here, moving down again, another bearish order block tapped in again. And remember, also a fair value gap, right? So it's paired up with a fair value gap, making it even higher probability. And price keeps going down and down and down. Now, let's talk about inducement order blocks, which is this over here, right? We have this rejection candle, right? Long wick on the top. So a bearish reversal candle. Now, why is this an inducement order block? Right? We've got buy stops over here, buy stops over here. So price seems to be pushing up and up and up, and it seems like we're in bullish order flow. But remember, this order block is high probability because we rated this high over here and we tapped into this fair value gap. Buy stops over here. We rate this high, inducement for more buyers. We rate this high, inducement for even more buyers. This 15-minute order block we know is high probability, so it will act as a resistance, and you can see price action taps into that order block and uses this as a resistance to continue down lower. Now, important, time is more important than price, right? You want to be in a specific kill zone for your high probability order blocks to function correctly. So London kill zone, New York kill zone, even London close kill zone are perfect times to engage into the market. And we can see over here with London close, we rate this buy stops and then continue down lower. As order flow is bearish, remember, and this is perfect inducement because we take out this high, pairing up buy stops once again into this order block and then continuing down lower inside the kill zone. So over here we have a USD CAD 1 hour chart. We're gonna spot that high probability order block once again, but take a look at this piece of price action, and why do you think this is a high probability order block? right? We've got this sell stop rate before this price action displaced up higher and leaving this bullish order block behind, right? We want to see sell stops rated for bullish order blocks to make it high probability. Price pushes up and up and up, hitting this fair value gap, filling it up completely. Then what is more perfect about this? What is even better about this piece of price action over here to make this order block even more high probability? We just talked about that inducement order block, right? Inducement, why is it inducement? Because we have a short-term low formed just before this level over here, right? So if you take this range low to this range high, buy side liquidity is above here. When you have a short-term low formed near the middle of the range and the order block has still not been touched, you can have a perfect turtle soup, so to say, because we're rating this low and then displacing up higher. So this is pairing up again, orders, right? It's order pairing. We have sell stops down here, price pushes down lower into it and then accumulates buys for it to push up higher. Again, time is very important. So London kill zone over here, right? Couple up your entries with the correct time. We can use again London kill zone, New York kill zone, London close kill zone. And if you're aiming for low of the day, London kill zone most of the time is your best bet. And if you see that 1 hour order block created the previous day and you see engineered liquidity over here, right? These lows, fill your swing down here. You can expect, if order flow is still bullish, of course, they drop into this high probability order block, taking out those sell stops, and you can couple up your buy with someone else's sell stops, making it higher probability. The correct time, right? London kill zone, pushing up and up and up, creating low of the day. Alright, so over here we've got a gold weekly chart. Now, what is more obvious than these buy stops over here, right? Relative equal highs up here, low resistance liquidity, and look at this piece of price action, right? We're moving up and up and up. We can see down close candles supporting price action. And look at this range, right? This low to this high is our current dealing range in this piece of price action. Now, if we go further, what happened prior to this move up, right? Sell stops down here, relative equal lows. And what happens over here? Order pairing again, right? External range liquidity. We have these sell stops again paired up with the long positions from smart money. Price displaces up higher and higher and higher, breaking structure up here. And what happens when you break up structure and you take liquidity before it breaks up structure? You form a breaker block, right? And breaker is also a form of an order block. So we can see that over here, moving it out to the right in time, right? Price keeps pushing up and up and up, engineering some buy side liquidity. The retracement happening back into that weekly breaker. Now, if we go to a 4 hour or a daily chart, we can see a key level form inside this breaker. Right, so we got a 4 hour chart. It's pretty naked right now, but we're going to annotate a little bit more once we go on. Engineered buy side liquidity to the left of here, right? Price breaks down. This is the retracement on that weekly candle. So we can see the weekly breaker down here. Now, where is the high probability order block over here? Right, if you guess this little piece of price action is a sell stop rate and then break of structure upwards, you are very correct and you're on the right way to reading this piece of price action. Over here, sell stop rate, right? Order pairing, once again, inside a key level, very important. We need to see that key level hit where the smart money reversal happens. We break up, break of structure up here, right? Now we have a new dealing range. So from this high down into this low, we have the equilibrium line over here. So this should be the high probability order block, right? And why is high probability? Again, sell stops have been rated inside a key level and also fair value gap and discount of this whole range over here. Right, outlining that order block over here with the box, this gray box. We have the engineered liquidity up here. As I draw on liquidity, we've got inducement, right? Because we're taking out short-term lows down here. So sell stops have been taken out back into that order block, and then price action is ready to go into bullish order flow, because on a higher time frame, remember, we want to go for those equal highs, right? Continuing up into price action, there are more opportunities to get in, right? You didn't miss the move if you didn't get in on this lower end part here in the discount, but obviously you caught the low of this whole range if you did, but there are multiple occasions where you can get in. So again, price action pushes up here, right? You see this sell stop rate. What is this sell stop rate? It's a high resistance liquidity run, which we covered in the previous lessons, right? So this is what you want to see when you are bullish and you want to see that engineered liquidity above market price, which is over here, right? We have these failure swings up here. So there's buy side liquidity, right? High resistance liquidity run. And then in the process of that high resistance liquidity run, we're forming a high probability order block. This order block offers support for price action to come back down into discount, again forming another order block, and price keeps pushing down into that order block to continue up higher until we reach that buy side liquidity, right? If after buy side liquidity has been taken, we have to be careful not to pick any down close candle, because those are not order blocks anymore. We need to have a drawn liquidity higher, right? We've got a British pound US dollar 1 hour chart. This is the last of the time frame alignments for the order blocks, right? We're using a 1 hour chart and dropping into a 5-minute time frame to see how the order blocks continue to support or resist price action to our drawn liquidity. So over here, if we have this whole piece of price action, we can see these buy stops have been rated up here, right, into a level up here. We're continuing lower, leaving a fair value gap behind. So this is our key level over here, right? We have this 1 hour fair value gap. And now intraday, we need to frame our order blocks on the 5-minute chart. Drawn liquidity being on the sell side, dropping into that 5-minute time frame, right? Again, think about external to internal range liquidity and order pairing, right? So we take out these buy stops up here, and then we rate it here with an order pairing into that 1 hour fair value gap. After this buy stop rate, we form what? A high probability order block, right? On the 5-minute, we're breaking down structure over here. Structure shift is here. Order block is resisting price action, keeps coming down and down and down. We have another up close candle resisting price action, moving down and down and down again. Now, importantly, we have another engineered liquidity up here, right? Relative equal highs. We see price action rates that again for what? External range, order pairing, right? Price break structure again. You see that displacement indicating it's still bearish. Did we hit that drawn liquidity yet? No, we did not, because it's down here, right? So price action keeps declining. We have this order block after that order pairing over here. Price resists this order block, which is perfect, coming down again, leaving this relative equal lows, right? Breaking down, leaving another order block over here, and then continuing price down. And price keeps doing this. It keeps continuing to engineer liquidity to pair up orders. Again over here, relative equal highs, right? Buy stops being paired up over here, and with this order pairing, it's good to go, as we had not hit that drawn liquidity yet down here. Next up, we're going to be talking about IPDA market cycles. So what does IPDA stand for? So IPDA stands for Interbank Price Delivery Algorithm. This is the algorithm which makes the market move a certain way. And this algorithm has certain cycles. So over here we have this price delivery depiction. We're starting with retracement, we've got reversal, consolidation, and expansion. Price only has 4 stages, and it's always doing one of these. There's nothing else it does. So we have that consolidation, that expansion, retracement, and reversal. Now we're gonna depict what it can do, and also importantly what it cannot do, so you can anticipate in which cycle it is, and if you know what it shouldn't do, then you have a higher probability of framing your trade setup. So over here, firstly, price always goes from a consolidation to an expansion next. Price can go from an expansion into a retracement. Price can also go from an expansion into a reversal, and price can also go from an expansion into a consolidation. Now, what price never does is go from a consolidation into a reversal, and we'll outline in the charts later how that looks like. And price can never go from a consolidation into a retracement. When price looks like it's delivering a consolidation to reversal, it's a trap, and you will be followed by an AMD reversal pattern. So if you're not familiar with AMD, it stands for accumulation, manipulation, and distribution. So you can already see in the name AMD, we've got that manipulation. So think about what we just said, right? You cannot go from a consolidation into a reversal, because consolidation is accumulation, right? The A in AMD, but we cannot go into a reversal from a consolidation. But if we do trade, let's say we are bullish and we have a consolidation and price starts to go lower, reversing from that consolidation, which it cannot do, it's a manipulation, right? For us to continue higher later, which will be the distribution phase, and we will outline those in the charts coming up. Once price has gone from consolidation to expansion, there's only two things that can happen from the expansion. It's from expansion to reversal, which could be an AMD reversal pattern, which I just outlined, and we have expansion into retracement, which could be a return to an order block or a fair value gap to continue up. So how does that look like, right? What do we see over here? We've got an old low down here, right? External range liquidity. So what do we want to do once we hit external range liquidity? We want to go to internal range liquidity, right? So we have a draw liquidity up higher. So if we look at this consolidation, can we reverse from this? We have a break of structure over here, but no, we are not reversing from this. Why? Because we have this consolidation and we're still in bearish order flow, right? Yes, we did take out this low, but look at how these lows are formed, right? We have this equal lows. So what's more likely to happen is that price engineers liquidity up here, right? In relative equal highs. But in the process, it does break structure over here, right? But it's a trap because we still have that consolidation. So it shouldn't reverse from here. Now we have one more rate lower and then expansion up higher. So this is a classic AMD schematic, right? Accumulation down here, right? Then a manipulation phase upwards, which it shouldn't do. So that's why it's called manipulation. Then distributing lower and then eventually following the true market direction after rating those sell stops. And here we can see with a depiction of that accumulation phase, right? The manipulation phase below sell stops, right? Order pairing, again, external range liquidity, then distributing up higher. In the process, highly likely to leave a fair value gap behind or an order block, and then we can distribute higher from that point on out. Continuation patterns. Only two things can happen here after it starts consolidating. Continuation expansion from the consolidation or an AMD bullish or bearish. For price to reverse, it has to go higher first. Right over here, we had this AMD down here, right? Accumulation, manipulation, and then distribution up higher. Now we're in bullish order flow, right? Draw on liquidity up in this fair value gap up here, right? Sell stops have been paired up with buy orders from smart money. So we know we shouldn't go down here anymore. So we are in bullish order flow. So we have expansion into consolidation. So what does price action never do after consolidation? It never reverses, right? So if we were to move down lower than this accumulation over here or this consolidation, we can expect that to be a fake move. So it should move like this, right? But if it does move a little bit lower, we can see an AMD model form, right? And then it should look something like this. Again, red as in the manipulation phase, right? We should not reverse from this consolidation. Keep that in mind. If you are in bullish order flow and you see a consolidation and we have not, importantly, not hit a target yet, a buy side target or internal or external range, we can expect that to be a manipulation phase, which we can see over down here. Now expanding up higher into a distribution phase, you can see this probably will become a breaker block. If there's a fair value gap coupled up with that breaker block, makes it even higher probability to distribute up higher. So until we hit that internal range liquidity. Now over here we have the same pattern but reversed, right? We don't necessarily have to hit this target. We can also reject over here and not reach this target. We're not always 100% going into internal, external. There might be a different level here which it's keying off of. So here we can see also accumulation, and then we have a manipulation up higher and then distribution down lower. So this is an expansion into this is a consolidation into expansion and then a reversal, right? And then retracement into expansion. Now, how does that look like on a candlestick chart, right? Euro, British pound, daily chart. Again, think about the previous lessons, right? Failure swings, order pairing, external range and internal range, right? What can we see over here? Again, buy stops have been rated, order pairing happening above marketplace here. What are we having here? A failure swing, right? So we have a draw on liquidity. We have a break of structure. Look at all these failure swings down here, right? Failing to take out these lows, so we have a draw on liquidity down lower. We fill up this daily fair value gap. Sell stops into external range liquidity. And dropping down into a lower time frame chart, which makes it easier to see what we're doing, right? We have our higher time frame target. We know buy stops have been rated and orders have been paired for sells. Now we're going into a lower time frame chart to see how that looks like, right? We have a high resistance liquidity run up here, order pairing once again, and then breaking down structure lower. And remember, it's of a key level, right? Key levels, it has to hit a key level. Now breaking down lower and we start to accumulate or consolidate. So price can not reverse from a consolidation, right? So if it were to do a fake move up, it is manipulation and we should still continue down lower because this is the draw on liquidity, right? So it could either do this or it could do this, right? So back up into this one, right? This would be an AMD and then that would be a accumulation, manipulation, distribution phase. Also consolidation into expansion reversal because it cannot reverse from a consolidation, and this would be a consolidation into expansion again, distributing lower, right? So as explained earlier, expansion into consolidation, only two things can happen now: continuation from a consolidation into a retracement back into what, maybe a order block or a fair value gap, as the draw on liquidity has not been reached yet, so it has to do a expansion into a retracement to continue down lower into those sell stops, right? We have all these targets down here, all these sell stops are still present. These relative equal highs or relative equal lows rather are still present. This is a very nice draw on liquidity, and we know this consolidation cannot reverse, right? So price breaks down lower, goes back into a retracement, so that market cycle is correct, right? Consolidation, expansion, retracement, expansion, right? We're hitting this order block, perfect area in premium, right? Also always draw out your discount and premium levels. So this is the dealing range over here, retracement into premium, into that order block, and then finally we hit those sell stops. So over here we have a USD Canadian dollar 4-hour chart. Sell side of the curve down here. We got a reversal down here and then into buy side of the curve. Now what is the draw on liquidity, right? After we reverse down here, we have this fair value gap. So we go from external, right? This lows has been rated. Then we go into internal. We can see this reversal happening down here, taking out this relative equal lows, and then think about the order blocks, right? External, internal range liquidity, and price respecting bullish arrays, making this buy side of the curve. Now, draw on liquidity, remember, is up in here, and now we're going to look at where the market cycles come into play. So we can see expansion into reversal, right? Then what happens over here? We have a small consolidation. We expand up higher, then we retrace back into the range, right? And then we have this order block right over here, which we talked about in the previous lesson. We're taking out these lows down here with this candle, breaking up structure. So this should support price action to continue up higher. And the market cycles also tell. Right, we have this fair value gap, retracement back into, and we have another expansion leg. So where do we consolidate again? We have this piece of price action over here, consolidating, right? We cannot reverse from a consolidation. So what do we need to do? Expansion, right? It's that simple. Think about those market cycles every time you look at the charts. With these tools already, you have that internal range, external range, right? You've got that order pairing, engineered liquidity, and now with the market cycles, you even have a more clear vision of what needs to happen and where price needs to draw into. So this consolidation, we have an expansion afterwards. What happens after this expansion? We have another consolidation. So do we need to go down from here? We did rate this high, right? But no, we are in a consolidation market cycle, right? So we don't reverse from a consolidation. So we keep on pushing up and expanding higher until we reach that draw on liquidity, right? And eventually we hit it over here. We hit that draw on liquidity, right? But what does price action start to do? It starts to consolidate again, right? So what can't we do once we consolidate? We cannot reverse, right? So we see this move down. You're asking yourself, reversal, right? No, it cannot happen because the market cycles tell us we go from consolidation into expansion, not from a consolidation into a reversal, right? So this move down, again, AMD model, right? Think about that manipulation phase. So we need to trade lower before, we need to trade higher before we can trade lower because we cannot reverse from this consolidation. Manipulation phase happens up here. Again, order pairing, right, above old highs, continuing down lower, breaking structure, and then we get that same expansion leg lower. And then what happens again? After we have an expansion into a reversal, and then we start to accumulate or consolidate. So what cannot happen from here? We cannot reverse up, right? Because we're going into bearish order flow after rating buy stops. We have thus that order pairing up here, right? Breaking structure lower, and the current market cycle is expansion higher into a reversal, going into, if you reverse, you're going into a different order flow. So we're going into bearish order flow. Now we're starting to accumulate or consolidate once again, right? So we cannot reverse from this consolidation. We see price does go up. So you should immediately ask yourself, why are we going up after this consolidation, right? It's highly likely it is manipulation, right? So we're going into this fair value gap order block combination. This is a high probability order block, right? Then price continues down lower, expanding. This move up can be a reversal, right? And here we can see the schematic of the AMD, right? I just explained it, and with a little bit more annotations, we can clearly see the accumulation phase into the manipulation phase, and then distribution lower, right? Order pairing happened up here already, so we know we cannot go higher than here, and we broke structure lower. It's time to talk about breakaway gaps and balanced price ranges, and we'll be including a new PD array. Breakaway gaps and the redelivered rebalanced PD array. So most of you probably haven't heard about the RDRB or redelivered rebalanced PD array, and we're going to include that in this lesson. And this will be also very nice to include into your arsenal to identify certain breakaway gaps. So a bullish balanced price range by definition is a portion of price action that has delivered buy side, sell side, and then buy side once again. So in simplicity, up, down, and then up again. Inversely, a bearish balanced price range by definition is a portion of price action that has delivered sell side, buy side, and then sell side again. So in simplicity, down, up, and then down again. Now we've got this nice depiction of how it looks like with candlesticks, right? So we have this first candle going up, and really look at what it does, right? So it offers buy side, right? Making that wick up. And at this point, when it's up here, it's a full bodied candle, right? But then offers sell side again, going all the way down and then closing here. So what happened inside this wick, it offers buy side and sell side, right? So with the next candle open, it offers buy side once again. So again, think about that simplicity, right? It's up, down, and then next candle up again. So this piece of price action over here has been fully balanced, right? And then if this occurs and price action starts to trade back into this range again, it's already a balanced price range, right? So if there's a bullish fair value gap below us, this can remain open. Same for a bearish fair value, bearish rebalance, redelivered price area, right? This is a bearish candle, right? So what does it do first? It offers sell side, right? Full bodied candle over here, but then goes back up all the way again. So what does it do when it goes back up again? It offers buy side, right? And then with the next candle, we've got this sell side offered once again. So again, think about that simplicity, right? Down, up, and then once again, down again. So this area of price action has been balanced. So this fair value gap will stay open because there's a balanced price range below it, the redelivered rebalanced PD array, right? So now we can, with higher probability, determine if certain fair value gaps stay open or not. You can draw out lines in this balanced price range, so this BPR for short, right? And then this looks like a fair value gap, right? But we know this is a BPR and it will be highly likely price can reject from this area. Same with the sell side, right? Take a line from the opening again. Same with the sell side, right? Take a line from this closing price of this candle and then the wick of the last candle, and then you got this redelivered rebalance PD array. Now, how does that look like with a price action chart? We've got the US dollar index 4-hour chart over here, right? And then think about this. There is a fair value gap here, but it is a breakaway gap. Now, why is it a breakaway gap? We just learned about this new PD array, right? The redelivered rebalanced PD array. So again, this candle delivers buy side, right? Up, then down again, and then the next candle once again up. So we have up, down, up. Balanced price range over here. So if there's a balanced price range over here, this gap doesn't need to get repriced into, right? Because there is a balanced price range above it already. So price can reject, go into there and reject and continue its way up. And we can use this little schematic over here, right? Which we covered in the previous slides, right? Again, up, down, and the next candle up, forming that balanced price range. And again, you can see that over here, up, down, and then up again, using this as a new PD array, the redelivered rebalanced PD array. We've got a USD Canadian dollar chart over here. This is actually very nice, right? We have multiple gaps over here. We have a breakaway gap here, a breakaway gap here. So why is it a breakaway gap? Again, right? We have this candle here, delivering sell side, buy side, and then the next candle trades through it, delivering sell side once again. Over here, draw out two lines, closing price of this candle and the low or high of this candle, right? We have this redelivered rebalanced PD array. Price action trades up into it, but not into the breakaway gap, right? Because it doesn't have to be delivered in here anymore. The balanced price range is over here, so price has no business going higher if we are bearish. Really study this depiction over here, this little schematic, down, up, and down, and for bullish, up, down, and up, right? We can see it over here. We can also use this as a PD array on its own, so it doesn't need to have a fair value gap above or below it to be used. This PD array is defined as a redelivered rebalanced, so we use RD, RB on our charts. We've got a Australian dollar, US dollar 4-hour chart, and now take a look at this piece of price action, and can you spot that redelivered rebalanced PD array? focus in on this little piece of price action over here, right? Where the eye is. We've got this candle up, down, and then the next candle up, right? Balance price range over here. So we have this area over here which is balanced, so we don't need to trade in this 4-hour fair value gap anymore, right? You can draw out the lines from the opening price of this candle into the lower wick from this candle, and then we have this redelivered, rebalanced PD array, and in this case it's obviously a discount array because we are going into premium levels. Again, with the USD CAD chart, 1-hour chart, look at this gap up here, right? Breakaway gap. Now again, focus on this piece of price action here, right? Down, up, and then the next candle down again. So balanced price range. You see price action taps into that area multiple times but does not go into that breakaway gap. We know balanced price ranges are a very strong resistance or support area, and then we draw lower and lower and lower. And this is not random, right? We have another breakaway gap and we see the same thing happening over here, right? Big wick down here, delivering sell side, delivering buy side, and the next candle delivering sell side once again, closing, and the next candle has a balanced price range before it, right? Over here, next candle, next 1-hour candle drops, trades up into that redelivered, rebalanced PD array, and then continues down lower. Euro, British pound, 5-minute chart, right? Hitting a higher time frame array, right? Key level, starts to break down lower, displaces, and now why are we not returning back into this fair value gap? Because I think this is in premium, right? But remember, we have this new array, this new PD array, right? We've got this redelivered, rebalance again, down, up, and then the next candle down, leaving this portion of price action balanced. So this balanced price range should act as a resistance, leaving this breakaway gap, right? So now we can identify breakaway gaps, which is very good, right? Because sometimes we miss trades because we think it should go into a premium level in this fair value gap, but we're wondering why is this not hitting, right? And then we have our limit order in here and price moves away, and that's just a shame. But now we know balanced price ranges are the reason why some fair value gaps stay open and become a breakaway gap. We've got an example from Twitter. We've got a New Zealand dollar, US dollar chart, right? Why are we taking a buy from here and not from the fair value gap here, right? How are we trading this range? And we'll outline that in the next chart. First of all, we've got this high resistance liquidity run down here. Sell stops have been taken. Again, think about external range, right? Sell stops being order paired over here for longs on smart money reversal. Now, where do we spot this PD array? Failure swings up here. Where is that redelivered, rebalanced, right? Up, down, next candle, up, right? So we've got a balanced price range down here, and we can outline that on a 1-hour chart too. Right, so we have this gap here. Why are we not trading inside this gap? Or even inside this 1-hour gap, right? This should be a nice area where we can retrace into. What is happening over here, right? Up, down, and then once again up. So we have a balanced price range here, and you can see the wick comes into this BPR over here in this redelivered, rebalanced PD array. Put your eye on here. Outline those with the redelivered, rebalanced lines, which with the closing price of this bullish candle and the low of this wick from this candle, and then we have this array leaving all these breakaway gaps. Why is it a breakaway gap? Again, it's a balanced price range right over here, so price has no business going down here anymore. Let's use this little depiction over here, right, so we can see it more clearly. Again, I keep repeating this, but this is very important, right? We need to see an up move, then a down move, and the next candle needs to go up again, right? Up, down, and up. So we see that happening over here as outlined earlier, making it a balanced price range. Right, we've got a gold monthly chart over here. This is an example of a price move without a fair value gap. Right, there's no fair value gap down here, but this whole move happened from this area over here, right? And why is that? Because we had that redelivered, rebalanced PDRA down here, right? Up, down, and then the next candle up again. So we have this high probability redelivered, rebalanced discount array. And this actually was the catalyst to go to this highs up here on gold. Another example, remember back for the Twitter example, right? The Twitter example we showed earlier on the daily chart. Did you see it? We can outline it right now. Again, high resistance liquidity run, right? Sell stops have been taken. Order pairing, again, smart money longs. But there's no fair value gap to take a trade from here. So why are we entering with this wick down here, right? Again, up, down, and the next one up. Leaving that redelivered, rebalanced PD array and outlining it with annotations. We can see price dips just slightly inside here and then continues its path up. Think about drawn liquidity, right guys? We have this failure swings into external range liquidity and eventually we hit that target. Now obviously there are times when this will fail like every other PD array, but for the most part this will have a lot of success in framing a trade and or identifying breakaway gaps. So we've reached the final lesson of core concepts, which is DXY consolidations. DXY consolidations, when to trade those exotic pairs and how to do relative strength analysis. When the dollar index consolidates, smart money will allow the crosses to move, and when this happens we look at those individual currency futures charts and we can compare the following: strong versus a weak currency, strong versus a consolidating currency, and a weak versus a consolidating currency. Now, when is it most likely that the dollar index will consolidate? When it is at equilibrium of a higher time frame range, when we have high impact news late in the week and none early in the week, pre-major high impact US news events such as NFP, CPI or FOMC, in London session when the Asian session was extremely large, and then in New York session when London session was extremely large. Now that we know when the dollar is likely to consolidate, we can start looking for signatures in price to tip its hand to us that consolidation is about to occur. Now credit to Braveheart for this candlestick understanding. So how to anticipate consolidations with inside ranges. This is fractal and can be applied to all time frames. So over here we've got our first candlestick, right? We've got a open, high, low, close. Over here, next candle is an inside bar, right? So on this one we don't take out previous daily high, nor do we take out previous daily low, right? So our first candle now becomes our inside range high and inside range low, and that looks something like this. The next candle needs to take out either the high or the low of the inside range candle. If it does not, then we can anticipate a longer term consolidation. So now this third candle fails to take out that inside range high or low, and then we can expect a extended consolidation to occur. Now an example on a candlestick chart, we've got that US dollar index over here, daily chart. Over here we've got our first candle, right, closing inside the previous candle. So now we've got a inside range high and inside range low formed, which looks something like this, right? Next candle needs to take out the inside range high or low, and failure to do so will result in an extended consolidation. Over here we can see that third candle failed to take out the inside range high or that inside range low, and now we can expect a extended consolidation and we can look for those exotic pairs. And over here you see how long it consolidates, right? We're still staying inside that inside range high or inside range low. if DXY is consolidating on the daily chart, we need a daily drawn liquidity or directional bias for the individual currencies. However, if DXY is consolidating on an hourly chart, for example, for an intraday play, then we only need to look at the intraday 1 hour drawn liquidity for those individual currencies. So DXY consolidating, then we analyze individual currency futures chart, and then we compare one of the 3 options we covered in those previous slides. So over here we can anticipate that extended consolidation, right? Because we got Monday's high is that inside range high, and then Monday's low is that inside range low. The third candle fails to take out that range, and we can see it extends into Thursday and Friday consolidating. And how does that look like on a 1 hour chart? Well, it's one big consolidation. So now we see DXY is consolidating. Now we need to look at the individual currency futures charts and match those 2 currencies with one of the following of 3 criteria. Now again, to remind you, the options are strong versus a weak currency, strong versus a consolidating currency, and then a weak versus a consolidating currency. And alternatively, when DXY consolidates, we can also trade Euro GBP, right? Because it's a cross which moves when DXY is consolidating. So over here we got a Canadian dollar futures chart. Over here starts that consolidation, right, on DXY, and we're going to focus on that Thursday and Friday price action. We are in premium of the range. We are forming a daily bearish order block over here, and we can see Thursday and Friday is reacting of that bearish order block, and we're continuing down into discount, which is the draw on liquidity. Zooming in on that 1 hour chart, right, that intraday chart, and we know after Wednesday that inside range is still holding on the DXY. We can expect Thursday and Friday to be good movers for those exotic crosses. So we see that Canadian dollar futures chart over here. We are in bearish order flow. We have sell side liquidity down here in discount, our drawn liquidity, and we're going to be focusing on Thursday and Friday for this one. So we know Canadian dollar futures is bearish. Now that we identified a bearish currency in this case, which is the Canadian dollar, we need to match this with a bullish currency or a consolidating currency. So over here we've got a Euro futures chart, right? The daily chart. We can see it's consolidating right now on Thursday and Friday as well. So we're going to match up that bearish currency, which is the Canadian dollar, with a consolidating currency, in this case the Euro. Over here we've got the 1 hour chart, and we can clearly see this is a consolidating currency. So DXY is consolidating. Now we've got our exotic pair protocol. Pair up a bullish currency with a bearish currency or a consolidating currency, and pair up a bearish currency with a bullish currency or a consolidating currency. Now we're trying to find the cross, right? So we had that Canadian dollar chart which was bearish, right? And then we had that Euro chart which was consolidating. Now we've got Euro against the Canadian dollar paired up as our cross, and Euro is consolidating, so it's moderately to extremely bullish in this case, Euro Canadian dollar. So over here we got that Euro Canadian dollar daily chart, right? We found out our exotic pair protocol, and we're gonna go with this pair. And over here we're sitting in discount. Over here we got this daily bullish order block, and the mean threshold of that daily bullish order block is being held. We are in discount, so it's likely that we're gonna draw into premium. And think about the draw on liquidity, right? It's above here with those buy stops. And on what day do we want to focus our attention? We know after Wednesday that DXY was in an extended consolidation. So Thursday and Friday is highly likely to be a good mover for those exotic pairs. So Monday, Tuesday, Wednesday, right? So again, we also got a swing low formed here, right, on that key level. Think about that previous lesson about daily swing highs and lows, right? We're forming it at a key level. And then we're going to focus on day number 4, right, and day number 5, which is Thursday over here, running those previous daily highs. So over here we've got the 1 hour chart for Euro Canadian dollar. We know our draw on liquidity is on the buy side, and we're going to focus on Thursday and Friday again, right, because we know after Wednesday DXY is consolidating, and we're going to focus our attention on finding a buy setup for Euro Canadian dollar. Now without the annotations, we can see this chart going into bullish order flow, but with annotations we can find our setup. right? With our understanding of the open high low close and open low high close of the daily candle, right? That power of 3, we want to be a buyer below midnight opening price. We can actually see this bullish order block formed over here is being held and price drops below that midnight opening price to accumulate those long orders and then continue to push up into our draw on liquidity. And even on Friday we can focus on this again. We drop down a little bit, forming a high resistance liquidity run down here, right? We take out this candle's low over here, so we have that on our side of structure. Then a bullish order block is being formed, and we can see those down close candles are supporting price to go up higher and eventually into our draw on liquidity. So now how do we make sure we have the strongest or the weakest currency? We can compare closely correlated pairs against each other, such as the euro against the pound, right? The euro GBP, or Australian dollar versus the New Zealand dollar, which is AUD NZD. If we know EuroCAD is likely to be bullish from our analysis of the individual futures contracts, we can then compare Euro GBP to compare which is stronger between the euro and the pound, and then we have the pick of the absolute best pair to trade. So if Euro GBP is bullish, then the euro is stronger than the pound, and then in the next slides we will see that Euro GBP was indeed bullish, so EuroCAD is better longs than GBP CAD. As mentioned as option number 2 for the exotic pair protocol, when DXY is or is likely to consolidate, we can trade Euro GBP on its own, as there will now be volatility in the crosses and clean price action moves. So when money leaves one market, it goes into another market. So over here we've got a Euro British Pound daily chart, right? So we're going from internal range to external range, right? So we've got that daily fair value gap over here in discount. We've got our premium levels up here, and then that external range liquidity buy stops. Now we know, because of that inside range on DXY, right, that Monday's candle has not been violated by Tuesday and Wednesday, we expect DXY to consolidate further into the week. So we're going to be focusing again on that Thursday and Friday's candle for Euro GBP. So over here we're going into a intraday chart. We've got a 1 hour chart for Euro British Pound. We've got a market maker buy model. We've got our original consolidation up here, right? We've got sell side of the curve until we hit that key level right over here, that discount fair value gap on the daily chart. Now with DXY consolidating early in the week and extending further in the week, we can focus on Thursday and Friday's candle expansion up higher into those external range liquidity buy stops. So how does that look like? We outline our New York midnight opening price line as always, right? We want to be a buyer below this line and a seller above it. And in this occasion, we're going to look for buy stop. So we want to be a buyer below that. Is there any PDRA supporting our idea for this buy? Yes, we've got this bullish order block over here, right? The mean threshold of this bullish order block over here is supporting price up higher, right? And we're continuing our path into buy stops. So over here, again, New York midnight price line, right? We drop below, hitting that discount array, and then we can focus on buys even on Friday. Over here, we've got that order block formed at the middle of the day, right? Around end of New York session. Price is still being supported because we're on buy side of the curve, right? We want to see those down close candles support price action into higher prices, which happens over here. And then again on the next day, Friday, we have this bullish order block formed over here, and you can see price action is moving away from it, and eventually we clear out those external range liquidity buy stops. Now that we've finished all the core concepts, it's time to move on to the next section, which is the market maker models, and we'll start off with time frame alignment. Time frame alignment for market maker models, and what do they look like? One of the keys to finding clean market maker models is understanding the time frames they form on in relation to the time frame of the PDRA. So time frames are directly linked to each other, and if you stick to the rules I give you today, you have a lot more success in identifying them. So as always, time frame alignment for market maker models. We're going from a monthly PDRA into a daily market maker model. We go from a weekly PD array into a 4-hour market maker model, a daily PD array into a 1-hour market maker model, a 4-hour PD array into a 15-minute market maker model, then we have a 1-hour PD array into the 5-minute, and then eventually 15-minute PD array into a 1-minute market maker model. Now, from monthly all the way down to the 15-minute, you can already see these are different types of personalities, right? We have the swing traders over here with the higher time frame, and then the hyper scalpers on the M15 and the 1-minute market maker models. So price is fractal. It just depends on how long are you willing to hold the trade. We've got this nice schematic over here, right? Higher time frame, we got that monthly level. We've got a weekly level or a daily level. Pick one, right? Which is most preferred for you. Scalpers most of the time want to have a daily level, right? 1-hour structure and PD arrays on the market maker model. Go to the 5-minute buy or sell program and market maker model entries. So same for a higher time frame on the monthly, right? We look at the daily structure, PD arrays for the market maker model, and then on the 1-hour a buy or a sell program with market maker model entries. Time frame alignment for market maker models. So in a market maker buy model, there is almost always at least 2 stages of accumulation on the sell side of the curve, and in a market maker sell model, there's almost always at least 2 stages of accumulation on the buy side of the curve. The curve is defined by the lowest low in a market maker buy model and the highest high in a market maker sell model. So we've got this schematic for a market maker buy model over here. A market maker model always starts off with a original consolidation. So this is easily depicted by obviously a consolidation, then price expanding lower into another accumulation phase, right? So accumulation phase number 1. Think about market cycles too, right? Consolidation, expansion, consolidation, expansion, another accumulation phase, and then we hit that discount array, and there is the moment where we can anticipate a smart money reversal. Not earlier, we need to hit a key level. If you want to see a market maker buy model, we need to hit a discount array. So we've got this sell side of the curve over here, having our highest high up here and our lowest low down here. And then once we break structure upwards, after hitting that key level, right, we can go into buy side of the curve. Now same for a market maker sell model. Think about the original consolidation which needs to be present in a market maker model. We've got this consolidation down here, expansion again, right? Accumulation phase number 1, another expansion, accumulation phase number 2, another expansion, and then we need to hit a key level inside this premium array, right? And then we have this highest high, confirming sell side of the curve after we break structure and hitting that key level. And then we can start to look for sell opportunities and then completing this market maker sell model, liquidating this original consolidation. All right, so we've got a Australian US dollar monthly chart. And again, keep thinking about the core concepts, right? External to internal range with order pairing. So we've hit that external range liquidity. So what is the draw on liquidity afterwards? We want to go to an internal range, right? So external to internal. What does that look like on a daily time frame, right? Think about the time frame alignments. Can't stress this enough. If we look at the monthly chart, we look at the daily structure. If we look at the weekly chart, we look at the 4-hour structure, etc., right? So on a daily time frame, we can see this original consolidation starting down here. Sell stops below it, obviously, right? Market expands higher, forming accumulation phase number 1, expanding higher again, accumulation phase number 2, and then eventually we keep going until we hit that premium level, right? So over here, that monthly external range liquidity, right? Now we've taken external range liquidity, and what happened up above this old high? Order pairing, right? For smart money shorts. So smart money pushes price down. We've got this break of structure down here, right? Then respecting this fair value gap and accumulation phase number 1 over here on the sell side of the curve is happening. So we can anticipate lower prices and continuation into sell side of the curve, completing this market maker sell model until we reach that drawn liquidity, which is the monthly internal range liquidity fair value gap. Now on a weekly chart, New Zealand dollar versus the US dollar, again, we've got this time internal range into external range, right? So once we hit that internal range, we want to go and seek external range liquidity. That happens over here from this range high premium levels, right? So this fair value gap internal range makes sense to be a good point where we can reverse from, and then external range liquidity on the low side of this range. Now from a weekly, remember we go to a 4-hour structure. So earlier we had a monthly chart into a daily structure. Now we're going into from a weekly key level into a 4-hour structure. So we're starting off again, original consolidation, right? Sell stops resting below there, external range liquidity, accumulation phase number 1, accumulation phase number 2, expanding up higher into that internal range on a weekly time frame, right? And then over here we break structure lower. Does it make sense that we break lower from here? Yes. Why? Because we hit that internal range liquidity fair value gap on a weekly time frame, right? So now we're going into sell side of the curve, and you can see every premium array is being respected, right? We've got these fair value gaps being respected, pushing down lower, and you can see, think about high resistance and low resistance liquidity runs, right? What do we have down here? Failure swings, failure swing, right? So sell stops are resting below here. Price action wants to keep continuing down, and also think about high resistance liquidity runs, right? We see a rate on this high, for example, or a rate on this high, or a rate on this high, and you see immediate rejection lower, confirming sell side of the curve until we hit that external range liquidity, completing that market maker buy model. So we got E-mini Nasdaq 100 futures chart over here. Again, we think about external to internal, right? So we have daily low sell stops being rated, turtle soup, right? Now we want to go into an imbalance or a lower time frame market maker buy model. So this is a daily time frame, right? Think about when we went from monthly to daily structure, weekly to 4-hour structure, and now we're going from a daily PD array into a 1-hour structure. As always, we start off with an original consolidation, right? Always outline your original consolidation and where your market maker buy model draw on liquidity should be, right? From here, we go from external range liquidity, right? Sell stops have been liquidated. Accumulation phase number 1 has happened over here. Accumulation phase number 2 happened over here. And then we form that smart money reversal down here below an old low, right? Sell stops have been liquidated. Again, what happens down here? Order pairing, right? Smart money longs are being accumulated down here, then push price up higher, and buy side of the curve is being confirmed after break of structure, and we're disrespecting a bearish fair value gap, right? Should not happen if we are bearish, so continuing up, respecting bullish fair value gaps, and buy side of the curve has been confirmed until we liquidate this original consolidation up here. Diving one time frame lower, again 4-hour chart, so 4-hour PD arrays, and then we're going to dive in a 15-minute chart, right? And we keep going down and down inside the time frames, and it is all fractal, right? It works on a monthly to a daily structure, it works from a 4-hour to a 15-minute, and so on. So from this range low, right, to this range high, this is our dealing range. Everything below this 50% level is discount. Now, again, we think about external to internal, internal to external, order pairing, very important, right? So we have an external rate over here, or a turtle soup, right? Now, what are we going to be looking for our next drawn liquidity after we take out external? We're going to look for an imbalance in discount, preferably, as our drawn liquidity, which is this fair value gap, right? This fair value gap is also a drawn liquidity, but it's still in premium, right? Because this above this 50% level, this is still premium. So we can dive a little bit deeper down inside this discount level. And how does that look like on the 15-minute, right? Market maker buy models. market maker sell models, it is all fractal. So 4-hour PDA above an old high external range liquidity, original consolidation down here, leaving some low resistance liquidity, right? So we know sell stops are resting below here, and that drawn liquidity was way lower, right? The daily or that 4-hour fair value gap in discount. We had accumulation phase 1 happening over here, accumulation phase 2, and then eventually smart money reversal above buy stops, right? Order pairing again, continuing down lower, 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 completing this market maker sell model on a 15-minute time frame. We're diving one more time frame lower, right? 1 hour chart. So we're getting into scalper territory right now. So 1 hour time frame, we can use a 5-minute market maker model. I think most people prefer a 5-minute market maker buy model, so you can have an intraday trade, right? If you're trading off a weekly key level, for instance, you're gonna hold your trades for a few days probably. So 1 hour is for most people, I think, the way to go, depending on your personality, of course. Now, again, we think about external to internal, right? We see these buy stops getting rated over here, over here. So we have external rate, we want to go to internal range liquidity, which is this 1 hour fair value gap, right? And once we hit that internal range fair value gap, we can look for external again. And then we dive into a lower time frame, which is the 5-minute time frame, right? And see if we can spot a market maker buy model forming. Also think about low resistance liquidity, right? Failure swing up here, engineered liquidity. So let's dive into 5-minute time frame. So we got this pretty clear consolidation, right? And inside this consolidation, we can also see a failure swing, right? This high and this high, failure swing, this high to this high, failure swing, and then accumulation phase 1 happens, accumulation phase 2, and then eventually we hit that key level, right? We always want to trade off a key level. So 1 hour fair value gap down here, smart money reversal, and you can actually see this long wick down here rates all this sell stops down here. Again, order pairing, right? External range liquidity. Now we're breaking up structure higher, and we keep respecting this fair value gap, and eventually it pushes up in one accumulation phase, right? So we have that expansion, accumulation phase 1, and then another expansion, completing this 5-minute market maker buy model. Now we dive into the lowest possible time frame for this market maker model. I guess if you want to be really freaky, you can go to a 5-minute time frame and go on a 15-second chart, but I would highly not recommend doing that. And this would be your lowest time frame for a market maker model setup. So 15-minute time frame, again, buy stops have been rated, right? So external range liquidity, and then we're gonna look into a 1-minute time frame. And personally, I think if you do like a 15-minute time frame as your key level and then 1-minute market maker buy or sell model, a pair like GBP JPY is perfect because these pairs move a lot compared to, for instance, Euro USD. Right, so this 15-minute high, right? Remember, buy stops have been rated with this clear this clear original consolidation. Now, after that original consolidation down here, we've got accumulation phase 1 and accumulation phase 2 until we clear those buy stops, right? So key level has been hit, smart money reversal is in, and then we break down here, respecting this bearish fair value gap, and then continuing lower. Again, think about high resistance liquidity runs, right? We see this high getting rated over here, and then you see that immediate drop lower, indicating you're still on the sell side of the curve. And then this should be the drawn liquidity and completing this short-term market maker sell model on the 1-minute time frame. So now that we went over time frame alignment, let's move on to mitigation blocks. So what is a mitigation block? Mitigation blocks are the bullish order blocks on the buy side of the curve in a market maker sell model, and the bearish order blocks on the sell side of the curve in a market maker buy model. So where smart money bought in those bullish order blocks, right? We're gonna use that same order block on the sell side of the curve to offload their orders and mitigate their positions. Right, we've got a Australian dollar, US dollar daily chart, and we see a clear market maker sell model forming over here with this original consolidation, right? Accumulation phase number 1, accumulation phase number 2, and eventually taking out external range liquidity and making the highest high in this curve. So after we break structure, we know we are going to go into sell side of the curve, highly likely, because we took out external range again, right? So we're expecting this bearish PDA. Now, where are the order blocks on the buy side of the curve? Those down close candles, right? Before my price moves up. So we're going to outline those bullish order blocks to the sell side of the curve. So we want to extend the bullish order blocks from the buy side of the curve into the sell side of the curve, because that's where smart money bought before, and now they will use that to sell. We want to pair the mitigation block up with a new sell side PDA. So as we just saw, a bearish fair value gap, we want the sell side PDA to be inside the zone of the mitigation block, and we'll outline in the chart how that looks like. So over here we outlined all those order blocks, right? The bullish order blocks on the buy side of the curve. Now we're heading into sell side of the curve, and we're going to outline this bullish order block to the sell side of the curve, right? So we want to see our new sell side array form around this area where we can use this as a mitigation block. So we can see this fair value gap here, right? We displaced lower and breaking structure. So this is a premium array which we can use to sell off from. So outlining this bullish order block to the sell side of the curve, right? Now we can see where we can mitigate our orders. So filling up this fair value gap, not quite fully, but we tapped over the 50% level and then we reject. So in the process, we're creating this bearish order block over here, right? And it's co-inlined with this bullish order block from the buy side of the curve. So now we have this layered, right? So now it's high probability this area can be used to mitigate their orders. So this mitigation block coupled up with a bearish order block, and then we can find an entry on over here. Price keeps continuing down until we reach that internal range liquidity, right? Again, from external to internal, and then sell side of the curve with those mitigation blocks. We have another one over here and another one over here, which we can outline too. So we outline this bullish order block from the buy side of the curve into sell side of the curve, and again, we are forming a bearish order block inside that old bullish order block, right? So we have old accumulation over here for buy orders, and now we have a new distribution for shorts to mitigate smart money positions. And lastly, this bullish order block extended out in time. We are forming what a new array, premium array over here, right? This fair value gap inside this old accumulation, did this bullish order block, and makes it even higher probable this will hold and we can continue down for that last push and completing that market maker sell model down here. Right, we've got a British pound Canadian dollar daily chart. We filled up a monthly fair value gap right here. Took out these daily sell stops down here, so we went from external to internal. What does that look like on the 1 hour chart? So with the start of a market maker buy model, we need an original consolidation, right? Over here we've got that original consolidation. Accumulation phases down here until we reach that higher time frame key level. Smart money reversal down here, and now we're going to use those bearish order blocks on the buy side of the curve, right, to mitigate those positions. So we have mitigation blocks for the buy side of the curve. So outlining this bearish order block down here, extended out in time, and you can see a PD array has been formed over here inside, which is a fair value gap, right? So you really want to see those new arrays form inside that old accumulation over here. So bearish order block being used to co-inline with this fair value gap, and hence you can send the price higher. Again, over here, another bearish order block extended out in time, and then what happens inside this area? We form another fair value gap, right? So we have another array which is formed inside that bearish order block, creating a mitigation block for their smart money positions. So here they were in sells, right? And now they can convert their sells into longs in that same area. And lastly, up here we have another one, right? Extend it out in time. We've got another mitigation block up here, right? A fair value gap has been formed over here, and then continuation to complete this whole market maker buy model. So really outline those old arrays from the sell side of the curve, extend them out in time into the buy side of the curve, and wait for your new PD array to form, and then it will be higher probable to take a trade from. Now let's move on to how to trade those market maker models. Before we do that, let's remind ourselves of the time frame alignment, right? Those PD arrays on the different time frames. So from a monthly array into a daily market maker model, from a weekly array into a 4-hour market maker model, daily array to a 1-hour market maker model, and so on and so on. So price is fractal, right? So we can scout for setups using different arrays and different market maker models. Right, so over here we got a crude depiction of how it looks like on a chart, right? We outline our premium to discount levels and scout out where the original consolidation has formed, right? We've got on the lower end of this discount, we've got that original consolidation, hourly structure, right? Moving up, accumulation phase number 1, let me repeat that. So we've got this original consolidation down in discount over here. So we know this is going into buy side of the curve. Hourly structure on a market maker sell model. We've got that accumulation phase number 1, accumulation phase number 2, until we hit that daily premium array, right? We're going from a daily into a 1-hour market maker model. So price goes up into the daily premium array. We wait for that 1-hour stop hunt, and from here on out we can scout for an opportunity into a market maker sell model. In this piece of price action down here, we can see this is a bigger market maker sell model, but price is fractal, right? So on this 1-hour stop hunt, we can see a 5 minutes, on a 5-minute structure, we can see a 5-minute market maker sell model form. And this is our opportunity to get in on a trade. So a sell program up here is activated. Up close candle should support price lower, and bearish PD arrays should be respected, right? Going into sell side of the curve and then eventually liquidating this original consolidation. Now how does that look like on a candlestick chart? We've got E-mini S&P 500 futures over here, daily chart, right? So remember, we're going from daily PD arrays and daily external range to internal range into a 1-hour structure and looking for our market maker models over there. So over here we got these buy stops run, right? Let's go to a 1-hour time frame. Over here we got that run on stops on the buy side liquidity on the daily chart, right? Now we identify on the 1-hour where is the original consolidation, right? Down here we've got this nice original consolidation. Price expands up higher, 2 accumulation phases, and then eventually liquidating that high. And now we can scout for a market maker sell model, right? And all up close candles, which are bearish order blocks, should be respected on the way down, and also those bearish arrays, right, like fair value gaps. Zooming in a little bit more, we've got that accumulation phase 1, accumulation phase 2, and then external range liquidity up here has been taken, right? So break in market structure over here, and then price retraces back up, and this is an opportunity to look for a market maker sell model. We've got that breakaway gap up here, and remember from core concepts, right, we've got that new PD array, that redelivered rebalanced gap over here. Price has no business going into that breakaway gap, and it should form a sell side of the curve down here. If you go to the 5-minute time frame, we can see a market maker sell model form here, so we can zoom in a little bit more. Right over here we've got that 5-minute time frame, right? Remember, we're going from a daily external range liquidity rate into 1-hour structure, and eventually once we hit sell side of the curve on the 1-hour, we can scout for a 1-hour PD array, which in this case is that redelivered rebalance gap, right? And then on the 5-minute time frame we can scale in down even more and look for a more precise entry. So over here we got that original consolidation with sell side liquidity, right? Also equal lows. So very nice target for sell side. Accumulation phase 1, accumulation phase 2, buy side of the curve. Once we hit that PDRA up here, then we can go into sell side of the curve, and now every up close candle should resist price to go lower. Always match up your entry with the correct kill zones, right? London kill zone 2 a.m. to 5 a.m. or New York kill zone or London close kill zone. And if you trade indices, go with AM session and PM session, right? So in the correct kill zone, so time is in your favor, and we can see that over here it hits it in the kill zone, that higher time frame PDRA, and from here on out we should see bearish arrays being respected. So sell side of the curve, right? Again, use those mitigation blocks, right, from the previous lesson. We've got this bullish order block over here. We can extend it out in time to the sell side of the curve. Now, is there a PDRA formed inside this mitigation block? Yes, we do have a volume imbalance over here, right? And then a bearish order block being formed also. So this is a nice area to take a short from. It's lining up with that mitigation block from the buy side of the curve into sell side of the curve. And eventually we've got the same thing happening over here, right? That bearish candle over here is a bullish order block. It's being traded in through. Now it's becoming a breaker block, right? Because a breaker block is structure liquidated to the upside and then breaking structure lower. Then we have a bearish breaker block, which you can extend out in time. And over here, you can see it hits it and then continues to liquidate this low. So market maker sell model completed all the way from the daily, right? External range again, going into a 1 hour structure. You look for that PDRA on the sell side of the curve on the 1 hour and zoom in even more on the 5 minute to find that fractal market maker sell model. Right over here we've got US dollar Swiss franc weekly chart. Take a look at this chart and where are we most likely to draw into. So at first we take external range liquidity, right? So now where does your attention go into for your drawn liquidity? Right over here we've got this area, redelivered, rebalanced, little tiny fair value gap. So the drawn liquidity is from external to internal, and we're zooming in on a 4 hour chart. Now with this being messy, if we drop down into the lower time frames and scout our structure, we can still manage to navigate through all this consolidation on the 4 hour, right? So we know external range has been taken on the higher time frame, also on the 4 hour. Remember this order pairing happened down over here below an old low. We know we go from external to internal, right? The drawn liquidity is up here. Where's the original consolidation? It's up here. So we've got a market maker buy model forming. Now we need to take external range and have a smart money reversal, which is down here, right? Market structure shift up here, breaking structure after liquidating the lows. Very important. We need to take external range and then drawn liquidity on that original consolidation with internal range on the daily time frame. 4 hour fair value gap is being respected. Candles are respecting the CE of this fair value gap, so the 50% level, right? And then this retracement is a market maker buy model on a 15-minute time frame. So now we're on a 4 hour, right? We went from a daily external range and now our drawn liquidity is the internal range. We can see this market maker buy model form on a 4 hour and break of structure and a higher time frame POI. So let's zoom into the 15-minute. Right, we're on a 15-minute chart, right? We have another original consolidation inside this 4 hour structure, right? So think about it. Price is fractal, so this happens on all time frames. You can even dive into a 1 minute after this one and find a market maker buy model or a short-term market maker sell model even. So down here we got this consolidation, accumulation phase 1 and 2. This retracement is a market maker buy model, right? We liquidate this low again, short-term order pairing over here for those sell stops. Break of structure up here. What are we leaving up here? Right? Engineered liquidity. Price drops down back into that 15-minute order block. A 15-minute fair value gap. Right? And then draw out your premium and discount level from this low. We liquidate this low, dealing range low. We take out this buy side liquidity. That high over here is our dealing range high. So we have our premium levels and our discount levels. then this fair value gap is a discount array, and you can see price liquidates this one. And again, this is a high resistance liquidity run, right? Because we just take out this low and then reject immediately. So order flow is bullish. And then we've got another breakaway gap. Why? Because we have that PDA array, right? That redelivered, rebalanced PDA array, which is a balanced price range. So we have two opportunities to get in on this market maker buy model, and let's see how that looks like with the New York midnight open price. So on this day, this is a Monday. If you extend this New York midnight price over here all the way in time, you can see London session highly likely to create low of the day, right? So dropping below New York midnight opening price, we know after we create low of the day, we want to see displacement and a fair value gap or an order block being formed where we can base our trade off. So this was a good first entry to take because the drawn liquidity is still up in this original consolidation, right? So until we liquidate this original consolidation, we can still find entries multiple times. So over here, first entry was possible. On a Tuesday, there was another entry possible, right? Draw out your midnight opening price, 12 a.m. EST, and then that redelivered, rebalanced PD array is over here, creating this breakaway gap, and then drawn liquidity was still not reached, right? Remember, and on a 4-hour time frame, that original consolidation is even higher. So the potential to go higher and higher on this chart is very likely, and we can see we just use those discount arrays, and then second opportunity on a Tuesday arrives, and then eventually liquidates that market maker buy model. So how to trade the 1-minute chart and 1-minute market maker models. The 1-minute chart is based off the 15-minute structure and PD arrays, right? So remember about time frame alignments from monthly to daily structure and so on and so on. And now we go from that 15-minute PD array into a 1-minute market maker model. Right, so we got USD Swiss franc again, right? Same chart. And now we can dive into even a lower time frame to scout where we can get in. And we know this is a 15-minute market maker buy model, right? But from here to here, this retracement is a form of a market maker buy model, right? Because we're hitting a higher time frame PD array, and the higher time frame in this case is a 15-minute time frame. It's all fractal, so if we dive into the 1 minute, then the 15-minute is a higher time frame, right? If we go and dive into a in a 1-hour chart, that's the higher time frame for a 15-minute market maker buy model, and so on. So again, this retracement down here, that will be a 1-minute market maker buy model, right? We're dropping below New York midnight open price, so everything is lining up. Higher time frame is lining up, and now we dive into the 1 minute to scout for our setup. Right, so buy side liquidity above here, right? Market maker buy model, original consolidation. This is that retracement on the 15-minute, right? And then we got that 15-minute fair value gap, which is the higher time frame PD array to take our trades from. So going into sell side of the curve here, right? Smart money reversal, respecting this little fair value gap, right? Continuing buy side of the curve until we complete this market maker buy model on the 1-minute time frame. Outlining those phases, right? Original consolidation, accumulation phase 1, accumulation phase 2, and then eventually smart money reversal is down here. Smart money reversal needs to happen in a higher time frame PD array. It cannot happen anywhere. So if you think this is like a smart money reversal, but we didn't hit any higher time frame PD array yet, right? The CE is down here, and then actually we're leaving out these engineered liquidity up here, which is a failure swing, unequal highs. It's perfect draw liquidity for buy side of the curve. Market structure shift over here, also one down here, but this is a significant break in structure. So where do we get in? We've got this breaker block, right? This mitigation block over here. Now, do we form a PD array on this breaker block? Yes, we do have that bullish order block up here, right? And then price finds support up here and continue up higher. Again, outlining those mitigation blocks. Remember, right? Those bearish order blocks, extend them out in time. Now we've got that mitigation block for a new fresh PD array for the buy side of the curve. So we create another fair value gap, this displacement up here. co-inlined with that mitigation block, making it high probable it will hold, and then completing the market maker buy model over here. And what is most important too, time, right? So be in a kill zone to look for your setup. So New York kill zone starts over here, 7 a.m., right? And this part is in the kill zone. So we form that smart money reversal just before the kill zone, and we want to look for entries inside the kill zone. Right, so we got a higher time frame chart over here, Euro USD. We start off with the monthly. We've got that internal range liquidity, right? Higher time frame PY. So remember, time frame alignment, monthly chart, PDRs into the daily structure, right? So let's go to the daily. So on the daily, we hit that monthly fair value gap, right? We have a market structure shift down here. So we're going into sell side of the curve. So now we know bearish order flow on the daily time frame. It makes sense because we got that time frame alignment, right? We have that higher time frame PY in the monthly fair value gap. So it makes sense for the daily structure to shift. Where is our opportunity? We've got this sell side liquidity down here, and we form a displacement in the form of a fair value gap here. So opportunities lie inside this fair value gap to go down into this sell side liquidity. So if we use that daily PDRA, what kind of structure do we need to use? Right, 1 hour structure, right? So from this high until this low, we can find our potential market maker sell model forming, and the daily order flow is in line with this idea. And the market maker sell model on the 1 hour is completed once we liquidate this low and eventually take out this one on the daily time frame. So diving into that 1 hour time frame, remember we've got that daily fair value gap right up here. So before we want to go into sell side of the curve, we need to hit this higher time frame PDRA. Original consolidation down here, right? Accumulation phase 1 and 2, and then hitting that key level, making a smart money reversal. So over here, this is important. We need a key level to key off and go into sell side of the curve from there, and then we can dive in even deeper in the 5-minute chart later to find a more precise entry. But over here, how to trade this 1 hour time frame? What do we form, right? We take out buy side liquidity up here and then start to break structure lower. So this bearish candle becomes a breaker, right? So, and then in this breaker, there's your opportunity to go into a sell. We know we don't have to go up here anymore. We know sell side of the curve is confirmed, and we should not disrespect bearish arrays anymore. And then continuation until we liquidate this one. So this whole row of up close candles is a bearish order block, right? So price should offer support to go lower. Same case over here. All these up close candles over here is all a bearish order block, and you can see price drops below it, goes back one more time to go into that bearish order block, and then finish off that market maker sell model on the 1 hour. Now we can dive into a 5-minute time frame too. So on the 1 hour, you could have gotten in with a breaker, right? So entry on the breaker, stop loss above the breaker, and then continuation lower. But if you dive into the 5-minute time frame, we have this piece of price action over here, which could be a market maker sell model being formed, right? Because we take this external range up here, and then we have that fair value gap being fully filled in. So that makes sense to continue down lower. So if we dive into the 5-minute time frame, so we're going all the way from the monthly, right, into daily structure, and we know our daily structure was bearish. We had that fair value gap where we could base our trade off from on the 1 hour chart, and now we dive even deeper down in the 5-minute chart to go and find a market maker sell model. So again, every time we need to scout this market maker sell model original consolidation, right? So original consolidation is down here, sell side liquidity is resting below this, and see all these failure swings, right? So we have engineered liquidity around this area. Price moves up and up and up, leaves engineered liquidity behind once again, drops back down, and retracement to continue up and fill up this whole 1 hour fair value gap and taking out all this engineered liquidity up here, all these buy stops. So from here on out, it's a high probability key level where we can go into sell side of the curve, and all up close candles should support price to trade down lower, right? So we have this bearish order block here, price drops, displaces to, so making it even higher probable after this break of structure that this bearish order block will hold. Again, with these two up close candles, they keep supporting price to turn down lower. And then over here another array has been formed, right? This bearish fair value gap continuing down lower, little consolidation and expansion, and then finally completing that 5-minute market maker sell model. In this third section of the mentorship, we're going to be talking about top-down analysis. We've got long-term perspective, intermediate-term perspective, short-term perspective with a New York session bread and butter model, and then eventually putting it all together. So let's go to long-term perspective. Long-term perspective, guys. Here we have a nice little quote from the Inner Circle Trader, or ICT. Without the understanding of higher time frame charts, you are gambling, which is very true. So the long-term perspective is the why in why price moves, right? So the long-term perspective, monthly, weekly, daily charts gives us the why. Why should price go up to a specific level and why should price go down to a specific level? We answer the question to why price should move from these time frames, right? All price is doing is trading from one higher time frame premium or discount level to another higher time frame premium or discount level. So what do we need to trade with these time frames, right? We have seasonal tendencies, which is not always necessary, but highly effective when used in combination with higher time frame PD arrays. We need a dealing range and those higher time frame PD arrays. We need higher time frame external and internal range liquidity. We can couple it up with daily SMT and stop hunts, and eventually we'll go into a buy or a sell program. So how do we determine if the higher time frame order flow is on our side? So we can go over a few things. Is price rejecting when going below lows and significantly trading through highs, or is price rejecting when going above highs and significantly breaking lows, right? And think about high resistance liquidity and low resistance liquidity, right? We can spot those with those rejections and easy price movements through engineered liquidity highs, right? Are down close candles supporting price higher or are up close candles supporting price higher? Think about those order blocks, right? Buy side of the curve and sell side of the curve. Are bullish PD arrays failing or are bearish PD arrays failing? With using this, we can also confirm our bias. Seasonal tendencies. Seasonal tendencies are treasure maps to finding low resistance, higher time frame moves when they are aligned with higher time frame PD arrays. So on their own, they don't really mean much, but if you combine it and align it with higher time frame PD arrays, they are very effective. When the seasonal tendencies do align with the higher time frame premium and discount arrays, price is very likely to have a fast and volatile low resistance price swings between one higher time frame price level to another higher time frame price level. When the seasonal tendency don't align with the higher time frame premium and discount arrays, price is more likely to take longer to move from one higher time frame price level to another higher time frame price level. The seasonal tendencies are the 12-month macro laid out in front of you, and we'll show you a chart later how that looks like before the trading year even begins, every single year. So we have those median lines, right? 15 years, 30 years lines, what the seasonal might be doing. Our objective with seasonal tendencies is to blend time, the seasonal tendency, right, and price together, the higher time frame premium or discount arrays. So price meets time and time meets price. So over here we've got a seasonal tendency chart for the US dollar index, and let's focus on January and February, right? Over here we can see they're pretty bullish, right? So we have those lines going up. We have the 33-year line, we've got the 15-year line, and then January and February looking pretty bullish, right? So here we have a US dollar index chart on the monthly. We've got this monthly fair value gap being hit, right? Discount monthly fair value gap, and let's look at how that forms. So we just talked about that seasonal tendency, right, from January and February. Both should be bullish, or at least start to turn bullish in January and February. And when a higher time frame aligns with that seasonal tendency, you can clearly see how that price action explodes to the upside, right? So over here, we still had a bullish seasonal tendency, but you can see price action is just consolidating, right? And we didn't hit that higher time frame PDRA yet, which is that discount monthly fair value gap, right? Now, as soon as February starts, we hit that monthly bullish fair value gap, and you can see just in a couple of days, we move way more than we did in the half of this January price action, right? So over here, these three candles keep pushing up, right? And then this whole area, which took a lot of days, 2 weeks almost, and then in a few days we make the same move. So as shown in the previous slide, we can see that even though January has a bullish seasonal tendency, we don't just long because we have a bullish seasonal tendency, right? We need to wait for time to hit price, and price is that higher time frame PDRA, and it needs to align before we get that explosive one-sided price action move to the upside, and that is what we see in February. So back to the dollar chart, right? We've got that bullish tendency. Again, January we did not tap into that higher time frame discount array, but in February we did, right? Breaking structure over here in January, in this move up during February. Displacing up higher, leaving a bullish fair value gap. So we've got a PD array formed where we can take a trade from or base our trade idea from. So we've got a Australian dollar, US dollar monthly chart, right? And let's think about external to internal range again. Keep repeating that, right, for yourself. If you see external range liquidity being taken on a higher time frame, it's highly likely to draw into a higher time frame internal range liquidity, which should be a fair value gap. So pulling up the seasonals, right, we have a bullish seasonal for January and February on the DXY, which means all foreign currencies should go lower, right? So we should have a bearish seasonal in January and February for the Australian dollar because the US dollar has a bullish tendency. Now, after raiding that external range liquidity on the monthly, taking out those buy stops, right? Once we take out that external range liquidity and we are in line with that bearish seasonal, we can see how price explodes to the downside. We have that daily stop hunt, right? And from this point out, up close candles should support price action lower, right? And we can see that over here, price moves up, respecting this area over here, this fair value gap, trading lower and lower and lower until we reach that monthly internal range liquidity. So seasonals, couple it up with a higher time frame PD array. An old high is also a PD array, right? It's a premium area. So we stop hunt over here and then we displace with that seasonal tendency. So again, a reminder, the US dollar index is bullish, right? Bullish seasonal tendencies. We've got that daily fair value gap. So again, back to that Australian dollar, US dollar chart, right? That monthly range buy stops have been liquidated, and now let's look what our dealing range is, right? We've got this range high down into this range low, and then we have a break of structure down here. Equilibrium is around here, so everything above this equilibrium line is in premium. And then if we look at this like this on a daily time frame, we've got that stop hunt up here, break of structure, draw out that premium levels, right? Another daily stop hunt. And if you remember about the silver bullet lesson, right? Intermediate term high has been formed over here, right? So even on the daily time frame, you can spot that silver bullet setup. After we go into bearish order flow, right? After respecting bearish arrays, we should see all up close candles supporting price to go lower. And we can see that over here. Price trades back into that bearish order block. Those up close candles trades lower, forming another bearish order block. Over here, tapping it in slightly, moving down lower. We have another bearish order block, and we keep declining and declining until we hit our target, right? So we go from external back to internal on the higher time frame. So over here we've got a British pound US dollar monthly chart, right? We've got that premium levels outlined over here, right? This little red box, and then the discount levels down here all the way to the low, which should be discount, right? Now, what did we do over here? monthly premium. Can we spot something else? We've got that mitigation block, right? This should have been a bullish order block which got violated, and now we're using that on the sell side of the curve to look for a monthly premium level. Now we rate those buy stops over here on the monthly and then declining lower. So with that bearish seasonal, right, and a bullish seasonal for the DXY, remember, so if DXY has a bullish seasonal, then all foreign currencies should trade lower, which would be a bearish seasonal for the British pound, US dollar. Now we don't just look for shorts in January because we have a bearish seasonal tendency, right? We need to wait for time to meet price and to meet on the DXY as well, right? So higher time frame PDRA on the DXY. Remember in January that fair value gap got hit, and that should be the catalyst to trade down lower. Now, if you're unfamiliar with SMT, it is when, let's say, these highs are not getting rated, right? And on DXY, the lows are getting rated and then continues to move up. This is considered SMT. So over here we got daily SMT with the Euro USD. So over here we are not taking out any highs on GBP USD, and on Euro USD we are presumably taking out those highs, right? Because DXY pushed down into the lows, which makes Euro USD most of the time be in line and take out the highs. So we have some SMT going on over here, and now it is lining up with that bearish seasonal tendency, right? So we don't need to liquidate this high for this to decline lower in February. Zooming in a little bit more, right? We've got those daily external sell stops down here. We've got internal range liquidity down here. Again, after that SMT has occurred, we don't need to go above these highs anymore or this high. So we're waiting for a bearish array to form, which is this fair value gap, right? And it is in premium. That's also important. Now, what are we forming over here? Think about that silver bullet lesson, right? This is an intermediate term high, making it even more probable that we're going to continue lower and lower to eventually take out this sell side liquidity. So from internal range liquidity, what are we looking for next? External range liquidity, right? So from internal to external. Got some more external range liquidity down here, right? Before we go to the extreme target, which is this low down here. So after drawing out that premium and discount level, right, we can see those external range liquidity sell stop has been taken after we formed that intermediate term high. Now we can anticipate a short-term high forming next to this intermediate term high, right? Because this intermediate term high is a intermediate term high because we have a short-term high to the left of it and now a short-term high to the right of it. We're hitting that bearish fair value gap, right? So we have a premium array. If we take this high, this range high to this range low, right? Price trades back into it, comes back one more time over here and continuing that bearish seasonal tendency, hitting a higher time frame POI and then eventually taking out that sell side liquidity. So over here we've got a Nasdaq 100 E-mini futures chart, monthly chart. Now without knowing the seasonal tendencies, we can still look and see where the higher time frame is most likely to move. Because remember, price is just moving from one higher time frame level to another higher time frame level. So outline the dealing range, right? First of all, this range low to this range high. So we've got our dealing range. We're going to look for daily SMT or stop-ons, and then we can see where we go from internal to external and external to internal, right? So what do we see over here? We've got a monthly fair value gap, right? Internal range liquidity. So where do we want to go next? What do we do after we take internal range? We go to external range, right? So we've got that monthly external range liquidity up here. So we know we go from internal to external and a draw on liquidity without knowing those seasonal tendencies, right? We know where price is most likely to draw into. Now let's look at the weekly structure after knowing what the monthly is most likely to do, right? We've got that monthly discount for value gap, internal range liquidity, remember? We're going to external range liquidity next, so we know the weekly should be bullish, and without knowing those seasonal tendencies, we can use all the PDRs moving up into that external range until we liquidate that. So over here we drop down right into that discount fair value gap on the monthly. Now we have weekly external liquidity, which is over here. So where do we go after we take that weekly external? Your eye should immediately go to internal range liquidity, right? So you look for a fair value gap, which is down here, right? Again, draw out your dealing range, this low till this high. Then we've got that internal range liquidity. Then we can continue up higher. So from internal to external, from external to internal. And once we hit internal, we want to go external once again, right? So we take out this high over here, right? External range liquidity, internal to external. And where do we want to go next? To the buy stops. Right, so over here we've got another example. We've got the Euro Australian dollar daily chart. Now without knowing seasonal tendencies and using a daily structure, because the monthly and the weekly is unclear, right? We can still go to a daily structure and see where we can find our setup and our daily draw on liquidity. So over here, first of all, external range has been taken. I give you a few moments to see where you are most likely to draw into, right? So where do we go from external? Right, we want to go to internal range liquidity, which is this fair value gap. So draw on liquidity even without knowing the monthly or the weekly, because that's unclear and we don't know what the seasonal tendency is, we can still see internal range to external and external range to internal range can be utilized to still figure out where the daily time frame is most likely to trade into. Higher up in the range, same occasion, right? We have this dealing range low into this dealing range high. What is happening over here? We're creating an imbalance, right? In discount, that's important. We don't want to see that imbalance in a premium level. Taking out this lows down here, creating a intermediate term low, and then continuing up from that discount fair value gap. So using structure on the daily, we can still know where we want to go. We went external, right? And then we go back to internal. And once we hit internal, we want to go external once again, which is up here, right? Putting that eye on there. So over here, external buy stops, and this keeps repeating over and over and over again. So external has been taken. So now where do we want to draw into, right? Again, we go from external to internal and then from internal back to external. So internal range liquidity, this fair value gap. And might I just add, we don't know what the weekly is doing, right? And the monthly, and we don't know what the seasonal tendency is, and we can still determine our draw on liquidity this way. Discount fair value gap has been hit. Now where do we go? External once again, right? So from down here all the way to up here, it is all it is doing. It's going from external to external, back to internal, back to external, right? Now that we know how to determine our long-term perspective, let's go to intermediate term perspective. So intermediate term perspective, 4-hour and 1-hour charts. We just went over that long-term perspective, right? The monthly, weekly and daily charts, and now we will need to determine our intermediate term perspective. So the intermediate term perspective gives us the answer to how price should move to get to that long-term perspective draw on liquidity, right? So remember, long-term perspective is the why price should go to a specific level, and that intermediate term perspective is how price will get to that specific level. The intermediate term perspective is how we get to our long-term perspective draw on liquidity. We want to utilize the market structure and PDRs on this time frame to help us get to the draw on liquidity. So the highest probability trades are when these two perspectives align and the order flow is aligned. So long-term perspective and intermediate term perspective being aligned is very powerful. As with everything in trading, our analysis starts with the draw on liquidity, which we determine from our long-term perspective timeframes, right? The monthly weekly and or the daily analysis, and after we've determined our high time frame weekly or daily draw on liquidity, we want to wait for our intermediate term perspective time frame to break market structure in the direction of our long-term perspective draw, and this aligns both of these time frames. Using draw on liquidity and premium and discount arrays determined on the long-term perspective, we want to align ourselves with the weekly candles or the open low high close or the open high low close, right? From lesson number 1, that power of 3. We want to determine which weekly profile is likely in the current week, using the economic calendar and focusing on the day with high impact news events for injections of volatility. So over here we've got a gold weekly chart, right? We've got these relative equal highs up here, an easy draw on liquidity. Sell stops have been liquidated on the sell side over here, right? So order pairing again happening over here, starting to trade up, up and up, and back into that discount array, which is this weekly breaker, right? So our premium high is over here, discount low is down here. We've got this weekly discount breaker. Now we've got our long-term perspective, right? So now we want to drop down in a lower time frame to see if our intermediate term perspective is in line with our long-term perspective, and then we can frame a high probability trade, or at least a high probability draw on liquidity. So once we go into that breaker, where do we want to go? External range liquidity, right? Those buy stops are resting above this high, engineered liquidity. We know our longer term perspective is those equal highs over here. And let's dive into a lower time frame to see what that looks like. So we've got this 4-hour chart for gold, right? This is our intermediate term perspective, and we need this intermediate term perspective to align with our long-term perspective. So our long-term perspective is bullish, right? We see those buy stops high up in the range, and now we need order flow to be bullish also on the 4-hour time frame, because then both of those perspectives are in line. Now we can see this sell stop rate down in that, remember that weekly breaker, right, is down here. Now we have this 4-hour market structure shift, and then we can say, all right, long-term perspective and intermediate term perspective are aligned, and now we are good to go for more bullish price action and bullish order flow. So over here we draw out our weekly opening price, right? We want to know in which day of the week we are trading lower and higher, and does it make sense for us to manipulate lower first on a weekly candle, right, to continue up higher and align that with high impact news events. So let's look at the economic calendar. We've got Monday, no news. So what can we expect on a day without news? We can expect the daily candle to accumulate inside its range, right? So we can clearly see on Monday we don't have too much of a movement, and it starts to accumulate. On Tuesday we've got high impact news, consumer confidence, so this could be a day where we can see some volatility injection, right? And Monday being accumulation, we can expect an expansion to happen on Tuesday, coupled up with that red folder, right? That high impact news. And also notice how we are below weekly opening price over here, right? And running Monday's low. We can expect the weekly profile to be a Tuesday low of the week, and with the high impact news it makes sense, right? So we have that structure shift on the 4-hour, right? So intermediate term perspective lining up with that long-term perspective, and then high probability we have created the low of the week with this news manipulation. Right, so outlining the news events from start to finish, right? Monday, no news. What can we expect? We can expect consolidation or less volatility. Then Tuesday, high impact red folder, right? Volatility injection. So what do we see? Low of the week being created with that high impact folder below weekly opening price and running Monday's low. Those sell stops have been liquidated and order pairing happened over here. So on Tuesday we move up, breaking structure, and then long-term and intermediate-term perspective is aligned, right? We've got that 4-hour structure shift, and then our weekly draw on liquidity is in line. So outlining that low that got raided, right, over here. Sell stops have been liquidated, order pairing has happened. Tuesday, move up, Now Wednesday, we've got another high impact red folder, so we can assume more volatility is coming into the marketplace. We can see this happening over here, right? We have this bullish order block supporting price to continue up higher. Another bullish order block being formed, continuing price up higher. Now, what happens on Thursday? We don't have any news on Thursday, so how does that look like? We have an indecisional day, right? And then at the end of the week, we have another high impact news red folder, right? So another volatility injection over here. So keep in mind, very important, if you're looking for your long-term perspective, your intermediate term perspective has to be in line. And then we look at the economic calendar, right? Which day is it most probable to create low of the week or high of the week, right? So without news on a particular day, you can expect more of a accumulation or consolidation day, right? And then we try to frame our setups on those days with a high impact red folder. So on Friday, you can see actually continuing up into the range, right? With this fair value gap, internal range liquidity, right? Where we're going to external, which is above this high, and we're forming a bullish order block in the process, and then continuing up higher. And eventually we take out those buy stops, right? All the way down from our long-term perspective, that that weekly breaker, right? And then continuation up all the way into the buy stops. So after we take that external range liquidity, those buy stops, right? We can expect what? From external to internal, right? So what would be our next drawn liquidity? If you guess that internal range liquidity, you are right, because we go from external to internal. Now, this is counter trend, right? Because our long-term perspective is bullish. We expect price to go higher than this, but with a intermediate term perspective being bearish, the counter trend draw should be correct, because we still have to think about that external to internal range liquidity, right? Now this is our next draw on liquidity, right? That weekly fair value gap. So with this weekly fair value gap being the draw on liquidity, even though our longer term perspective is bullish, but it's switching right now from external to internal. Now we need the 4-hour chart to be in line with our idea that we want to draw into this weekly fair value gap, right? So let's drop into that 4-hour time frame. Before we can be bearish, we need to see that buy side rate, right? We see that buy side rate up here. Now market structure shift happened down here. So now what do we have? We have our longer term perspective, which should be the drawn liquidity in that weekly fair value gap, is in line with our intermediate term perspective, which is that 4-hour market structure shift, right? So drawing out our premium and discount levels from this high to this low, we can see price action moves into that fair value gap up here and then continue down lower. Drawn liquidity still that weekly fair value gap. So outlining that 4-hour premium order block, right? And coupled up with that fair value gap, high probability area for rejection. So that market structure shift on the 4-hour perspective, right? That intermediate term perspective is now in line with our long-term perspective, which is the drawn liquidity in that weekly fair value gap. We can see this premium array, which should be the next area where we can frame our setup. And you see it hits it and then trades down lower. Again, important, look at the economic calendar. What day of the week is it most probable to create high or low of the week, right? So we want to couple up that high impact news with our intermediate term perspective. Now look at the economic calendar. What is happening on Monday and Tuesday? There is no news on Monday and Tuesday, right? So what can we expect? Consolidation, right? Not too much volatility injection, because we've got that high impact news on Wednesday, CPI, right? And then on Thursday we've got PPI, and then closing off the week on Friday we've got consumer sentiment. So expecting nothing on a Monday, no news again Tuesday. Now what can we expect for Wednesday, right? What do we want to see when we're bearish? We want to see a high of the week being formed, right? And then that is coupled up with a high impact news event. So in this case we got CPI, and then it's most likely to form high of the week with that news folder. So CPI, volatility injection, and remember that 4-hour bearish order block, right, in premium, that is the area where we want to trade from. So this is a 1-hour chart, and then we can see we hit that area over here. High of the week being formed, rating Tuesday's high. So buy stops have been rated again. And think about market structure, right? We see this short-term high here, intermediate term high, and a short-term high here. So we're forming a market maker sell model right now, right? Bearish order flow. Another high impact news folder running Asia highs over here. So we want to see that external range back to internal, right? And then we got this external rate over here. Order pairing, high resistance liquidity run, because we see an immediate rejection after we take out that high, right? And Friday we have another high impact red folder, right? Volatility injection, making it even more probable to draw into our longer term perspective, which is that weekly fair value gap, right? We got a premium fair value gap over here. We drop or we dip into that premium fair value gap and we still continue our way down into sell side of the curve. In this lesson, we're going to be talking about short-term perspective, a New York session bread and butter model. So we've had that long-term perspective, that intermediate term perspective, right? And now it's time to dive into an actual entry model. So short-term perspective. Let's think back to the previous lessons, right? That long-term perspective, the why price should go to a specific level. We know how to do that right now. Then we had that intermediate term perspective, right? How price will get to that specific level. And now we're going to be talking about that short-term perspective, which will be our entry for our execution and the trade. So obviously we're going to talk about a specific time window, which is going to be 8 a.m. EST to 12 p.m. EST, and this is the kill zone for this model. And we got to do a little shout out to the currency merchant for the logic behind this time window. So thank you, the currency merchant. The New York session between 8 and 12 is the bread and butter time window of the daily range. It's the sweet spot in the daily candles power of 3, right? That open, high, low close for a bearish candle, or the open, low, high close for a bullish candle. Between 8 and 12, price only does two things. We either have a continuation pattern or a reversal pattern. So 8 a.m. EST to 12 p.m. EST is our kill zone. Now at 9 a.m. and 10:30 a.m. EST, usually that is the sweet spot in the kill zone for reversal days, for the reversal pattern. So we'll outline this in the charts coming up and we'll see how that is formed. And then we have 10 a.m. to 11:30 a.m. This is when London was a extremely large range, or we have a red folder at 10 a.m. Now, continuation days. In a New York continuation, we want to have seen London go below or above midnight opening price to accumulate for the daily range, right? So smart money accumulates sell orders above this New York midnight opening price, right? To continue down lower during the day, and vice versa will accumulate long orders below that New York midnight opening price to go for an expansion higher. So at 8 a.m. we delineate a vertical line, and when we look left for failure swings, right? Remember back into the core concepts, we've got those LR signatures, low resistance liquidity runs, right? Failure swings, equal highs, equal lows, trend line, and all that kind of stuff. The only two options for framing a trade between 8 and 12 are premium or discount array retracements or stop hunts. So on reversal days, if we are bullish, we want to buy below the opening price at midnight, right? And if we are bearish, we want to sell above the midnight opening price. So at 8 a.m. we delineate a vertical line, and then we look left for those failure swings, right? Those LR signatures. Then we think back about core concepts, right? Failure swings, engineered liquidity, equal highs, equal lows, trend line phantom, and all that kind of stuff. Now, what are we targeting? We're going to be targeting previous daily high or low, right? The easiest draw on liquidity, Asia high or low, or London high or low. The only two options for framing a trade between 8 and 12 are premium and or discount array retracements or a stop hunt. So now we also need to know when to avoid New York session, right? So when do we want to avoid New York session? When London is an extremely large range. And why do we avoid it? Because most of the time the daily range has expanded already, and New York session then tends to consolidate or accumulate or go into like a short-term seek and destroy profile, right? There's no juice anymore in the market and targets have been hit already. Also, when we have a red folder later in the afternoon, like FOMC, most of the time that is at 2 p.m. EST, right? And then the day before news events such as NFP or CPI. All right, we've got a crude depiction for our short-term perspective bread and butter model, right? Remember, time is very important, so we're going to be looking for that setup in New York kill zone 8 a.m. to 12 p.m., right? For that continuation or reversal. Now over here, we've got a continuation pattern, and basically what you're looking for is a premium and discount levels. So you draw out your range, right? If you're looking for shorts, you're looking for a premium array, obviously. So that could be a 1 hour or a 15-minute POI. And you can see drawn liquidity over here is lower, and we wait for our price action to go into that premium array and in that specific time zone. That is very important, right? Now, looking for liquidity, very important. We look for those failure swings, right? We can see those failure swings down here, another failure swing down here, and then that smart money reversal happening in our POI. That's what we wait for, and then the setup will form in our sweet spot from 8 a.m. to 12 p.m. Now, what is option 2 in the continuation? So we either hit a higher time frame premium or discount array, right? Or we look for that stop hunt and then continuation lower into our drawn liquidity. So basically we go back to that sweet spot, right? 8 a.m. to 12 p.m. EST. We see structure breaking down. Again, looking for liquidity. We see those failure swings, right? We want to have that low hanging fruit, that easy target. So when we break down, we have a clear draw on liquidity and continue down into those lows, right? We have that stop hunt on the 1 hour or 15-minute, right? So we know we think back about order pairing, right? On the core concepts, we order pair down up here, and then we continue down lower, breaking structure, and then we have that continuation between that 8 a.m. and 12 p.m. time window. Right, let's talk about that reversal pattern. Now, this looks like a market maker buy model, right? We have that original consolidation over here, and also we always draw out our New York midnight opening price, right? Because we want to be a buyer below this timeline, right? The New York midnight opening price, and we want to be a seller above it. So with a market maker buy model, we identified that original consolidation. We've got also those equal highs, right? Or failure swings up here. So we have a clear draw on liquidity for this one. And then we wait for that discount array to happen and that specific time zone. So 8 a.m. to 12 p.m. This is where the reversal can occur. So over here we hit that array, right? The discount array. We break structure up inside the kill zone, and then we're going to be looking for our setup. So same structure over here again, right? Only one difference, it's the time window is extended to the right a little bit further, right? Because then in late London we hit that discount array instead of that New York kill zone time frame. Now this is fine because we can still catch an entry because we wait for that specific time window, right? We know break of structure and a discount array has happened already, so that sweet spot should be hit within our kill zone, and then we still have that market maker buy model which we can complete. Right, so over here we've got a Euro USD 15-minute chart. Now, what do we want to do first, right? We want to delineate our New York midnight line, right? We've got that on the chart until 12 p.m. EST, right? The end of the New York kill zone. So what do we want to do at first? We want to draw out our New York opening price line, right? Because we want to be sellers above and buyers below that, right? We've got that line outlined over here. So we can see price is starting to accumulate above this New York midnight opening price. And why is it doing that? Because smart money wants to accumulate their short orders, right, to continue down during the day. Now, let's think about what time zone this is happening, right? We've got London open kill zone, right, 2 a.m. to 5 a.m. And think about London. London almost always creates a high or low of the day unless we hit a higher time frame POI where we can have a reversal, right, during a New York session. But accumulating short orders above that New York midnight open price over here, and then think about order pairing, right? From the core concepts, we've got that order pairing above those buy stops, and then they drive price down lower during the London kill zone 2. breaking structure lower, and then for us we wait for that specific time frame, right, at 8 a.m. to 12 p.m. EST for that New York kill zone. So outlining a vertical line from 8 a.m. and then from this point on we're going to be looking for low resistance liquidity, right, and or we're going to wait for that higher time frame or that premium discount array to be hit, or we wait for that stop hunt, right? So two things: we hit a premium or discount array and then continue our way down, or we're gonna wait for that stop hunt. Now, do we have news, right? We need to see, always keep an eye on that economic calendar. We've got 10 a.m. consumer sentiment, so highly likely what we just talked about, right? You want to have that 10 a.m. to 11:30 a.m. as your sweet spot for looking for a setup. If we don't have high impact news at 10, we can do it from 8 a.m. already. So in our specific time frame over here, we wait for either a stop hunt or a premium retracement, right? So what happens over here? We've got that 10 a.m. news, right? Price drives up and does a 15-minute stop hunt, and after that we can look for our setup, right? So this time we did a stop hunt instead of a premium retracement, and we kind of also went back into this fair value gap, right? That's a premium array. So from that 15-minute chart, we dive into that 1-minute chart, right? We've got that 15-minute stop hunt, and again, think about order pairing, right? Their buy stops are paired up with their sell orders, so price drives lower and lower and lower. And from this point out, we want to see all bullish candles being support for lower prices, right? We got that bearish order block formed after we ran liquidity, and then we're going into a sell program, and we can see that over here. It's offering support lower. And then every up-close candles, set of up-close candles should be supporting price lower. You can see it here over again, right? And just keep outlining this on your chart. And this is every time you can pyramid an entry on these types of candles, right? So we know the sell program is activated. We are in the sweet spot, right, at 8 a.m. to 12 p.m. EST. Now high impact news has occurred. We already had that stop hunt, so if you were to enter on this first order block, stop loss will be above this high, right? This stop hunt. And think back about that market structure too, right? We've got that intermediate term high formed, which should be protected and not get traded back into again. So this is a good area where you can place your stop loss. Now price comes back into it again, turns down lower. We have another bearish order block formed over here. Price goes in it, trades down lower. We got another bearish order block formed, and this will continue on and on and on until we hit our draw on liquidity. Right? Outlining a few more. Bearish order block up here. Then price drives lower, another bearish order block. Price drives lower, another bearish order block, and just keep outlining those bullish candles, right? Right, we've got a USD dollar Swiss franc 5-minute chart over here, and in the previous example we talked about that stop hunt, right, and then continuation into our price action. Now we're going to talk about that discount or premium array that we will hit, and then a continuation in our kill zone, right? So two scenarios. We covered that stop hunt, and now we're going to talk about that premium or discount array. So as always, draw out your vertical line, right, at 12 a.m. EST until the end of our kill zone, which is 12 p.m. EST. We've got our daily opening line, right? New York midnight over here. And again, think about it, right? New York session is our kill zone, 8 to 12 p.m. EST. But we have one advantage when we trade this time zone, right? Because we already know what the London session has done. So London kill zone, we trade lower, creating low of the day over here, starting to break structure upwards, and we've got that LRLR signatures above here, right? So we see clear targets for London kill zone to go up, and hence we create low of the day. So we already have this information, London open, creating low of the day. Now we look for our sweet spot, right? 8 a.m. to 12 p.m. EST, continuation pattern, right? So earlier we talked about that stop hunt, but we cannot see a stop hunt right over here. But we can use discount arrays, right? So first of all, where is our liquidity? We need to know our draw on liquidity before we find our entry setup, right? So we see this LRLR signature up here, right? Those failure swings. up here. And this is what we want to see if we are bullish, right? We want to see low resistance liquidity. So we want a high resistance liquidity run opposed to our buys, right? So over here, where do we have a discount array? We've got this low until this high, right? This is our dealing range. Why is this the low of our dealing range, right? This low takes out this low over here. That's a high resistance liquidity run, right? And then this high takes out this high. So that's how you define your dealing range, right? Discount into premium, and then we have that failure swings above there. Now we're looking for a discount fair value gap or a discount order block. We get one over here, and in the process that we move up from this discount fair value gap, we can form a what? A bullish order block also over here, right? So outline your PDRAs. So we got that bullish order block over here supporting price to go higher, and there's still an opportunity to get in next, right? Because we still form a breaker up here, and that is a second opportunity. It is still inside our kill zone, right? So important, if it's still in our kill zone, we can still look for setups unless we already cleared our drawn liquidity, and in this case we still looked for higher prices, so an entry was still possible. So we just talked about those continuation patterns, right? First of all, we have a stop hunt. And second of all, we can look for a discount array. Now let's talk about reversal patterns, right? So we have continuation pattern, and now we're going to talk about that reversal pattern. So again, two things you can have. You have that stop hunt, right? And then we have a discount or premium array where we can base our trade idea from. So over here, we've got our discount and premium levels, right? From this high down to this low. Again, we take out this low, right? So this is the low from our dealing range, and then we take out this high over here, and then we have our whole dealing range. Now we drop down back into discount of this whole range, and notice what happens down here. We've got that 1 hour stop hunt in discount of this hourly range, right? So this makes sense. Scenario number one, again, stop hunt, and now we'll dive into a lower time frame to see if we can frame our setups in our specific time frame, right? At 8 a.m. to 12 p.m. EST time frame. Right, so if you're a 5-minute time frame, right? As always, we see where have we had a stop hunt. On the 1 hour, we had one down here, right? So we know order pairing happened over here, and it's likely to reverse. Draw out your daily opening price line, right? New York midnight. As always, we want to be a buyer below this line and a seller above that line. So with London session slowly trading lower and lower, still accumulating, and notice where the liquidity is resting, right? We've got that equal highs up here. We got this equal highs up here. So we have a nice draw on liquidity to go for a bullish reversal. Now, after that stop hunt, what are we looking for? Our specific time frame, right? 8 a.m. to 12 p.m. EST. Outlining those buy-side liquidity once again over here, London highs and Asian highs, right? We target either previous daily high or previous daily low, or we're gonna do those London highs or London lows or Asia highs or Asia lows. Vertical line on our 8 a.m. to 12 p.m. time zone, right? That sweet spot for the bread and butter setup. Now again, hourly stop hunt down here, right? And then we continue up higher. Now think about, we talked about time earlier, right? What is the sweet spot for a reversal? That 9 a.m. to 10:30 a.m. is the sweet spot for those reversal days. And you can clearly see over here also, we start that reversal with that stop hunt. It's right on the dot on 9 a.m. And then in this time frame, 9 a.m. to 10:30 a.m., we can spot our entry model. Draw out your discount arrays over here, right? So we've got this nice bullish order block formed after that stop hunt. So a high probability order block has been formed over here. We're inside the sweet spot. We displace up higher. So we're leaving behind a fair value gap. That's entry number one, right? Then another displacement, another fair value gap. And in the process, we're creating an order block here too. So we can see these highs over here are relatively equal, right? Is a failure swing, so a low resistance liquidity run up here, right? So with this bullish order block being formed, there was still an opportunity to get in because we did not take out this high, nor did we take out this high, right? And then eventually our longer target was up here. So this bullish order block was another opportunity to get in, and in the process of taking out this high, we form another bullish order block, and that is actually the third entry you can find to continue up higher into the Asian session highs. So small little recap, right? 1 hour stop hunt, we went to the 1 hour chart, and then we look for that specific time frame. Then we wait for a break of structure and those bearish arrays to get disrespected and the bullish arrays to get respected. And we can clearly see that over here, that bullish order block, bullish order block, bullish order block, and we keep continuing up until we liquidate all those session highs, right? London session high and Asian session high. So over here, we've got a Euro USD 5-minute chart, right? It's naked, right? We're gonna add some lipstick later, but always we start off with that New York midnight opening line. Just keep repeating that over and over again. Always draw that out, and then end of our New York session kill zone, right? 12 p.m. EST. Draw out your New York midnight opening price, 12 a.m. EST. You can see London slowly accumulates below market price over here, right below that daily opening line, and then we continue up higher, taking out those relative equal highs at the start of the true day open, where the algorithm starts its day, right? And then we're talking about reversal patterns today, right? So that 8 a.m. to 12 p.m. Sweet spot, our kill zone, and we're going to be talking about what happens over here. So what do we want to be targeting, right? We're always looking for those failure swings, those engineered lows, those engineered liquidity highs. And in this occasion, we're looking for a bearish reversal during New York session. So we're going to be looking for failure swings on the low side. And we can clearly see we've got some failure swings down here. We've got some failure swings down here. And eventually we target, again, previous daily highs or low, London session highs or lows, or Asia session highs or lows. So we're going to be targeting that London session lows, and then we have more liquidity inside this range too. So it's setting up to be quite a nice reversal. Now, outline that 8 a.m. to 12 p.m., right? Our kill zone, and a reversal should happen inside this kill zone. And time is very important. We're not going to look for a setup before 8 a.m. and we're not going to look for a setup after 12 p.m. Again, remember the sweet spot for reversal days, right? 9 a.m. to 10:30 a.m. Unless there is a high impact news event, right? That if there's a news event at 10 a.m., we don't look for this reversal at 9 or 10:30. We wait for news to pass and then we look for that setup at 10 a.m. to 12 p.m. But right now we have no high impact news and we're looking for a premium array, right? So we discussed the stop hunt earlier and now we're gonna discuss this premium array trading lower. So you can see a break of structure above daily opening, right? We are above daily opening price. We are in the kill zone, 9 a.m. sweet spot for that reversal day. And then we can see break of structure down here. We see in the process of breaking down, we see this bearish order block being formed and a little fair value gap down here also being utilized as support for price to go lower. And then in the process here, we form another bearish order block and price is very willing to trade lower, and you can see this displacement is pretty significant, right? And we go straight for these lows down here, which we identified earlier, right? And eventually we take out those London session lows, which is the drawn liquidity, and this is just a perfect setup for that 9 a.m. to 10:30 a.m. reversal day. So we're going to be talking about how to trade high impact news releases, right? So trading the news events and knowing when to get in prior or post the news even is crucial. So the understanding of news and the volatility injection is derived from understanding order pairing, and we went over order pairing in the core concepts, right? So in a bullish scenario, if we are bullish and the market has taken significant sell stops prior to that news session, then the news will immediately move in one direction higher to pair the orders with the existing buy side liquidity, those buy stops, right, engineered prior to the session. And if we are bullish and the market is yet to take significant sell stops prior to that news event, then the news event will have a fake move. Then they will call that a Judas swing, right, to run those sell stops in the marketplace in the form of external range liquidity low or external or internal range low, accumulating the necessary sell stops to then reverse the market, taking it higher to pair those orders with existing buy side liquidity, those buy stops resting at the marketplace at that time. Now in a bearish scenario, if we are bearish, inversed, right, and the market has taken a significant buy stops prior to those news session, then the news will immediately move in one direction, lower, to pair the orders with the existing sell side liquidity, those sell stops engineered prior to the session. If we are bearish and the market is yet to take significant buy stops prior to the news event, then the news event will have a fake move, right? That Judas swing once again to run those buy stops in the marketplace in the form of an external range high or an internal range high, and then accumulating the necessary sell stops to then reverse the market, taking it lower to pair those orders with existing sell side liquidity, those sell stops again, resting in the marketplace at that time. So order pairing at a news event, there are three scenarios we can look at. We have that continuation, we have that Judas and then continuation, or we have a complete reversal, so we have a Judas reversal. So over here we've got a schematic of that continuation scenario, right? We've got our premium and discount levels. Going over here, looking where the liquidity is resting, right? We've got those engineered liquidity over here, failure swings, more failure swings, and we're forming a market maker buy model in this scenario, right? So sell stops have been liquidated over here and down there, smart money reversal down here, and then let's look, when is that news event, right? We've got that 8:30 or 10 a.m. news folder, and then we look for, did sell stops get rated prior to the news? If yes, then it's highly likely the news will just go one direction and shoot up, right? And we can see that over here. We already ran significant sell stops before that news release, and we have engineered liquidity above market price, right? So it's highly likely price will just continue up and take those buy stops and not go down once again. So this is a continuation scenario. So with that news event coming up at 8:30 or 10 a.m., right, that red folder, they want to pair up their sell stops with the buy stops from willing buyers above market price, and we can see that over here, because those were those failure swings, right? Over here also those failure swings. And remember, all those sell stops have been liquidated already, right? So price has no business to go down anymore, and we're going to look for those buy stops to pair up the sell stops. Now, this is a 10 a.m. scenario, right? Let's say at 8:30 a.m. we did not run significant sell stops yet. What will happen first, right? We get that Judas and then continuation scenario. So first of all, we talked about that continuation scenario, right? Does significant sell stop have been taken yet? If yes, then we have a one-sided direction with the news release. But at 8:30 and there are still sell stops to be have, then we can look for those sell stops. So there will be a fake move coming up with the news release, and we call that the Judas swing, right? So with 8:30 having a Judas swing, taking out sell stops, and then it's ready to continue up for those buy stops. Same over here, only inverse, right? A sell scenario. We've got this continuation pattern over here, and then we see our discount level here, our premium level up here, and then we are going to spot liquidity first, right? Where are the failure swings? Where are the equal highs or lows? Where are the trendline phantoms? And we can see those are formed here. So we have a basket or a liquidity pool of sell stops down here for order pairing. And then we have those buy stops rated over here and over here. And then we were reversing before news event. So we already liquidated those buy stops before that news event, right? So highly likely we're going to see a continuation lower one-sided. So this is again scenario one, continuation, because we already have liquidity taken prior to that news event. Now for that bearish scenario, let's say 8:30 a.m. is high impact news and we did not rate some significant buy stops, right? So what is most likely to happen? We can get a Judas and then a continuation, right? So we have over here a Judas swing with the 8:30 news event, and then we get a reversal. So we have a Judas reversal over here, right? So we're going down, we're going up from this 8:30 news event, reversing down, taking all the buy stops, and then we're continuing our way down into the real area where we want to go, which is that liquidity pool of sell stops down here. Right, over here we've got a E-mini Nasdaq 100 futures chart, right? And think about the core concepts again, right? We're dipping into a internal range liquidity pool over here, which is a daily fair value gap. So after internal range liquidity has been tagged, where do we want to go? Right, we want to go to external range. So we're looking from internal to external. So that's step number one. Now we're thinking about time frame alignment too, right? We're looking for a daily external range. So we went into a daily internal range, and now we want to go to a daily external range. And what do we use with our time frame alignment? Daily structure, and then we go into a 1 hour time frame, right? So over here we've got that 1 hour time frame, right? Outlined below down here, we've got that daily fair value gap, right? That internal range liquidity. Next up, we're gonna spot our engineered liquidity or failure swings, right? We've got a bunch of failure swings up here. So there's a lot of liquidity here, right? For the buy side. We've got sell stops down here, we've got sell stops down here, and here, and here, and these sell stops all got rated prior to that news release, right? Because we're gonna zoom in a little bit more later, but this all happens before that news release has happened, and we hit that higher time frame POI, right? So let's go to the next one, which is a 5-minute chart. So again, time frame alignment, right? We go from a daily PD array into a 1 hour structure, and then we can zoom in from our 1 hour into a 5-minute, and then we have an even more clear picture to get in on a trade, right? So prior to that news release, we've got this CPI over here, right? High impact news. But what happens before that news impact, right? We already took out sell stops here, those sell stops down here, and then those sell stops down here, and then more importantly, we hit that discount array, right? Internal range on the daily. Now we want to look for that external range on the daily. And with all these buy stops being engineered prior to that news release, it's highly likely we have one-sided continuation with news release, right? So like this, you can anticipate price action to go one-sided, or that we have a Judas swing before that news release happens. Now, I do not advise trading CPI because you can get slipped very hard. So this is just an example, and again, I don't advise trading CPI. We've got those buy stops up here for order pairing, which makes sense, right? There's no order pairing anymore down here because we already took out those sell stops prior to that news event, and all that engineered liquidity has been taken out with that news release. Right over here we've got a crude depiction of market structure, right? So what does our eye go to first, right? We're looking for low resistance liquidity, and we're gonna look for old highs or lows which are being ran before the news release, right? So let's see, where is the liquidity? We've got this very clean trend line, and your eye should immediately go there, right? This is all the low resistance liquidity being formed prior to that news release. Now, after this has been formed, what did we do after? Right? Buy stops have been liquidated, right? So now we're gonna see at what time is the news release. Was this news release before we took out these buy stops or after, right? If we have news release after we take out those buy stops, it's highly likely again to be a continuation, right? A one-sided direction with news release, because order pairing already happened up here, so their price has no business to go down, and we have massive engineered liquidity down here, so it's highly likely news will push price down and then liquidate all that low resistance liquidity. Now, if we have 8:30 news before that buy stops have been liquidated, right, then it's highly likely we're gonna get a fake move first and then a continuation after. So think about it, right? Is liquidity being liquidated, or are buy stops or sell stops being liquidated after or before that news release? And then we can think about, is it more likely we have a continuation, or is it more likely we're gonna get a fake move first and then a continuation? So how does that look like on a British pound US dollar chart, right? We've got that daily chart over here, and again, external range liquidity, right, over here. So what is more likely to happen after we take external? We want to go to internal, right? We have some internal range liquidity down here, pushing price lower and lower and lower. We've got now a failure swing, right? And then the displacement happened down here. So we've got internal range liquidity on the daily. And now let's zoom in a little bit more. Right, we got that 1 hour chart, right? Now we're in a higher time frame POI, right? So this daily fair value gap is our area where it's highly likely that price will move down further, right? Continuation. Now let's look at where is a news event. We have that 9:45 a.m. red folder up here, and then we have to decide where has liquidity been taken already and what is more likely to happen. Are we gonna have a continuation lower with news, or are we gonna run buy stops first? So if your eye went to this high over here, that is very nice, because then we have an external range liquidity rate, right? So we have a fake move first, taking out those buy stops because those buy stops have not been taken out prior to that news release. We can see that fake move up and then a continuation down lower, completing that market maker sell model eventually down here. And think about, we're coming from a higher time frame, daily fair value gap, right? And if you think about the daily time frame again, we already had those buy stops ran on external range and then displacing down lower. So this is the highest probable PDA to go down from. So those buy stops have been liquidated. And then if we dive into the 1 minute time frame, we can see even a more clear picture, right? So think about that high that got liquidated on the 1 hour, right? It's also still inside a 1 hour fair value gap. We can see price action goes up above it, and then we're breaking structure down here, and you can see this first premium array is being respected, right? We have this breaker and then this fair value gap here. Price breaks down even further and then starts to accumulate before that news release. So we've got PMI right at 945. You can see this little fair value gap here offering resistance for price. And again, we already ran those buy stops, right? So order pairing happened already above market price. Now we're going to look for order pairing below market price, which are these sell stops for order pairing into buy stops. And then where is the liquidity, right? We've got these failure swings, right? So engineered liquidity, trend line phantom. So it's highly likely price action will just continue down with that news release because we're already ran buy stops before the news. Right, so over here we've got an execution picture, right? Those execution, there's a lot more execution, but we're gonna focus on this piece over here, right? We just looked at the 1 hour chart and we got that high over here, which is this high, which get ran, right? So those buy stops got run, and you can actually see a sell execution just prior to that news release over here has been activated, and then going for those sell stops, right? So this is a perfect scenario where you are aware that buy stops have already been ran, and it is highly likely this high impact news release will just drop price, and you can clearly see here that sell execution into those sell stops for order pairing and closed down here. So perfect trade. So over here we've got a New Zealand dollar, US dollar daily chart, right? As always, we're going to look at the PDA. Where are we in premium or discount, and what is more likely to happen? Are we going to trade lower or higher? So we are spotting some failure swings down here, right? And it looks like we're going to go bearish because we're respecting that daily fair value gap up here, and we're respecting this new daily order block, right? So zooming in, again, time frame alignment, right? We go from a daily PDA into a 1 hour structure. So we're looking at this 1 hour structure over here. Price goes into the daily order block, respects it, pushes down lower, leaving equal lows down here, right? And then we see this little swing high over here. So when we're talking about two news events, right? Let's say you have a high impact news event at 8:30 a.m. and then you have another high impact news at 10 a.m. and you see that 8:30 a.m. news event runs buy stops and then continues to decline. You can anticipate that next news event to continue its way down because we already, remember, took out those buy stops, right? So the first news event, we took out those buy stops, and the second news event, it's highly likely we're going to have a continuation. So you can actually position yourself after that first news event into the second one, and I will show you some executions later. So over here we've got that 8:30 news, right? Buy stops have been ran. You wait for that news release for price action to show its hand, what it wants to do. Do we run significant buy stops? Yes, we do, right? We took out these buy stops and then started to decline with displacement, and then 10 a.m. we've got that news event down here. So it's highly likely this fair value gap prior to the news event will stay respected and then continue down, and it looks something like this, right? Bearish order block being respected. Think about all those up close candles, right? They should support price lower once it is in a sell program. So that happens over here. Bearish order block, price rejects it. Another bearish order block, price rejects it. Another bearish order block, and that is prior to that news event, right? We displaced lower, and then you have that fair value gap down there. And this is what it looks like with execution, right? We see this buy stops have been ran over here. Price drops lower, 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 lower. This is prior to the news event. So if you have that knowledge, is there already buy stops ran? And is it more likely that we have a continuation with news or a reversal or a Judas swing? And in this occasion, we know buy stops have been ran already, right? And then this is not even risky. This is just logical thinking. And we can see this drop down here, executing, taking a partial, and then eventually closing down at this low. Perfect trade once again. Right, we've got a British pound US dollar monthly chart, right? So we're looking for that monthly drawn liquidity, which was that internal range liquidity here, right? We're going to be talking about that news reversal right now. So now, earlier we talked about that continuation and that Judas swing into continuation, right? And now we're going to talk about that news release. And now we're going to talk about that news release that will be a full-blown reversal, right? So monthly drawn liquidity, that fair value gap. Let's go into a lower time frame. We've got that daily chart right now, and what is price action doing? We're supporting over here, right? And then NFP release is on this day. So our drawn liquidity is that monthly fair value gap, remember? So go back one more slide. We are aiming for this monthly fair value gap. There is a daily order block supporting price prior to that NFP release, right? That high impact news release. And then we zoom in into the 15-minute time frame. So over here, so where is the market at prior to that NFP news release, right? It is in a premiums when we are bullish, so it's likely to reverse, right? Then there are failure swings below us too, right? We've got these failure swings down here, right? And then it failed to run significant sell stops prior to that news release, right? So it's highly likely we can see a reversal from that news release. So market will seek discount and sell stops at the release before reversing and pairing those sell stops up with the engineered buy stops above marketplace. Our NFP news candle is over here, right? And we can see it drops straight back down, taking out all those failure swings, right? And then a full-blown reversal will happen because we hit that higher time frame POI, and then finally we take out those sell stops, right? Because remember, if we didn't take out any significant sell stops, it's highly likely it will reverse afterwards and take those sell stops. So at NFP release, the market is in a premium when we are bullish. So what is more likely that it will do? So if it's in premium, it's more likely to drop back into discount with the news release, right? But there has to be failure swings below us, which is the case in the previous chart, right? And then it failed to run those significant sell stops prior to that news release. So the market will seek discount and sell stops at the release before reversing, and then pairing those sell stops up with those engineered buy stops above marketplace. Over here we have some more lipstick on the chart, right? We've got that discount into premium range, right? Before the news release, where is market price at, right? We're in this discount levels, right? Because the news release is over here and we are still in this premium area, so it's more likely to draw lower. Are there any significant sell stops being taken yet? No, they are not, right? Because we've got all these failure swings down here, failure swing here. So it's highly likely NFP will continue down into those sell stops before reversing. So now we accumulated those significant sell stops, right? We have order pairing below it after that NFP release, dropping down into the daily discount order block, and then over here we can see order pairing happening and then continuation up. So how does that look like on a lower time frame, and can we even trade this, and is there an opportunity to get in to go for those to go for that monthly drawn liquidity, right? That monthly fair value gap. Yes, we can do. We have some buy stops over here, right? For order pairing. So there are engineered buy stops up here and engineered buy stops up here. And eventually above here, right? That monthly fair value gap, which is the drawn liquidity. Dropping into the 5-minute time frame, we see those buy stops for order pairing are present. We hit that discount array, that daily order block, right, after that NFP release, and remember we took all those significant sell stops, right? So over here we're starting to break structure upwards, and then from there on out you want to see all those discount arrays being respected again, right? So we have that fair value gap over here. The bodies of the candles are respecting this fair value gap, and you can actually see it pushes up further and further and further, and then leaving this mitigation block up here, and then price finds support over here on that mitigation block, continuing up higher. And if you can spot it, we've got that new PD array, right? That redelivered rebalanced candle here. So this area over here, doesn't go into this fair value gap anymore, right? We know now why is this a breakaway gap, right? Because there's a balanced price range over here already, and we can see price continues up higher and higher and higher, and then dipping one more time into this fair value gap to continue up, taking out all those buy stops for order pairing. Outlining that order block over here, right, where price action can go up from further. We've got that breaker block, or actually a mitigation block over here where price finds support. Another mitigation block up here, right, with a fair value gap. So we have coupled up these PDRAs with each other, highly likely to reject and then continue its way up. So we're coming up into our final lesson of the top-down analysis section. We've had that long-term perspective, intermediate-term perspective, and that short-term perspective with that bread and butter model. And now we're going to blend it all together and putting it all together. So let's put it all together, right? Long-term perspective, higher time frame, monthly, weekly, and daily charts. Intermediate term perspective, 4 hour, 1 hour, right? And then we want to do that short term perspective, 15 minutes down to the 1 minute, and we're going to see how we're going to do that. You've got this crude oil daily chart, right? So we're on our long-term perspective right now. Now look at this chart, what has happened already, right? Think back about those core concepts. We have that external to internal range liquidity, right? So draw out your premium and discount levels, right? From this high up here into this low down here. We have discount until this equilibrium level, this 50% level of the range, and we're going to be aiming from external to internal, right? So where's that internal range liquidity? We've got that daily premium fair value gap, and this is our draw on liquidity. So we know on a long-term perspective, sell stops have been liquidated already, order pairing happened down here, and now we want to draw into internal range. So draw on liquidity has been determined and sell stop rate has happened already. So now we're going to dive into that intermediate term perspective, right? You want to have your long-term perspective in line with that intermediate term perspective, so you have a higher chance of being on the right side of the market, and eventually we go into short-term perspective to see how we can enter on a trade, right? So over here we've got that 1 hour chart for oil. We know from the daily time frame we already ran those sell stops right down here. Now we're breaking back up and up. We're looking for liquidity, right? We've got this high up here, we have this high up here, and then we have that internal range liquidity for our long-term perspective, right? That's the draw on liquidity. So when does the intermediate term perspective go in line with our long-term perspective, right? We want to have that one in bullish order flow as well, because we want to go into a premium array, and for that we need a bullish order flow. So we wait for a break of structure on the 1 hour, right? So over here we've got this last swing low which has been liquidated up here, and then we have that break of structure. So we're going into a buy program from here on out. So intermediate term perspective is now in line with our long-term perspective. We can see down here we've got this discount 1 hour fair value gap, right? So we have our POI on the lower time frame, and we're going to be focusing on that 8 to 12 p.m. or 8 a.m. to 12 p.m. time window, right? That bread and butter setup. We only need to know, are we into a continuation pattern or are we in a reversal pattern? That's it. So diving in on a 5-minute time frame, what do we see over here? Take a look at this chart just for a bit and think about what we already learned in all those lessons, right? So our long-term perspective is in line with our intermediate term perspective, right? What are we going to look for next? Low resistance liquidity, right? Because we want to go into the market price where it's easy to go and not high resistance. So over here we've got this beautiful equal heights or failure swings, more failure swings over here, more failure swings over here. So once we hit that higher time frame POI, or from our intermediate term perspective, right, that 1 hour fair value gap, then we have some clear targets where we can trade into, right? So London session highs is our drawn liquidity for this chart. Draw out your New York midnight opening price as always, right? And we want to be a buyer below this opening price, and we want to be a seller above it. Important. Now we're going to go into that short-term perspective, right? We're waiting for our high probability time window, which is that 8 a.m. to 12 p.m. window, our bread and butter window. So we're aiming for a reversal, right? Because we are waiting for a drawn liquidity higher. Price action had been bearish for the longest time on the daily and now is reversing after taking out that external range liquidity, and we want to go into that internal range liquidity, which is that fair value gap on the daily time frame. Remembering back the 1 hour time frame, now we're in line, right? We have that break of structure on the 1 hour, so intermediate term perspective is in line with long term, and now we're looking at that short term perspective. Is the market giving us an ability to go up, right? We wait for that break of structure on the lower time frame too after that higher time frame target has been hit at POI. So failure swings, right, as outlined earlier, all the way above here. So a lot of buy stops resting above here. So we have clear targets for our window and we're waiting for a reversal, right? So actually from 9 to 10:30 is that sweet spot for that reversal, right? We got that 5-minute structure shift. So now we have everything in line, right? Long term, intermediate term, and then that short term perspective is in line right now too, because we're breaking structure upwards, right? So all the time frames are in line, and now this gives us the most high probability trade setup you can get. Draw out your discount arrays, right? Where do we want to enter, right? Where is it logical for price to retrace back into and then continue up? We've got this bullish order block formed over here, right? Fair value gap entered on. This is opportunity number 1, right? For an entry inside the time window, right? Still inside the time window, and draw this out in time. We still have a bullish order block formed over here, and price keeps continuing up. This is outside of our time window, but we still have not met these London session highs, so we can still draw into this London session highs. But I would keep my entry inside this time frame for consistency reasons, right? Because if you take entries outside of this time frame, right, your data may be skewed because you're taking entries outside a specific time window. So multiple entry possibilities. You could even pyramid in over here again until we reach that level. Draw out your mitigation blocks, right, from the sell side of the curve, as we learned in the core concepts, right? Those mitigation blocks over here, and are they in line with those fresh PD arrays being formed on the buy side of the curve? Yes, they are, right, because we had this bearish order block down here, which becomes a mitigation block once we go into the buy side of the curve. We've got a order block formed in line with that mitigation block. Over here, same situation, right? Mitigation block formed inside this fresh PD array, which is a fair value gap, and then keep doing this until you reach your target, which eventually is those London session highs, right? Failure swings have been liquidated and this trade is successful. Right, so over here we've got a US dollar, Canadian dollar weekly chart, right? As always, we start off with that long-term perspective, right? We go from long-term to intermediate term to short-term to frame our bias and setup. So with this long-term perspective, what did we do? We have this premium high into this discount low. Where is a premium level? We've got this fair value gap, right? So we're going from internal to external this time, right? So internal range liquidity to external range liquidity. Now, after we hit that internal range liquidity, where should your eye go, right? You've got that external range liquidity down here. And also notice, right, after we hit that fair value gap fully filled, right? Look at the expansion of that weekly candle, right? So after hitting a POI, it's highly likely to expand with more volatility. Now we want to go from internal to external range liquidity, right? And think about time frame alignment. So we're going to dive a little bit deeper into the lower time frame to see our structure form. So over here, we actually have a 4-hour structure, right? We've got a market maker sell model forming with our original consolidation down here with external range liquidity, those sell stops, right? We wait for a break of structure. So our intermediate term perspective is in line with our long-term perspective. We can see those buy stops ran up here, right? And then we form a high probability order block in the process, right? So order pairing up here for accumulation of short positions from smart money. We're breaking down structure, leaving that high probability for our order block behind. And you can go back to the core concepts about order blocks, and we use this same example right over here. So we've got a 4-hour mitigation block here. Why is this a mitigation block? Because this was a prior bullish order block, right? So we can use this old area of buying into our new area of selling, and that's where we can find another opportunity if we dive into the lower time frame. So now we're going to a 15-minute chart, right? And remember that old area of buying, right? That bullish order block to the left of our chart. We outlined that in time to the right, right? And over here, we can see a new area of selling occur. Now, what do we wait for? We either ask ourselves, is this more likely to be a continuation or a reversal, right? So what do we wait for? We wait for our time window, right? That 8 a.m. to 12 p.m. time window, that bread and butter window. Draw out your New York midnight opening price as always. Never forget this. Always draw this out on your chart. We can see accumulation of short orders above marketplace over here. And then is there any significant buy stop or sell stop ran already? And is there a new target do we have? So asking yourself, continuation or reversal, what is more likely to happen in that 8 to 12 p.m. or 8 a.m. to 12 p.m. time window is the only question you need to answer for yourself. So continuation or reversal. Why is it continuation? The weekly reached up into a premium internal range liquidity, right? That fair value gap, and we could see it draw lower later, and the market hasn't reached for that external range liquidity yet. So this is the why for a continuation. So do we have news? Yes, we have 8:30 a.m. high impact news, NFP. So if it's continuation, did London accumulate above opening price? Yes, it did, right? As we outlined earlier. And if it's continuation, what are the two options? We either have a stop hunt or we hit a premium array. So we just asked ourselves, are we doing a reversal or is it more likely to do a continuation pattern, right? So with that 8:30 high impact NFP news folder, right? Is there any significant buy stop ran over here? Not really, right? So we wait for that news folder to be released. We can see this high over here has been liquidated. 15-minute time frame stop hunt. So we have two options, right? Always look for either a stop hunt or a premium or discount array to be hit. And now we have this stop hunt and trading down back lower. And in this occasion, all up close candles should support price lower, right? So we have these up close candles up here. And you can actually see our opportunity lies after that news release, right? After that stop hunt inside this bearish order block, and we break down structure here. See, so this 15-minute time frame breaks lower, this candle breaks lower, and the next candle dips back into that bearish order block. So going into the 5-minute time frame, short-term perspective, right? Now we know long-term perspective. We go from internal range liquidity to external range liquidity on that weekly time frame. On the 4-hour, we have that high probability order block, right? Pushing price lower, and then that old area of buying, which we are in right now, which is our new selling area. So that 15-minute order block is over here, which we outlined in the previous slide, right? So that should support price lower, and then we had that break in structure, and this next 15-minute candle we can see here on the 5-minute time frame comes back into that order block and starts to distribute lower, and then this order block is supporting price lower and it just drops through it too. Now we have a breakaway gap. So why do we have a breakaway gap? Think about that new PDA, right? That redelivered rebalanced PDA. So we have a BPR down here, right? Again, because down, up, and then the next candle goes down. So we have a balanced price range up here. So this fair value gap should never get tagged anymore until we reach that external range liquidity, right? Outline all your bullish up close candles, those bearish order blocks, right? We have a bearish order block here. Price moves down, forming another bearish order block. You can see beautiful, these wicks tap into that order block and drop down further. We have another up close candle, and price is being used here as a resistance once again. Back to that 4-hour, right? We had that beautiful market maker sell model, and there are multiple opportunities to get in, right? We have those mitigation blocks where you can get in. You can get in on that high probability order block right over here, and then as long as your long-term perspective and your intermediate term perspective and your short-term perspective is in line with each other, it's tends to have a very, very high probability for a successful trade setup. And also important, right? Time, that 8 a.m. to 12 p.m. window, very important. Coming up into the last lesson of the market maker model section, we're going to be talking about the silver bullet. The silver bullet. What is the silver bullet? It's advanced market structure, and we'll show you in some charts later how that looks like. But first, what is a silver bullet? The silver bullet is the second stage of accumulation in a market maker buy model, or it is the second stage of distribution in a market maker sell model. And the hardest part for most traders is being able to identify the stages in the moment as price is printing live. So how do you know that this next leg is the silver bullet, and why is the previous high or low the low risk sell or the low risk buy in that market maker model, or as we call it, stage 1? We do not need to know the low risk buy or the low risk sell in the moment as price is printing. We know when the silver bullet is going to be forming by understanding intermediate term highs and intermediate term lows. This is all about market structure. An intermediate term high is a high that has a short term high to the left of it and to the right of it. And an intermediate term low is a low that has a short term low to the left of it and a short term low to the right of it. So the intermediate term high or the intermediate term low is where you place your stop loss. That's the high or low in the structure you don't want to see get violated. There are two ways to trade the silver bullet. Trading after a confirmed intermediate term high or intermediate term low has formed, so it has a short term high or low to the left and a short term high or low to the right of it, or we're going to anticipate that intermediate term high forming and trading that short term high or short term low that will be forming next to it. So over here we got a crude depiction of how a market maker model looks like. We got that again original consolidation up here, right? And then hitting a key level once again where the smart money reversal should occur. Now breaking structure up here, and then the first area over here, that is the low risk buy in a market maker buy model. We're not looking for this, we're looking for that second stage of accumulation in this market maker buy model. So looking at all the lows and highs being formed around in this area, we can see this is a long-term low. Now why is this a long-term low? It's the extreme low in this whole range, and it has a short-term low to the left of it and a short-term low to the right of it. So this is a short-term low. Now once we start to break up further, there will be more short-term lows being formed in that whole range moving up, and we are waiting for that short-term low after the low risk buy to get rated, and then we form that intermediate term low. So we expect price not to exceed this intermediate term low once again. We call that a protected low. So in anticipation of that intermediate term low forming, we can see the second stage of distribution forms after we form that intermediate term low. So essentially you're going from this external range liquidity, right, this short-term low getting rated into another price leg up, and inside this another price leg up we anticipate a short-term low forming, which is the silver bullet, right? So this is an entry model for second stage of the distribution or accumulation phase. Referring back to the other lessons, right, mitigation blocks, we can use all those techniques to solidify our trade idea where that short-term low should form. We've got that mitigation block on the sell side of the curve, extending it out in time, right, to the buy side of the curve. We see this intermediate term low forming, and it is only an intermediate term low once we form a short-term low to the right of it, right? So we need to have a short-term low to the left of it and then a short-term low to the right of it. And this is the silver bullet entry model and second stage of accumulation. So this is option number 1, anticipating that short-term low to form next to that intermediate term low. So this is option number 2, right? And this is, we're waiting for that intermediate term low to be confirmed. So we need to see that short-term low to the left of it and that short-term low to the right of it, and then we have a confirmed low. So over here, same sort of depiction, only slightly different market structure, right? We've got these equal highs getting rated, but we also have these equal lows down here, which are short-term lows, and we're expecting that intermediate term low to form below this short-term lows after that smart money reversal. And remember that smart money reversal needs to happen in a discount array. Sell side of the curve, smart money reversal and forming that long-term low, right? Because this is the extreme low in this whole range. Short-term low to the left, short-term low to the right, and that intermediate term low forming will be inside OTE levels of this range, right? So intermediate term low has been confirmed after we form another short-term low to the right of it, right? So then this is accumulation phase 1 because this is now the low risk buy. And in the previous schematic we saw price action drop into this area over here, creating the low risk buy already and then continuing up, and then we wait for that intermediate term low, right? But over here that low risk buy is in fact that intermediate term low. So remember, you need to have a short term low to the left of it and a short term low to the right of it. Accumulation phase number 1 happens over here, then we expand higher again, and then the silver bullet is forming, which is the second stage of accumulation. Again, thinking back about order pairing, thinking back about mitigation blocks and that kind of techniques, right? We can use that mitigation block once again. So this could be a bearish order block, right? We violate that bearish order block, and once price trades back into it, we can use it as a mitigation block to offload those short positions and go into long positions from smart money and completing that market maker buy model above that original consolidation. Now for a sell model, same thing, only inversed, right? We've got that original consolidation to the bottom over here, going into buy side of the curve, and we need to hit a key level, right? So smart money reversal over here, dropping below this market structure low, creating a break of structure, low risk sell occurs over here, and then we go into the first distribution phase. Now we need to see an intermediate term high form, right? Because we're on sell side of the curve. So what do we need to have? We need a short term high to the left of it and a short term high to the right of it. Right? So low risk sell, short term high, another short term high is formed, and then that intermediate term high is being formed. We could have a bearish order block inside this price leg up over here, and that makes sense that this high will hold, right? And this is option number 1, right? We anticipate this short term high forming over here. So our entry is in anticipation of that short term high forming to the right of it, right? Looking at it from a different perspective, option number 2. Again, we drop lower, breaking structure after that smart money reversal, right? Short-term high to the left, long-term high, and then another short-term high to the right of it. Now we need to wait for that intermediate term high to be formed. We wait for a rate on liquidity of those short-term highs, which happens over here, right? So now we wait for a short-term high to get created to the right side of it. So we have one on the left side and one on the right side, creating this intermediate term high, and then distribution phase 1 happens, and then breaking down lower, and here is where the silver bullet forms, right? Again, think about those mitigation blocks, right? There could be a bullish order block over here, which is violated, and then price trades back into that, creating that mitigation block to offload those long positions from smart money into sell positions and creating a down move which will liquidate that original consolidation. Here another schematic, and then that mitigation block happening a little bit earlier, right? So you have multiple areas of mitigation blocks, right? We use those bullish order blocks on the buy side of the curve and extend them out to the sell side of the curve. So over here we've got that intermediate term high forming around that mitigation block, and once it breaks lower, that short term high forms inside that mitigation block, making it a very high probable silver bullet setup. So the second stage won't form this way every single time. However, the majority of the time it will. So if you stick to this rule, you will see a lot of success in identifying and trading it. When you see this structure form at the highs when bearish or at the lows when bullish, at a key level, importantly, and you are using time frame alignment, it's very, very likely that the market is and has turned and is looking for the opposing liquidity or discount and premium levels. Right, so we got a Australian dollar, US dollar daily chart, right? Again, keep in mind every time, right? External range liquidity into internal range liquidity. We rate this external range liquidity old daily high. Where does your eye go to, right? We have an imbalance down here. So our draw on liquidity is down here. So now we know this high over here is unlikely to get traded into again, and our next draw on liquidity is to fill up an imbalance or reprice into a fair value gap, right? Because the algorithm only does two things, which is running old highs and lows, right? And repricing into imbalances and inefficiencies. Now we see this big daily candle completely filling up this fair value gap on the daily time frame. Now we drop down into a 1 hour chart, right? How are we going to identify where to get in, right? We wait for that intermediate term high to form, right? And then we look for that silver bullet setup. So look at this chart for a bit and see if you can spot the silver bullet. Right, now let's look at market structure, right? What do we need? We need a long-term high above an old high, right? We need that smart money reversal. So we have a short-term high here, long-term high here, short-term high here, right? And now we wait for that intermediate term high to be formed. So how does that look like? Right, smart money reversal above that old high, breaking down lower. And what do we have down here, right? Low resistance liquidity or engineered liquidity. So our drawn liquidity gets better every time when they engineer liquidity on the sell side. Price trades back up into OTE levels or premium level of this range, right? Creating that low risk sell, forming another distribution phase, dropping lower, and then the silver bullet is the second stage of distribution and it forms over here. Now let's look at the different highs, right? We have a short-term high here, long-term high here, short-term high to the right of it. Now we need to wait for that intermediate term high, which is forming above over here, right? And now we need a short-term high to the right of it, which is over here. And this is what it looks like, that intermediate term high, which is also the low risk sell in this occasion, right? So we don't get in over here because we waiting for that short-term high to be formed, right? Which is over here, and then price drops down lower, and now the silver bullet is activated in the second stage of distribution. Now we're looking for a mitigation block, right? Or a breaker block. We use those bullish order blocks from the buy side of the curve and extend them out in time, right? And use them on the sell side of the curve. And we can see over here we got this breaker and mitigation block which is being tapped into. You could use this one, you could use the wick of this one too. This is overlapping and it's high probable that the silver bullet will form over here, which is another short-term high, right? Continuing down and filling up that daily fair value gap, which is the draw on liquidity. So we got gold futures chart over here. Again, external into internal, right? Keep that in mind. Order pairing. We've got these buy stops being liquidated up here. Bearish order blocks being respected. Another one over here. Now let's look at market structure. Diving into that 3-minute time frame, right? So we're going into time frame alignment. This time we used a 30-minute order block and we're going into a 3-minute time frame to see if we can spot that silver bullet setup. So we have this market maker sell model formed over here. Sell side liquidity over here. We know the draw is bearish. Price keeps going up and up and up until we go into that higher time frame POI, which is that 30-minute order block, right? Market structure shift to the downside over here. And now we need to wait for that intermediate term high to form. And this time we're going to anticipate a short-term high forming next to it, and that will be our silver bullet. Right? Smart money reversal, again in a logical key level, breaking down structure, distribution phase number 1, breaking down further, and then the silver bullet will form. Annotating market structure, short-term high to the left of it, and in that smart money reversal we got that long-term high, right? So short-term high to the left and a short-term high to the left of it. Then we have that long-term high and then a short-term high to the right of it, which is in this occasion the low risk sell. Now we're breaking down structure, confirming sell side of the curve, right? Then forming distribution phases over here. Outlining some more structure, right? We have this swing high over here. Now we wait for this swing high to get rated and dropping down further and anticipating this to be an intermediate term high. So immediately our stop loss could be above here once we look for that second stage of distribution, right? That silver bullet setup. Price drops down lower, lower, lower. sell side liquidity is still intact, right? So our draw on liquidity is still present. We wait for price to go back into a PDRA, which in this case is a fair value gap over here, right? It's going into a premium level from this range high to this range low, so that makes sense. And the silver bullet is being formed over here, outlining that mitigation block over here, right? We use those bullish order blocks on the buy side of the curve, extend them out to the sell side of the curve. Is there a fresh PDRA formed over here? Yes, there is, right? We've got this fair value gap, and price dips into that fair value gap and declines, completing that sell side liquidity. Right, so we've got a crude oil 4-hour chart, and we're going to be looking in anticipation of an intermediate term low forming in this market maker buy model, right? So what do we have over here? We've got a key level, right? A fair value gap in discount from this range high to this range low. We see we are respecting it and continuing up, leaving behind low resistance liquidity, right? So our eye should immediately go here for the drawn liquidity. Price retraces back into that 4-hour order block, and now we can use time frame alignment, right? 4-hour PDRA into a 15-minute market maker buy model, and let's dive in a lower time frame to see what that looks like. So smart money reversal happens over here in that higher time frame POI, right? We've got that 4-hour order block. We've formed a market structure shift up here, low risk buy down here, and then the first stage of accumulation is happening in the next PDRA, which is this fair value gap, continuing up, and then we're anticipating this to be the intermediate term low, right? Because the silver bullet is the second stage of accumulation, and now we're anticipating this low to be the intermediate term low. So our silver bullet setup will be a short-term low to the right of it, right? And we need to wait for it to decline into discount and use a fair value gap as an entry. So if I go over here, we can outline those short-term lows, long-term lows, and intermediate term lows in the next slide. But we've got that short-term low down here, right? On that smart money reversal, again, on a key level, important. Long-term low down here, because we have a short-term low to the left of it, and a short-term low to the right of it. Bullish order block, supporting price, pushing up, breaking market structure. This is called a low risk buy, right, for smart money. But for us, it's not a low risk buy because it's actually a little bit higher risk for us because we don't know if market structure shift will happen. That's why we wait for that market structure shift. And this whole silver bullet setup is a very solid entry model. We anticipate this low being formed, being the intermediate term low. Why? Because we take out this short term low, right? And then creating another short term low to the right of it. Now marking out your PDRAs, right, mitigation blocks, breaker blocks, and then premium and discount levels. We've got that bearish order block over here, which is being used to the buy side of the curve, right? So now it's a mitigation block or a breaker block because we took sell side liquidity down here. Is there a PDRA formed inside this mitigation or breaker block? Yes, there is, right? Because we have that order block up here, and then a fair value gap combination also. So we have a lot of confluences in this area to anticipate this being the intermediate term low, and the silver bullet setup will be this short term low to the right of it. And then you can see price is very willing to continue up higher and complete that market maker buy model. Right, so over here we've got an E-mini S&P 500 futures chart on a 30-minute. We've got these clean buy stops formed over here, and sell stops have been rated, right? So we've had external range liquidity been taken. We're starting to move up into buy side of the curve, and now we're going to look at a confirmed intermediate term low, right? And we'll dive into the lower time frame for this. We've got this BPR over here, right? That PDRA, that redelivered rebalance PDRA. The price is rejecting off that. So again, going into buy side of the curve after hitting a key level, right? That key level over here was the 30-minute BPR or redelivered rebalance PDRA. We're in a 3-minute chart right now, so we're doing time frame alignment once again, right? Higher time frame PDRA into a lower time frame market maker model. So price is trading up higher right here, continuing up and then forming a short-term low here, and we see this getting rated. So what is this low? Low risk buy, right? But also we have an intermediate term low formed down here. Why? Because we have that short-term low to the left of it, right? And that short-term low to the right of it. Now this is confirmed, right? Instead of anticipating and taking an entry on this short-term low, now we wait for this intermediate term low to be formed and then go into second stage of distribution, which is over here, and that will be the silver bullet setup. So where do you get in? Again, we have that BPR, right? Just like that on the 30-minute time frame, that redelivered, rebalanced PD array. Same thing over here. We have that up, down, and then the next candle up, right? And then we can outline this gap over here, leaving a breakaway gap too over here, because we don't need to go into this fair value gap once there is a BPR formed above it, right? So we have this mitigation block on the left side, right, on the sell side of the curve, which would be a bearish breaker. That would be a bearish order block over here, right, extended out to the buy side of the curve. Now it's overlapping with a new PD array. So again, layering all those confluences, looking at market structure. Do we have an intermediate term low? Yes, we do, right? So ideally, you can take an entry here. If you're very conservative, you can put your stop loss below the intermediate term low, because that for sure should not get rated. But after we already did this entry in this short-term low, I think it would be solid to just have our stop loss below this fair value gap, which should be a breakaway gap anyway, and that would be a very good risk to reward trade. Silver bullet, short-term low. We've arrived at the last section of the mentorship, ladies and gentlemen, models and risk management. Now we went over core concepts, right? Our foundation of this mentorship. Then we went into those market maker models with time frame alignment, very important. We know how to trade the buy side and the sell side of the curve with this, and wrapped it up with that top-down analysis, right? That long-term, intermediate term, and short-term perspective to finish off the complete model. So we're going to talk about that universal model right now. Let's get into this lesson. This universal model is statistically the highest probability bread and butter model, guys. So universal for weekly range traders, so swing traders, right? We have those models for intraday traders and even scalpers, because we know price is fractal and it works on all time frames. It is universal for all kill zones. We can use the New York kill zone, the London kill zone, and even the Asia kill zone. And it is universal for all asset classes. However, kill zones can vary depending on the asset class. It works on Forex, it works on index futures, it works on stocks, and it even works on crypto. The MMXMs traders model. So we're going to go over a few points on this. We've got that premium and discount levels, right? The PD arrays, external and internal range liquidity, and the relationship between them. Then relative strength analysis. This is optional, but it will increase your probabilities. Then continuation purge, so a buy program or a sell program activation. Then time frame alignment with the market maker models, right? Down or up close candles will now support price, and PD arrays in line with the draw should hold. And then eventually premium and discount of the range, and that mitigation blocks for pyramiding your trades. So let's start off with time frame perspectives, right? That long-term, intermediate term, and short-term perspective. Reiterating again that long-term perspective is the why price should go where it is going, right? And think about that external to internal range and internal to external range, right? Then intermediate term perspective, this is how price should get there, right? We want to line up all these perspectives together so they are high probability. And then that short-term perspective, that's our entry and our trade execution idea. So again, long-term perspective, draw on liquidity and higher time frame PD arrays. Intermediate term perspective, structure and continuation purge. And then on that short-term perspective, we got those market maker models and your entry. The long-term perspective, intermediate perspective, and short-term perspective timeframes are going to vary depending on the trading style you're using between a scalper, intraday, or a weekly or swing trader. So building back on those time frame perspectives, on an intermediate term perspective or an ITP, external to internal range liquidity is the most forgiving, because even if you have a wrong bias, price can draw to internal range liquidity before going into the opposite direction. So you can be wrong about your bias and still make money, whereas trades framed from internal range liquidity require a stronger bias. So first of all, we're going to talk about that swing trader, right? That weekly range trader. We've got our long-term perspective where we'll use the monthly time frame, and we can also use the weekly time frame if the monthly is not clear enough, and this will be our drawn liquidity and our higher time frame PDRAs. Then we're going to go to that intermediate term perspective, right? We're going to use our daily structure and continuation purge, and then on the short term perspective, we're going to use a 1 hour market maker model and entry technique. Psychological profile for that weekly range trader or swing trader. You prefer to hold your trades for the weekly range. You can hold trades overnight or even multiple days, which means you are a patient person, right? If you cannot spend too much time on the charts, this is a better profile for you. So over here we got that Euro Canadian dollar monthly chart, right? We're going with that weekly range trader, that higher time frame, aka swing trader. And just take a look at this chart right now. What do we see? First of all, we're going to think about external and internal range, right? Where is external range liquidity been taken, right? We've got this low down here, extended out in time, and we see the purge on sell side liquidity over here, which means from external we go to internal, and we have our draw on liquidity, right? We want to draw into this internal range monthly fair value gap. This is where our eye goes to, and this is where our bias is for the draw on liquidity. So that monthly fair value gap draw. Going in from long-term perspective, right? Think about those time frame alignments. We're going to go to our intermediate term perspective, which on this occasion is the daily time frame, right? Because we're swing traders. So we want to have our daily time frame in line with our long-term perspective, which is that monthly draw on liquidity. So we're waiting for this buy side, this sell side liquidity to get liquidated, right? And going into a buy program. And what does that look like? Right, we need to wait for those sell stops to get purged, which happens down here, and then before we get in line with our long-term perspective, we want to see a break in market structure, which happens over here, right? So furthermore, we know we are in a buy program starting from here, bullish order flow on the daily time frame. Our intermediate term perspective is in line with our long-term perspective, and now we can look for continuation trades and even continuation purges, which means it will take out sell side liquidity and continue up into buy side liquidity. This is our intermediate term perspective, right? So in this area over here lies our opportunities once we go in our short term perspective, and our short term perspective in this occasion is the 1 hour time frame. So over here we got the Euro Canadian dollar 1 hour chart, right? We're gonna go over what we see over here. We got that market maker buy model, right? We start off with that original consolidation, then we have accumulation phase 1, accumulation phase 2, and what do we need to wait for before we go into buy side of the curve? We want to hit a higher time frame PDRA, right? So we need to wait either for sell side liquidity to get purged or hit a higher time frame PDRA, which could be a fair value gap or an order block, for example. Now we see this purge on liquidity, right, on that daily time frame, that long wick we saw in those previous slides. Now after this we have a buy program activated, right? So we wait for our short-term perspective to be in line with all our other perspectives, like that long-term perspective into that monthly fair value gap, right? And then our daily structure into that bullish order flow, and now our 1 hour time frame breaks structure too, and we can be confident all time frames are aligned and we can go look for a buy setup. So where do we look for? We outline our premium discount, right? We outline our PDRAs, and how does that look like? So over here we outline that 1 hour order block right after that break of structure. This is a very good area to get in on a trade, and remember we are swing traders, right? So we can hold our trades a couple of days, so we can enter on that order block and sit in this trade for 1 or even 2 days before we hit our target. And we can see over here we've got a first opportunity to get in on this order block after that break of structure. Now there is a second opportunity to get in, and think about that new PDRA, right? That redelivered rebalance PDRA, that BPR, so a balanced price range, right? Because we have this candle go up, go down, and then the next candle going up once again, creating a balanced price range over here. and thus creating a breakaway gap, right? So now we know why there are breakaway gaps. A big order block has been formed over here, right? All these consecutive down close candles is a bullish order block, and once we trade above it, we can use this one again as a support, right? Because all down close candles should support price up when we are in a buy program. So back to the daily time frame, right? First of all, we had the sell stop rate into a break of structure, then that daily continuation purge over here, and then we have another daily continuation purge over here, which makes for another opportunity on our lower time frames. So back to the 1 hour, right? And this is the second stage of that daily continuation purge. So we had one occasion first, now we're going to the second one. Again, market maker buy model on your short-term perspective, right? So original consolidation up here, accumulation phase number 1 over here, accumulation phase 2, and even a third accumulation phase until we purge that sell side liquidity, right? Now we want to see a buy program activated after we purge that sell side liquidity. So buy program activated, right? Below an old low. We've got that break of structure. And now what we're going to do, think about previous lessons, right? We're looking for low resistance liquidity, failure swings, right? Over here, failure swings up here, and then eventually failure swing up there. So all engineered liquidity on sell side of the curve, right? And then we're going to use those mitigation blocks from the sell side of the curve, outline them in time to the right, and we can use that with fresh discount arrays, price can trade up higher, right? So outlining those mitigation blocks from the sell side of the curve, extend them out in time, and you can see clearly after that break of structure, every down close candle should support price up higher, right? Because we're in a buy program after clearing those sell stops. Now we use from the sell side of the curve, we use those mitigation blocks. We've got an order block over here, price supports it higher. Another order block formed in line with that mitigation block, right? That is making it even higher probability, and then price keeps climbing up and up and up. Eventually we purge these highs, so we can have another accumulation phase, right? Price is not going from one low to a high in one motion. You have those market cycles, remember? You have that expansion, consolidation, and then another expansion again, right? So this mitigation block over here, extend it out in time, and we start to accumulate on top of it on that order block, and eventually we're reaching up higher into here, taking out external range liquidity. We've got a breaker block formed here. Why is it a breaker block? Right, because we take out sell side liquidity before we break up higher, so that's called a breaker block. Price finds support over here and eventually clears this 1 hour market maker buy model. Adding premium and discount arrays once again, right? We want to go from discount into premium and vice versa. So all these entries down here were the most high probable entries. As soon as we go above premium, it starts to decline in probabilities, but if that market maker buy model is still intact, there's still opportunity to get in, even up here in 75% of the range, right? Ideally, you want to get in down here, down here, or down here, which is still in discount, right? But there's another opportunity here with this breaker block. Right, so over here we've got a Euro USD monthly chart, right? Let's see what is happening over here. What is the current order flow? What is the premium and discount levels, right? So let's outline those premium and discount levels first. We're coming from discount, right? From this low, and we're entering premium levels over here. Now, does it make sense we go down from here, right? We're looking for mitigation blocks. We've got this monthly premium mitigation block in line with this area over here. What do we have over here? Again, right, that redelivered, rebalanced PD array, right, down, up, next candle down. We can see this area is balanced already, so no need to go up higher if we are bearish. So we can see this rejection, and it is in line also with this mitigation block. So long-term perspective, we are bearish, right? So going into our intermediate term perspective, we can see this monthly premium mitigation block from the previous slide, right, extended out in time, and we can actually see price action is starting to break down. And how does that look like? Right, external range liquidity has been taken, so we go from external back to internal. And where is our internal range liquidity? In discount, right? We've got these fair value gaps down here and even down here. So after that break of structure over here, right, we can see this internal range liquidity is our draw, and we can even see this high being purged over here, which is a daily continuation purge. right? So over here, this is where our opportunity lies on the short-term perspective, because we have a intermediate term high potentially forming over here, which should not get rated anymore, right? Think about that market structure. And then in the lower time frames, the short-term perspective, we can find our setup. So right now we're on our intermediate term perspective, right? And we have that in line with our long-term perspective. Once you trade below here, we have that 1 hour market maker sell model completed, and let's look at how that looks on the 1 hour time frame. So over here we got that 1 hour Euro USD chart, right? Market maker sell model is forming, right? Over here, that daily continuation purge. So we have a sell program activated, right? And once that sell program is activated, all up close candles will now support price lower. So all bearish PDRAs should also hold and bullish PDRAs should fail, right? So start off with our market maker buy model, or market maker sell model rather, right? We've got that original consolidation, and then we hit that external range, and then we want to go down back into internal at least, which is over here. And this is why sometimes if your bias is incorrect, if you wait from external to internal, it's more forgiving, right? Because we know price is more likely to draw into discount first. And even if we draw into here and we start to go up again, if you find an entry from up here or even up here and you can draw into here, you can make money, as opposed if you're waiting for this POI to get hit, right, and then try to trade external again, that you need to have a real clear bias. So over here we see a break of structure, right? Sell program has been activated because we went into external range liquidity. Order pairing happened up here, right? Those buy stops have been paired up with sell orders from smart money. Now we're breaking down and we can find an opportunity. And remember, all up close candles should now support price lower. So over here we've got this BPR, right? This redelivered rebalance PDRA once again. This up close candle should support price lower, which it does, right? We hit it over here. This BPR is being respected, and that is an opportunity to get in on a sell trade. Another set of up close candles over here. This is a bearish order block once again with a fair value gap, so making it even higher probability, right? We tap that order block slash fair value gap combination over here, and we start to decline even further. What do we form over here? Another order block, right? All up close candles should support price lower, which it does, right? We still have not completed the market maker sell model down here, right? Because we are not trading below this external range yet. Price turns back into premium once more into that bearish order block, and then finally we purge that market maker sell model and continuation lower. Next up, we're going to be talking about intraday traders. So now our long-term perspective will be the weekly or the daily chart for our draw on liquidity and higher time frame PDRAs. Our intermediate term perspective will be 1 hour structure and then continuation purges. And our short-term perspective is going to be on the 5-minute time frame, where we look for our market maker models and entry execution. Psychological profile for intraday traders. You can hold 1 or 2 sessions or hourly targets. You can hold trades for about 3 to 5 hours, and you prefer to be in and out on the same day. And personally, I like to be an intraday trader. We've got this British pound, Japanese yen weekly chart, right? Have a little look, where are we going and where are we coming from? Why? This is the why, right? The long-term perspective. So if you saw that external range liquidity being taken, right, to the left of here, we've got that external range purge. So where do you see your eye go after external? We know this, we go to internal range, right? So we want to go to internal range liquidity, which is this fair value gap on the weekly time frame. So after we take this buy stops, our bias and draw on liquidity for the long-term perspective will be that weekly fair value gap. Now, how does that look like on an intermediate term perspective? We want to be in line with the long-term perspective, right? Our intermediate term perspective needs to go bearish too, so we need to wait for a 4-hour market structure break. Our range high from up here after that buy stop rate until these lows down here, right? We are in premium over here. So after that 4-hour market structure break, we're also leaving a fair value gap behind, which could be an opportunity to get into a sell, right? So after that market structure shift on the 4-hour, our intermediate term perspective is in line with our long-term perspective, right? So now we wait for that continuation purge to get in, right? This turtle soup over here. So from here on out, we can have a sell program activated, right? And we can see that on our lower time frame, and we'll be using a 15-minute time frame in this occasion. The market maker model on the 15-minute starts down from this low, right? So from external back to internal range. And again, reiterating, right? If you have external to internal, it's more forgiving, because even if the bias is wrong, you can still get into that discount level. So we got that 15-minute time frame over here. So now we're on that short-term perspective, right? So we had that long-term draw on liquidity. We had that 4-hour being in line with our bias from the long-term. And now we wait for that purge on the 4-hour, which happened over here, right? As soon as this gets stop hunted, what do we get? We get a sell program activated, right? So now after this purge on liquidity, all up close candles will now support price lower, and the bearish PDA should be respected and the bullish PDA should fail, right? So we have this market maker sell model formed over here. So all time frames are aligned. We wait for that break of structure, short-term perspective, right? Over here. Then draw out your premium and discount levels, right? From this high down into this low. If we want to return back into premium, we have to wait to go above this 0.5 line, this 50% line, right? Over here. And then continuation lower. And if you think back about the previous lessons, think about the silver bullet. Can you spot it over here? We will still outline it, of course, with annotations, but first of all, first stage of distribution happening over here, right? In this breaker block, coupled up with this bearish order block now, and price is continuing down lower into a second stage of distribution, right? Forming another breaker. Why is this a breaker? Because we are rating buy side liquidity over here, right? Does it make sense? Yes, it's a high resistance liquidity run. Remember, that's against our order flow. So we're gonna go for all those lows down here, those failure swings, right? Low resistance liquidity. And then we form a BPR over here. So what do we have above that BPR? Breakaway gap, right? Because now we know that PDA, that redelivered, rebalanced PDA over here, make sure we don't have any more price action coming up in here, thus leaving a breakaway gap. Now, can you spot that silver bullet? Premium and discount again, and then in the right time frame, right? We're gonna talk about this a little bit, right? Short-term perspective, bread and butter setup happens in New York kill zone, right? The highest probability setup between 8 a.m. and 12 p.m. and we have a continuation profile, right? Because we already took out buy stops, right? This is important. And now all up close candles support price for going lower, and we can get in either on distribution phase number 1, or we can get in on that silver bullet, right? That distribution phase number 2, and wait for that intermediate term high to be formed. So can you spot that intermediate term high, right? This one over here. It's a high resistance liquidity run. We have a short-term high to the left of it, and then a short-term high to the right of it, thus creating that silver bullet, right? Here outlining it again with annotations. Low risk sell happens over here, right? The first return back into that premium level, then short-term high formed over here. This is an intermediate term high after we form another short-term high to the right of it, right? But with the silver bullet, we can get in on this redelivered, rebalanced PDA. So second stage of distribution, silver bullet, perfect entry over here. You could have entered on this order block too, right? But this here is the silver bullet. Another way to make it even more clear, right? We can outline our mitigation blocks from the buy side of the curve, extend them out in time to the sell side of the curve, and then we wait for those fresh PDAs to get formed, right? So we have, for instance, over here we have a fair value gap formed inside this mitigation block. Over here we had this mitigation block from the buy side of the curve, now having a bearish order block over here, and then the same over here we have that BPR formed around this mitigation block, and we can say this is the silver bullet and it is high probability because it's lining up with those mitigation blocks. We got a British pound Australian dollar daily chart, right? We're on our long-term perspective, and we're not going to talk about the New York session this time. We're going to talk about Asia session and London session. Why? Because it will show that this model is universal, right? We are talking about a universal model. So what is our long-term perspective, right? What did we do over here? Let's zoom in a little bit. We got our discount into premium range, right? So what happened prior to this up move? We got that external range liquidity purge, right? Old low sell stops. Now, where does your eye go immediately? Once again to internal, right? Every time external to internal, internal to external, right? So we got that daily fair value gap as our draw on liquidity. Now we have our long-term perspective established. Let's go to our intermediate term perspective. So if we trade a daily time frame as our long-term perspective, we have a 1-hour chart as our intermediate term perspective, right? So we need to wait for a break of structure on our intermediate term perspective, which is that 1-hour chart. Over here we've got some swing low purges, right? So same with the swing traders waiting for a daily continuation purge. Over here we wait for a 1-hour continuation purge of a swing low or a swing high, and in this occasion we wait for a swing low purge because we are bullish, right? Our drawn liquidity is that fair value gap on the daily. So we got two different kill zones, so we'll zoom in on both of them to see that this model is universal. So let's first off start with London kill zone, right? So we wait for that intermediate term perspective purge, right? That 1-hour swing low purge. It happens down here. We wait for time, right? London kill zone, 2 a.m. to 5 a.m. What is our drawn liquidity? We are waiting for this 5-minute market maker buy model to go into buy side of the curve, right? So original consolidation has been established to the left side of this curve, sell side of the curve, until we take out this swing low, right? This 1-hour liquidity purge on the sell side. Then waiting for a break of structure as always, and our buy program has been activated. Now when a buy program is activated, all down close candles should now support price higher, right? And all bullish PDRAs should hold and all bearish PDRAs should fail. So over here, break of structure, right? First indication we're going into a buy program, then a very solid break of structure up here. And remember about that low resistance liquidity, right? We're looking for failure swings and equal highs and equal lows. So we're going into buy side of the curve. Now let's outline our PDRAs. We've got this whole set of down close candles being a bullish order block, right? So we're in a buy program, so all down close candles should support price up higher, right? And this is the highest probability order block, right? Because we take out sell side liquidity and break up structure afterwards. So you shouldn't frame your trades on these down close candles down here, right? Because we're still not leaving this area. And then until we do leave this area up here and higher, then we can use the other down close candles, right? So that's a London session trade. Now let's focus in on that Asian session, which this universal model should work on too, right? So again, 1-hour swing low, that liquidity purge, right? So after we have a liquidity purge on the sell side, our buy side of the curve is activated and we have a buy program, right? So over here, buy program has been activated below this low. So again, all down close candles should support price up higher afterwards, right? We break structure and then we look for our setups. So bullish order block in our kill zone, important, right? We need to stay in our kill zone. Over here, bullish order block. We've got a OTE retracement too. So take your Fibonacci from this low to this high, and we see we hit that sweet spot, that 0.705 level perfectly, and then we continue up into our drawn liquidity. So the drawn liquidity is still from our long-term perspective, right? The why should price go there, right? We already did external on our higher time frame. Now we're going to go to internal, and that is still our drawn liquidity until we reach it. So now we went over that Asian session kill zone, right? That OTE entry over here and this order block supporting price to go up higher. We still have that engineered buy side liquidity, right? Because we had that failure swing up here, right? Because this high is still not taken out. So price goes back down, back into discount, right? Because at this low to this high, so from this premium high to this discount low, we wait for price to get in our discount levels, which is over here. We've got this beautiful 5-minute fair value gap in discount. Does it line up with our kill zone? Over here, not yet, but price dips in one more time at the start of the kill zone and even comes back one more time around 4 a.m. to continue up higher. You could have gotten in at the start of the kill zone, right? And then a partial above, buy side liquidity is always smart to do, and it even comes back one more time around 4 a.m. to continue up and reach our long-term perspective target, right? That drawn liquidity, the daily fair value gap. With the market maker models, we're outlining those mitigation blocks once again to make it even more clear, right? We want those discount fair value gaps, those discount order blocks to form in our mitigation blocks from the sell side of the curve. So sell side of the curve, we've got this mitigation block after that break of structure, right? So our mitigation block is in line with that order block inside our time zone, right? Inside our kill zone. So that's a high probability entry. Then again over here, there should be a bearish order block, right? But now it's being used as a mitigation or breaker block on the buy side of the curve, and then we had that 5-minute fair value gap formed inside our kill zone, and then price continues up, completing that failure swing, taking out buy side liquidity, and eventually going into the daily fair value gap, which is internal range, right? So wrapping up that universal model, now we're going to talk about those scalpers, right? So it's all fractal, time is fractal. The swing traders use those monthly and weekly charts. The scalpers use that 4-hour chart as their higher time frame. So our long-term perspective is going to be the 4-hour time frame, but we can also use the daily time frame when the 4-hour is not clear enough. And we'll use this again as our drawn liquidity and our higher time frame PD array. Then we're going to intermediate term perspective once again, and this time we'll use a 50-minute structure and continuation purge, and then our short-term perspective or entry model is going to be on that 1-minute market maker model and entry. Psychological profile for a scalper: we cannot hold trades for very long. We tend to panic and close 5-minute entries too early, right? Prefers to be in and out within the session or within a couple of hours, and is impatient. And there's nothing wrong with having this psychological profile. It all depends on your personality. Me personally, I cannot hold trades for weeks or days, right? But I'm also not a scalper, so everybody has a different personality. Right, our long-term perspective, we're going to use that 4-hour time frame. We've got a British pound US dollar chart, right? First of all, where are we coming from and where are we going? We have to ask the why, right? Long-term perspective. So we've got all these failure swings down here. So we have a clear draw on liquidity, right? Do we have a external range liquidity purge? Yes, we do, right? We've got this purge over here on our long-term perspective. So now what do we want to do after we go external? We want to go internal, right? So we got that break of market structure down here. We have this fair value gap down here. So even if it does not trade lower and lower, there's an opportunity down here. And even this purge up here, we can look for more opportunities. And we have another purge down here until we reach those low resistance liquidity runs down here, right? Those failure swings. So where's that 4-hour turtle soup happening? That external range liquidity rate. We've got one over here, and we'll zoom in and look how that looks on the intermediate term perspective. So now we're diving into our intermediate term perspective, right? And with our intermediate term perspective, we want to be in line with our long-term perspective, which is a draw lower, right? Our draw on liquidity is lower. So we can see this liquidity purge up here. So we're going from external back to internal, right? We wait for a market structure shift. So our intermediate term perspective is in line with our long-term perspective. We can see initial break of structure happens here, and this market structure break solidifies this bearish order flow, right? So over here, we're trading lower and lower and lower. Still not hitting that drawn liquidity, right? So now we wait for what? A 15-minute purge on buy side liquidity, right? We look at these highs over here, relative equal, right? This is low resistance liquidity. So we want to see this go before we want to trade lower. So we have that 15-minute continuation purge. And now it's time to go in that short-term perspective, right? We're going to use a 1-minute time frame to look for our entry setup. Market maker sell model will be in this area over here, right? From this range low to this range high, because we purged that 15-minute time frame over here. And we're going to dive into the 1-minute time frame and see how that looks like. So we got that 1-minute time frame over here. M15. 15-minute time frame continuation purge, right? It is all fractal instead of a 4-hour purge or a daily purge. Now we're looking at that 15-minute purge because we are scalpers, right? Again, market maker sell model is completed once we take out this original consolidation and that sell side liquidity down here. outline that original consolidation, accumulation phase number 1, accumulation phase number 2, and smart money reversal up here. So what happens after we take that external range liquidity? We are now activating a sell program. So again, all up close candles will now support price lower. Bearish PDA should hold and the bullish PDA should fail, and then we are in sell side of the curve, right? So we're waiting for that break of structure on our short-term perspective. It happens over here. We want to be in the correct time zone, right? I'm gonna outline that later, but we want to be, as I can see down here, we are in New York kill zone, right? So all up close candles should now support price lower, and we can see that over here. Bullish candles over here are now a bearish order block. Another bearish order block here with a fair value gap. Another bearish order block. Another one, and lastly here we got that fair value gap again, and keeps declining lower and lower and lower, and you can see all up close candles are supporting price to go lower. We're gonna once again use those mitigation blocks right from the buy side of the curve, extend them out in time to the sell side of the curve, making it higher probability, right? We want to see those fresh PD arrays form on those mitigation blocks from the other side of the curve, which happens over here, right? We've got that mitigation block from the buy side of the curve, which would be a bullish order block in this occasion until we go into external. Now we extend it out in time to the right. We've got that fair value gap here with that order block, and you can see price is neatly going down and respecting those areas too. Now I'm wondering if you can spot something more, and I'll give you a few moments to look at this chart. Do you see what is forming over here? And I'll give you a hint. Think about second stage of distribution, right? Got that silver bullet formed, right? So we have that short-term high, longer-term high, and a short-term high to the right of it, that low-risk sell. We break structure, and once again we have that short-term high here, intermediate term high formed here, and then that silver bullet forms in that second stage of distribution. So multiple areas where you can get in, but this is the silver bullet area. Right, so another example we're gonna go over. This time we have E-mini Nasdaq 100 futures chart. We are in bullish order flow, right? So what are we waiting for? Internal to external and external to internal, right? So we know from the higher time frame we are bullish. We're coming from this internal range liquidity fair value gap. So how does that look like on our 4-hour perspective? We're still on a long-term perspective, right? Because our intermediate term perspective will be a 50-minute time frame, and our short-term perspective will be a 1-minute time frame. But over here, we reached that discount fair value gap, right? On the 4-hour over here. So we want to go from internal to external, right? We know daily order flow is bullish. We are in a discount array, and with this discount array hit, we can continue up into buy side liquidity and eventually run those buy stops. So our draw on liquidity for our long-term perspective has been established. Now let's dive in to intermediate term perspective, right? We want to line up our intermediate term perspective with our long-term perspective. So over here, we've got a break of structure over here, right? So our intermediate term perspective is in line with our long-term perspective. We can see a 15-minute continuation purge, and I will zoom in a little bit over here because you can't quite see it clearly down here, but we take out this swing low with this candle over here, and thus creating that continuation purge. And with that continuation purge, we can now start to look for our short-term perspective entry model. Right, we got a 1-minute time frame right now. We waited for that 15-minute continuation purge, which happened over here, and you can see it a little bit better now because we're in the 1-minute time frame. Buy side liquidity, our final target as a scalper, right? We're not holding for the whole day. We want to go in and out with our market maker models. So market maker buy model has formed after we create this low. We purge that sell side liquidity and thus going into that buy program. After that sell side purge, we break structure up here, and then after we activate a buy program, what happens next, right? All those down close candles should support price up higher. So we have a bullish order block formed over here. Another BPR over here, right? That redelivered rebalanced PD array. So we know this is a breakaway gap. using sell side of the curve, right? Again, with those mitigation blocks, we use it into the buy side of the curve. In this occasion, it's a breaker block because we took out sell side liquidity down here, right? And then breaking up. We have another bullish order block formed here, and then we continue up into this high. Now we're going to do some more additional examples so we can outline even better how this forms and all the time frame alignment with this universal model. Right, we got a British pound Swiss franc daily chart. Right, we go from external to internal. This is our long-term perspective, right? This is the why we should go there. This is where we start off. So we can see this external range liquidity being purged over here. The CE of this wick has been hit, so we're quite deep into discount. So after that external range liquidity purge, where do we want to go? We want to go into internal range, right? So we got this fair value gap as our drawn liquidity. Now our long-term perspective has been established. Going into our intermediate term perspective, we know our long-term perspective, we have that internal range liquidity daily fair value gap. On our intermediate term perspective, we got all these failure swings, right? So we know where the liquidity is resting. So we have our bias confirmed after we break structure, right? So we need this external range liquidity purge, and then we wait for that break of structure, right? Over here, we have a break of structure. We have those engineered buy stops over here. Over here, we have no kill zone yet, so no trade yet, right? Because we have a stop hunt over here on the 1 hour, but it's outside of the kill zone, and we really want to be in our time zone before we execute a trade, because outside of kill zones, the probabilities reduce drastically. So over here we see a 1 hour stop hunt, again on our intermediate term perspective. And now we dive into our short-term perspective, right? Now we have that 5-minute time frame. Again, think about that long-term, intermediate term. They're both in line right now because we broke structure, right? On the intermediate term, drawn liquidity is that long-term perspective daily fair value gap. And now we wait inside our kill zone for a break of structure and a liquidity purge. So we have that 1 hour stop hunt, that liquidity purge of sell side liquidity. So buy program has been activated, and we wait for London kill zone to start. Yeah, not before, we wait for our kill zone. So now all down close candles should support the price up higher, right? So we can see that over here, got a bullish order block, another one formed over here, and this is all inside the kill zone, right? So that's important. Price moves up again, forming another bullish order block, continues up again, hitting those buy stops for order pairing with sell stops. Now over here, we did not quite reach our draw on liquidity, right? Over here. So we have engineered buy stops for the next kill zone. So the draw is not reached yet, so longs are still valid. Once again, you can draw out your mitigation blocks from the sell side of the curve into buy side of the curve, right? So over here we've got a Australian dollar, US dollar 1 hour chart. Again, we're going to do another example. This is more of a scalper example, right? Because we are on our long-term perspective on a 1 hour chart. So what has happened over here? We've got failure swings, right? So we have a draw on liquidity down here. What happened prior? External range liquidity, right? Buy stops have been purged up here, thus making us go into sell side of the curve after that happens. We've got some sell stops down here with those failure swings, right? So low resistance liquidity run. And now we dive into our lower time frame. So over here, 5-minute time frame, we wait for a break of structure, right? Important. So break of structure happens down here. Sell program has been activated because we took out that external range liquidity, right? So all up close candles should now act as a resistance and support price down lower. Order blocks, fair value gaps, and turtle soups are high probability above here, right? Above this area, because why? We are in premium, right? So from this discount low into this premium high, everything above this 0.5 level is higher probability than below it. So those PDRAs below this 50% level are still valid if the draw hasn't reached yet. However, there are a little bit lower probability because we're not in a premium level, right? So try to always get in on a premium level if you're selling, and if you're buying, you want to be in a discount level, right? We can see all these bearish order blocks supporting price to go down, over here too, over here, and so on until we reach that draw on liquidity, those sell stops. Again, outlining from the buy side of the curve into sell side of the curve, our mitigation blocks, right? Are we having new PDRAs formed inside those mitigation blocks and making it higher probability for price to resist that area, right? We have that fair value gap here. Inside this mitigation block, we have this bullish order block being formed inside this mitigation block, and so on over here, mitigation block into this bearish order block again. Down here, another mitigation block, and we can see all these PDRAs formed here are still holding price to continue down lower and complete this market maker sell model. So over here we've got an Australian dollar, New Zealand dollar daily chart, right? And this is going about relative strength analysis, right? So over here, if we want to trade AUD USD, for example, or NZD USD, we go to Australian dollar, New Zealand dollar to see which one is more weak or which one has more strength. And over here, you can see AUD NZD is extremely weak, right? Because we can see price action continues to dive deeper and deeper, making NZD stronger than Australian dollar. So in this occasion, Australian dollar is weaker than the New Zealand dollar, so you had better shorts on AUD USD over NZD USD. Let's move on to an Asian session model, a hidden gem. Now, before we start off, it is a highly requested Asian session model by our Asian-based traders from Twitter. So with Asia session generally being a lower probability session, this is the most consistent and high probability bread and butter based model, and it repeats, and it is easy, and it has very little moving parts. So we're going to be talking about the AUD JPY and the 2022 YouTube model. The kill zone for this model is 8 to 10 p.m. New York time, and Australia and Japan are 1 hour apart, and their sessions open are 1 hour apart too. So within the 8 to 10 p.m. New York time, both Australia and Japan open are in this time window. And due to this, there's a volatility injection in the market, and our focus is going to be on a 15-minute turtle soup long or short. So what do we want to see? If we are bullish, we want to see a 15-minute swing low get run between 8 to 10 p.m. New York time for a turtle soup long. And if we are bearish, we want to see a 15-minute swing high get run between 8 and 10 p.m. New York time for a turtle soup short. So over here we've got the Australian dollar Japanese yen daily chart. We're still going to go over our higher time frame draw, right? We need to know if we're coming from internal or external. So what do we see on this chart? We've got that external range liquidity taken, right? So we move from external to internal and from internal to external, right? So we can see that over here, this high has been taken out. So external range liquidity has been liquidated, and now we move back into internal range, which is this fair value gap. And how does that look like with premium and discount levels drawn out? Over here we've got our range low, right, into equilibrium down here, and then eventually, because we took out that external range liquidity, this is our dealing range high or our premium high. So over here we've got that daily fair value gap after we took out that external range liquidity, and that was our draw on liquidity going from external to internal. Now how does that look like on a 15-minute chart, right? And remember, we're going to look for setups between 8 and 10 p.m. New York time. We want to wait for that 15-minute stop hunt, and then we're going to drop down into time frame. So we kind of don't want to go into a 1-minute time frame because that is a little bit inconsistent. So we're going to focus on that 2 to 5 minute time frame. So up here, remember, external range was taken up here, right? So we can still look for a setup drawing into internal range. So there is a nice sell setup happening over here, right? With that 15-minute stop hunt. Over here, we're in that higher time frame internal range liquidity POI, this point of interest, right? We've got that 8 to 10 p.m. time window where we're going to be looking for that 15-minute stop hunt. So first of all, let's go over that sell opportunity, right? After we take that external range liquidity on the daily time frame, where our draw on liquidity is going to go to that internal range liquidity, which is the daily fair value gap lower, right? Now we wait for our Asian session model kill zone, which is that 8 to 10 p.m. and then we wait for a 15-minute stop hunt. Now we're on a 2-minute time frame, right? Not on a 1 minute, so we're going to be looking between 2 and 5-minute time frame. So over here we've got that 15-minute stop hunt happening, and now we're going to look how that looks like with our PDRAs marked out in time and obviously waiting for break of structure, and then our entry model. So we draw out our premium and discount as always, right? We had that 15-minute stop hunt over here. Now this is our dealing range high and our dealing range low. So if we want to enter on a sell, we want to be in premium levels, right? We don't want to sell in discount, we want to be in premium, which is up here. Now we can outline an order block or a fair value gap after that break of structure, and that should be a solid entry point. So over here we've got a 2-minute fair value gap right over here. And you can see price draws back into premium, then respects it, dips in one more time, and then declines lower in our higher time frame draw on liquidity. So over here we're in that Australian dollar Japanese yen 2-minute chart, right? Not going into the 1-minute chart, we're going to go from 2 to 5 minute, and over here we'll wait for that Asian model kill zone time frame, right, at 8 p.m. to 10 p.m. Now we're in the CE of the daily fair value gap, right, that internal range liquidity. Over here is the CE line, that dotted line over here, and then we wait in our kill zone time, we wait for that 15-minute stop hunt, which happens over here, right? So from this point on out, now we know our first criteria has been met, which is that 15-minute stop hunt, and now we draw out our premium and discount levels, right? So we break structure up here. Now we have our dealing range low, which is down here, into this dealing range high up here. Now a good entry model would be a fair value gap or an order block, right? And it has to be in discount, right? Because we want to buy and we don't want to buy in a premium level. We want to draw back into that discount level down here. What do we see? We have a breaker down here, and you can see price is supporting over here and continuing up and up and up. And we have those clean highs up here, those failure swings above here, right? Think about that low resistance liquidity, and then price continues up and takes out that buy stops over here. Now that second scenario, once again, right, we wait for that 15-minute stop hunt. We're still in the daily fair value gap, right, the daily internal range. We want to go to external once again. So we wait for that 15-minute stop hunt. It happens over here in the kill zone, 8 to 10 p.m. important, right? And then we're going to look for an entry model. But what do we do first? We draw out our discount and our premium levels, right? Discount is over here, premium is up here. We've got this nice discount order block marked out in time, breaking structure up here, and this should support price to go higher. Right, so over here we got that Australian dollar Japanese yen daily chart once again, right? Now we're thinking about that internal to external and external to internal once again. Over here we have our discount low into discount high. So we have these failure swings up here, right? So buy side liquidity is that external range liquidity. So after we hit internal range liquidity, which is this daily fair value gap, right? This daily fair value gap has been filled up. Then we're going to look for external range on liquidity. So that's our draw on liquidity for the higher time frame. Then again, we dive into the 15-minute time frame, right? We want to wait for that 15-minute stop hunt inside our kill zone time, 8 p.m. to 10 p.m. Your eye should go immediately down here, right? We wait for that 15-minute stop hunt. It happens over here. And once you see that and price starts to break up higher, we dive in a lower time frame for our entry model. So to illustrate how that looks like, right, with a little bit more annotations, we got this 15-minute purge over here, so that 15-minute stop hunt. So that's a turtle soup for our long, because our bias is bullish, right? We're coming from that daily discount fair value gap, and we want to draw into external range liquidity, which is up higher. So now once again diving into the lower time frame, right? The lowest you will go is a 2-minute time frame, 2 minutes between 5 minutes, right? That's our time frame. We're going to be looking for an entry. Over here we've got all these failure swings, so low resistance liquidity, right? So even better, if we are bullish, we want to have that low resistance liquidity above us. Then over here we see that break of structure in our kill zone time, right? So it has to happen within our kill zone time. So break of structure, price returns back into discount, and what do we have, right? Premium high into discount low, and we can see this bullish order block with a fair value gap combination, right? That fair value gap and bullish order block combination is typically very strong, and it happens inside the kill zone, so time is matching up with price, and eventually we take out those failure swings, which is low resistance liquidity, and we're going, remember, from the daily time frame, from internal range liquidity, that daily fair value gap, we want to reach into external range liquidity. We have arrived at the last lesson of this mentorship, and we're going to be talking about funded accounts, how to pass them and how to retain them. So how do we pass and how do we keep those funded accounts, right? As we all know, phase 1 of most prop firms is 8% profit target, and phase 2 is 5% profit target. Now, depending on the prop firm, you have a either 10% max drawdown or 12% max drawdown, and most of the time the daily maximum drawdown is 5%. But we don't want to risk 5% in a day, right? So be sensible. Our objective is to win 2 trades in a row, and this risk management plan is framed around the different models taught in the mentorship and assuming you follow all the rules. Our objective with the first trade is to get a 2 to 3% buffer on the account, and then we're gonna risk 2%. So phase 1, right, 8% profit target. Option number 1, how are we gonna do it? When we are break even or we are starting out the account, we risk 1% and then we aim for a 1 to 2. Don't go be aiming for 1 to 5 or 1 to 6. We wanna go and build up our buffer first, right? So a 1 to 2 for a 2% buffer. Now for our second trade, we risk 2% and then we aim for a 1 to 3, and that would be 6%, right? So with 2 winners, you can get a phase 1 passed with 8%. If at any point we are back at break even, we risk 1%. So at any point when we are below break even, we risk 1% or less, and we don't risk more to catch up, right? Because then if we take another loss and we go risk 2% or 3%, we go even deeper in drawdown. Option number 2. When we're at break even, we risk 1% and then we aim for a 1 to 3. So then we have a 3% buffer to start off our account, right? For our second trade, then we risk 2% and then we aim for a 1 to 2.5 R, making 5%, right? So again, with 2 per trades, you pass that 8% phase 1 profit target. If at any point, again, we are break even, we risk 1% again, and if we are below break even, we risk 1% or less and never risk more. Now for phase 2, option number 1, at break even, again, we risk 1% and aim for that buffer, right? That 1 to 2, so we have a 2% buffer. Then for a second trade, we risk 1% and then aim for a 1 to 3. Now you can see this is a little bit more conservative, right? Because on phase 1 you have to have 8% profit target, which can be a long climb if it's not done properly, but this 5% is a little bit easier to attain, so there's no risk to risk 2%, right, for option number 1. So risking 1% to go for a 1 to 3, getting that 3%, and then you have that full 5% phase 2 passed. Again, at any point if we are break even, we risk 1% again, as always, and then if we are below break even or we are in drawdown, we risk 1% or less and never risk more. Option number 2, at break even, we risk 1% and then we aim for a 1 to 3, right? So we aim for that 3% for our first trade, and then for our second trade, we risk 1% and then aim for a 1 to 2. So that should be a pass on your challenge account in 2 trades once again. If you're at any point at break even, risk 1% again, and if you're below break even, risk 1% or less and never risk more than 1%. So now that we've attained that live account at break even, we risk 0.5% and then aim for a 1 to 2. Now we have a 1% buffer, right? So for a second trade, now we can risk 1% and then aim for a 1 to 2 or a 1 to 3, and that depends on the trader's strike rate. Once you reach about 2 to 6% on your live account, leave it, because we move on to the next account. Once a live funded account reaches that 2 to 6%, you can wait for your payout, get your challenge money back, and then you can move on to the next account. And this is how you build up your capital.